So now let's get started with the revision of the fourth chapter of this marathon, which is investment decisions. And this chapter is also popularly known as capital budgeting. Capital budgeting. See, it is mentioned here. This chapter is also popularly known as capital budgeting. Now, first, let us understand this chapter with a background. This is a very easy chapter if you understand the logic, number one. And number two, there could be some case study questions in this chapter which students generally find it difficult. So I am also going to solve two extra case study questions in this marathon itself in order to give you a proper clarity. Now, in case of case study questions, what you need to do is you need to have patience in reading the question carefully. And once you read this question carefully, automatically you will know how to proceed further. Clear? Yes. So now first, this chapter is called as investment decision. The alternative name for this chapter is also known as capital budgeting. Now, what does this chapter talk about? Now in our subject, financial management, yes, we saw that overall financial management helps us achieve three objectives. Financing decisions, that is decisions relating to fundraising activity, correct? Then investment decisions, that is decisions relating to where the funds should be deployed, correct? And then you have something called as dividend decisions, right? So under financing decisions, we saw three chapters we saw already. So the three chapters that we saw already was cost of capital, then we saw leverages, then we also saw capital structure decisions, correct? Yes. So now this chapter, the name itself is investment decisions. This falls under the category of the second objective of our subject, which is investment decisions. Sir, what do you mean by investment decisions? So where exactly does this fit into? And in financial management, what we are going to do in this particular chapter? Now, let's assume this is the balance sheet of a company, right? Now, what happens to actually start a business? Company needs money, correct? So company can get money from various sources of finance, as we have seen in the previous chapters. It can be through equity share capital, it can be through retained earnings, your preference share capital, your debentures, your long-term loans, etc. Correct? So now a company raises money from these different sources of finance. Obviously, each source of finance has its own cost, and the weighted average cost of capital is popularly known as the overall cost of capital, or WACC. So basically, the company raises money, correct, which comes with a cost. Now, why does this company raise funds? So that they can deploy this funds, they can put this funds into the business and generate some revenue. Sir, what is the meaning of this? Basically, what they do is, once they raise this money, the company will predominantly buy fixed assets, correct or not? Yes, using this fixed assets like plant and machinery, your entire factory, or it can be your equipment, it can be so many things. Using this, of course, in your day-to-day operations, you have something called as current assets, current liabilities. You have current assets here, current liabilities here. Popularly, these two netted off is called as working capital. This working capital is a subject matter of study in the next chapter that we are going to revise, which is working capital management. But the predominant amount of the long-term sources of finance goes into the company's non-current assets, also known popularly called as fixed assets. Why? Only if you have a fixed asset, only if you have a factory, only if you have equipments and all purchased, only then you can run your day-to-day operations. Yes or no? So the next part of this particular financial management is, which are the assets I need to buy? Or in other words, taking decisions with respect to the investment perspective. Sir, what could be the decisions that I take in this chapter? Let's say I'm a manufacturer. Let's say I'm a pen manufacturer. Okay. Now, this pen, whatever pen that I'm going to manufacture, let's say I'm Rorito, right? This company called Rorito. So let's say I'm a pen manufacturer. This Rorito pens can be manufactured using machine 1 or machine 2 or machine 3. Let's say there are 3 models of machines available, correct? Now, whether I should buy machine 1 or I should buy machine 2 or I should buy machine 3, this is a decision taken in this chapter. This is one of the decisions. Are you clear with this? So it is not necessary that, one second. So it is not necessary that this is the only decision that you are going to take. It can be machines in this case. It could also be projects. What do you mean by project? Let us say I am a company like L&T. Okay, I'm a company like L&T. So whether I should go for project A or project B or project C, or maybe project A and B together, or B and C. So whichever base. So I need to find out where this money needs to be deployed, because I am raising this funds. These funds do not come free of cost. It comes with a cost. Yes, now I should judiciously, I should carefully invest it in such avenues that gives me more return. So I will have to compare between different alternatives. Are you clear with this? Yes. Now, sir, how do we go about with this chapter? There is something called as capital budgeting techniques in this chapter. We will be seeing, using those techniques, we will actually gauge, we will find out which is the best investment proposal, and all those things related to that we will find out. Now, one most important thing in this chapter is about cash flows. That is, let us say, if I want to purchase machine 1, now initially there will be year 0, there will be a cash outflow, correct? Let us say 100 crores is the cash outflow, correct? Then let us say this machine has a life of 5 years. So for the next 5 years, the machine can generate what? Inflows. So it can generate, let us say, 30 crores in year 1, 25 crores in year 2, 15 crores in year 3, 10 crores in year 4, and let us say 12 crores in year 5, and so on. Are you clear with this? So always remember, in this chapter, in investment decision chapters, there is an initial outflow followed by a series of cash inflow. Why? Because first you need to shell out money to buy the fixed asset, to buy the long-term equipment, correct? And once you do that, you can use it every year. To generate your cash flows. Are you clear with this? This is exactly the opposite of cost of capital. There in cost of capital, what we saw, it is about fundraising activity. Initially, you will get the funds from the investor, followed by a series of outflow. Every year, you need to pay them interest or dividend, correct? But in this case, what happens? The cash flows are reverse exactly. That is initially there will be an outflow followed by a series of inflow. Are you clear with this? That is how this entire chapter is going to look like. And of course, we will be using time value of money techniques and all that. But remember, this chapter is about what? About where should I park my funds, which are the right avenues where I can invest my funds and generate money. Are you clear with this? Yes. Now, there are some popular capital budgeting techniques. So this is the overview of this entire chapter, capital budgeting techniques. So capital budgeting techniques can be broadly classified into traditional or non-discounting techniques and time adjusted or discounted techniques. Are you clear with this? Very simple. There are only two methods in the traditional technique, something called as payback period and something called as accounting rate of return, right? And then there are 5 methods under the time adjusted or discounted techniques, something called as NPV, which we've already seen in basic concepts, correct? What do you mean by net present value? The present value of cash inflows minus present value of cash outflow. Are you clear with this? Then there is something called as profitability index. Profitability index is nothing but present value of cash inflows divided by present value of cash outflows. Are you clear with this? This is what NPV, present value of cash inflows minus present value of cash outflow, correct? So if the NPV is positive, then it means that you can go for the project. If NPV is negative, it means that you should not go for that particular investment avenue. Are you clear with this? Fine, I'm just giving you a broad introduction. Anyways, we will be seeing a lot of sums, even high level sums we'll be seeing, so we need not worry about that. Whereas profitability index means what? Present value of cash inflows divided by present value of cash outflows. So technically, if the numerator is greater than the denominator, that is, if your present value of cash inflows is greater than your present value of cash outflows, generally your profitability index will be 1, correct? If it is less, if your present value of cash inflows is less than your present value of cash outflow, then it means that your profitability index will be less than 1. It will be in a decimal. Are you clear with this? Are you clear with this? So ideally, if your profitability index is 1 or more, then technically it means that you have a positive NPV. This is some interconnection that we can do. Then we have IRR. internal rate of return. So what do you mean by internal rate of return? The rate that makes our NPV equal to 0, or in other words, the rate that makes my present value of cash inflow equal to my present value of cash outflow. That is the rate that makes my NPV equal to 0. We have already seen this in the basic concepts. Anyways, we'll be touching upon this. Then there is something called as discounted payback period, and the final thing is called as MIRR, marginal internal rate of return. It's a modified internal rate of return. It's a modification of IRR. Are you clear with this? Now, very simple. The first two methods, traditional methods, these two methods ignores the concept of time value of money. Clear? Whereas these five methods considers the concept of time value of money. So you tell me logically, which is better, the traditional approach or the time adjusted approach? Obviously the time adjusted approach. Why? Because the time value of money concepts are considered here only. In the traditional approach, that is the payback period and accounting rate of return, generally you don't consider your time value of money concept. So basically it is not that great approaches. Are you clear with this, sir? So we are finished the chapter? No, I'm just giving you an introduction. So we will be seeing everything one by one with numerical problems. Are you clear with this? Yes. Now there are a few rules, general rules that we need to follow in this particular chapter. So I told you, right? So generally in this investment decisions, there will be a cash outflow initially, followed by series of cash inflows. Correct? Yes. Now every year you have a cash inflow. Correct? The cash flow is there. Correct? Now what cash flow is this? Or in other words, what are the items that needs to be considered while arriving at this cash flow, every year's cash flow? What are all the items that needs to be considered? These are some general rules that is prescribed at the beginning of this chapter. All these things are mentioned in our ICA study material. Now, while calculating the cash flows in capital budgeting decisions, the following items need consideration. The first one is depreciation. Now, depreciation is a non-cash item by itself. It does not affect the cash flow. However, we must consider the tax shield or tax benefit from depreciation in our analysis. Since this benefit reduces the cash outflow for taxes, it is considered as tax. It is considered as a cash inflow. So, what do you mean by this? Now, let us say every year you have all the cash flows. Correct? In that, depreciation is also one expense. So in your P&L account, if you see, you have sales, correct, minus all your operating expenses and all you have, minus depreciation is also an item. Correct? You arrive at this to compute at your profit before tax. Yes or no? Fine. From this you reduce your tax to arrive at your profit after tax. Yes. Now you tell me, now this depreciation is no doubt an expense considered for the purpose of arriving at your profit after tax. But you tell me, from a cash flow perspective, every year will you pay depreciation to anyone? No, it is not a cash outflow. But the presence of depreciation can reduce your tax liability. Why? Because depreciation is a tax allowable, tax deductible expense. So, or in other words, depreciation as such should not be considered. But the presence of depreciation will impact your tax savings, correct or not? Or in other words, the tax savings on depreciation should be considered, but depreciation as a whole should not be considered. Sir, can you give us an example? Let us take the first question in this particular discussion, in this particular chapter. Let's take the first question. So go to question number 1. ABC Limited is evaluating purchase of a new machinery with a depreciable base of 1 lakh rupees, expected economic life of 4 years, and the change in the earnings before taxes and depreciation of 45,000 in year 1, 30,000 in year 2, 25,000 in year 3, and 35,000 in year 4. Assume straight line method of depreciation and a 20% tax rate. You are required to compute the relevant cash flows. So now what they are saying, if this company ABC Limited, if they buy a new machinery, for the next 4 years, it has a useful life. And for each of the 4 years, they have given the earnings before tax and depreciation. That is earnings before tax and depreciation. Tax and depreciation, both have not been considered, so which means they are yet to be considered. How much? 45, 30, 25, and 35. This is what they have given. Now, what we need to calculate in this question, we just need to calculate the cash inflows for these 4 years. Are you clear with this? That's all. We are not using any capital budgeting techniques and all. We are not applying. They have just asked us to calculate the cash flows for each of these 4 years. Now, they have given that the depreciable base is how much? 1 lakh rupees, and straight line method of depreciation, tax rate is 20%. Straight line SLM method of depreciation, which means 1 lakh divided by 4. Every year the depreciation is how much? 25,000 rupees. So what we need to do, earnings before tax and depreciation less depreciation. So in the first year it will be how much? 45,000 minus 25,000. It gives you earnings before depreciation of how much? Earnings before tax of how much? 20,000, correct? Minus tax at the rate of 20% gives you how much? 4,000 rupees of tax. So earnings after tax is how much? 16,000. Now wait. This 16,000 is not the cash flows after tax. Why? Because this depreciation ideally was not a cash flow at all. It was not a cash outflow, but I have subtracted it. Correct? So now what we need to do is, whatever depreciation we subtracted before, now we need to add it back. So add back depreciation. Why? Because it was never an outflow. I have subtracted it before, so now I am adding it back. So the net cash flow after tax is going to be 41,000. This is the amount that is considered for all our investment decision purposes. Are you clear with this? So whenever I say the relevant cash inflows, it is basically cash flows after tax. Are you clear with this? Remember this word, cash flows after tax. That is, we are considering only cash flows, that too after tax, the post-tax cash flows. Now, I'm repeating this entire thing once again. We started with where? Earnings before tax and depreciation. We subtracted depreciation, arrived at earnings before tax. Always remember, earnings before tax is the base on which the tax rate is applied. Correct? So, less taxes, you get earnings after tax. Correct? Now wait, since depreciation was a non-cash item, still it was subtracted. So now you add it back to nullify the effect. You get this cash flows after tax. Are you clear with this? Now you might have a doubt. Sir, I have subtracted depreciation here, but I have added it back here. Instead, I could have ignored depreciation completely. No. Just look at this. I subtracted depreciation here and added it here. In between, there is a line item called tax. Correct? Now, tax is calculated on earnings before tax, or in other words, since the depreciation was initially subtracted, the base on which I am computing the income tax is now reduced. So instead of calculating tax on 45,000, I am calculating it on 45 minus 25, only 20,000, correct? So, or in other words, because of the presence of depreciation, what has happened? Your tax outflow has reduced. So technically what we have done is, we have ignored this depreciation as a whole, but the presence of depreciation has impacted on some tax savings. So the tax shield on depreciation has been properly considered. How? Because we have reduced it in the beginning, and on that reduced amount only we have computed the tax, and then we have added it back once again. Are you clear with this? Are you clear with this? This is how you compute the relevant cash flows for every year. Similarly, for second year, earnings before tax and depreciation, subtract depreciation, you get earnings before tax, multiply the tax rate on that, you will get earnings after tax, then add back your depreciation, you get your cash flows after tax. Similarly for third and the fourth years respectively. So now every year's cash flow is how much? Net cash inflow that you get is how much? So if you invest in this machinery, at the end of year one, technically you get 41,000 after paying all the taxes, correct? Here at the end of year 2, 29,000, at the end of year 3, 25,000, and at the end of year 4, it's going to be 33,000. Remember, here in this chapter, we are talking about cash flows. We are not talking about profits. We are only talking about cash inflows and outflows. We are just matching these two, cash inflows with cash outflows. We are not bothered about the profits and all that. So based on the data that is given, based on the starting point of what we need to do, we need to arrive at what the cash flows after tax. Are you clear with this? So earnings before tax and depreciation minus tax gives you earnings before tax, correct? Less taxes gives you earnings after tax. But now you need to add back the depreciation which we once subtracted. So you'll get the cash flows after tax. And the relevant criteria for this chapter is cash flows after tax. Are you clear with this? So basically, in short, we need to ignore. So depreciation should not be subtracted, but tax saving on depreciation should be considered. That's why we subtract it on the top and compute the tax. And finally, at the bottom, once again, we add it back. So that overall, what happens? Only the tax impact or the tax savings on the depreciation is being considered, whereas the whole depreciation as such is not being considered. Are you clear with this? This is the first learning here. Right. Now, now go back to the first one. Go back to the first one. These are some basic rules. The problem is students generally, they miss out on this very, very basic areas, because if you spend more time on this and learn this basic areas, automatically any kind of sum you will have a crystal clear clarity. Clear. So generally students miss out on this, and that is the reason why I'm just quickly going through this. Next, B, determining the discount rate. Now I told you this chapter involves what? Time value of money techniques. Yes. So not considering time value of money techniques, there are only two methods. Leave that. But predominant portion of this chapter considers time value of money techniques. Yes. Now this 100 crores is a cash outflow arising at the beginning of the life of the project, that is on the present date. But if you see, this 30 crores is happening at the end of year 1, 25 crores the end of year 2, 15 crores the end of year 3, 10 crores the end of year 4, and 12 crores the end of year 5. Correct? So these are cash flows, cash inflows arising at different point of time. Yes. Now can I add these cash flows as such? No, I cannot add these cash flows as such. Why? Time value of money concept, because the cash flow at the end of year 1 and cash flow at the end of year 2, or the cash flow at the end of a different period, are not comparable as such. So what will I have to use? I need to use a relevant discount rate and convert all these things into present value and arrive at the present value of cash flows. Yes. Now for me to do it, for me to actually arrive at the present value, how will you do it? Very simple. Cash flow at the end of year 1 divided by 1 plus r to the power 1 plus cash flow at the end of year 2 divided by 1 plus r the whole power 2 plus cash flow at the end of year 3 divided by 1 plus r the whole power 3 plus cash flow at the end of year 4 divided by 1 plus r to the power 4 plus cash flow at the end of year 5 divided by 1 plus r to the power 5. Correct? If I do this only, I will get the present value of cash inflows, because these cash flows are not addable as such. Correct. Now here basically we need a discount rate. Yes or no? We need a discount rate. Yes. What is the discount rate that we can consider here? Now very, very simple, guys. This is where we are going to connect the concept. This discount rate that we will be considering in this chapter is nothing but your WACC, weighted average cost of capital, also known as KO. Are you clear with this? Sir, why, sir, in this chapter we are taking the discount rate as weighted average cost of capital? Very simple. Very simple. Look at this. I am raising funds. Correct? The cost of raising the funds is only called as KO, also known as weighted average cost of capital. Correct? Now, when I am taking an investment decision, let us say the weighted average cost of capital is, example, 12%. Correct? Now, when I'm taking an investment decisions, I should invest in the machines, or I should invest in assets that at least generates how much? 12% return. Only then I will be able to pay my finance cost. Correct or not? Yes. So technically, this is the base on which I will do all the computations, or this is the minimum rate that I need to generate using my assets. Are you clear with this? So whenever they are asking for a discount rate in this chapter, discount rate stands for KO, also known as weighted average cost of capital. And this is the logic. An organization may establish a minimum rate of return that all the capital projects must meet. This minimum could be based on an industry average or the cost of other investment opportunities. Many organizations choose to use the overall cost of capital, or WACC, weighted average cost of capital, that an organization has incurred in raising funds or expects to incur in raising the funds. Are you clear with this? This is what they are saying. So which means discount rate stands for what? Discount rate stands for your weighted average cost of capital. Now, this is different from IRR concept. I will come to that in a while. Next, exclusion of financing cost. Now, very important. Now, what we do, so the present value of cash inflows, present value of cash flows, whatever you want, you can just say. Now, what we do, the relevant cash flows divided by 1 plus r to the power n. Yes or no? This is how we need to discount the cash flows. Yes. Now, what they are saying, this relevant cash flows are nothing but cash flows after tax. Correct? Yes. The first thing we saw is depreciation should not be considered, but the tax impact on depreciation should be considered. We have seen it. Yes, absolutely. Right? Now, this is always post-tax. Taxes should be considered. After tax, cash flows should only be considered. Yes. Now, one very important thing that we are going to see, while computing the relevant cash flows, that is the numerator, every year's cash inflows while you are computing, you should not deduct any kind of finance cost. What do you mean by finance cost? Basically, interest and dividend. So what is this, sir? What is the logic for this? I will explain. So what we are saying, every year, the cash flows after tax that we are computing, it should not consider the finance cost. Why, sir? Is this as operating cost? No, 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 no. That is not the reason. I will give you the logic. The finance costs are already considered while computing the denominator. What is denominator? R. R is nothing but KO, no? Yes. What do you mean by KO? What do you mean by KO? So KE into WE plus KP into KP into WP plus KD into WD. Yes. This is how you compute. Correct? While each of these costs are already considered in the denominator, if you consider it once again in the numerator, if you deduct all these things once again in the numerator, it will definitely have a double negative impact. So you should not do that. Or in other words, this numerator should be the funds available or the net cash flows available for distribution to all the sources of finance. Are you clear with this? That logic you remember. So basically, this cash flows after tax should be after tax, but before paying your interest and dividend, before finance cost. Why? Because all your finance related costs are being factored into in your denominator, and in the numerator you should only consider the cash flows that are available for all the sources of finance. Are you clear with this? This is the logic for taking up cash flows after tax without considering the finance cost. Very important thing, guys. These are some fine things that students generally miss in exam. That's why I'm pointing it out for you. Exclusion of financing cost. So when cash flows related to long-term funds have been defined, finance cost of long-term funds, that is interest or dividend, should be excluded from the analysis. See, these are reflected in the weighted average cost of capital. Look, all these words are coming from institute study material. Correct? Hence, if the interest on long-term debt and dividend on equity capital are deducted in defining the cash flows, the cost of long-term funds will be counted twice. So these things are already taken care of in the denominator. Please don't disturb the numerator once again. That is, don't consider all these while taking up the cash flows. And post-tax principle, we already solved. That is, we are only talking about cash flows after tax. Correct? So the relevant cash inflows while you're computing, you should compute the cash flows after tax and not the cash flow before tax, only after tax. Fine. And similarly, in the denominator, while computing 1 plus R, that R is nothing but your weighted average cost of capital. Correct? And weighted average cost of capital is nothing but KO. For calculating KO, you consider all taxes and all. What do you mean by KD? How do you calculate KD? For KD calculation itself, I into 1 minus T and all we do. So basically, the denominator also considers, it is also the post-tax cost of capital. The numerator is also your post-tax cash flows only. Only then it is comparable. Are you clear with this? Have these crystal clear clarity. So the cash flows after tax should not consider depreciation, but it should consider the tax shield on depreciation. So you subtract it once and then add it back in the end. Correct? The second point that we studied is what is the discount rate? Discount rate is taken as the weighted average cost of capital. The third point that we studied here is the financing cost should not be considered, should not be deducted from your numerator. Reason, the logic is nothing but it is considered while calculating your discount rate. And the fourth one is always the cash flows that you consider should be post-tax cash flows. Are you clear with this? These are some basic ground rules on which this entire chapter is being based about. So now we have seen how to calculate the cash flows and all that. Now let's quickly jump into the capital budgeting techniques. So what do you mean by capital budgeting techniques? These are the techniques using which you will judge whether you should go for a particular project or not. Are you clear with this? So these are the techniques or methods using which, the tools using which you will judge whether you can go for a particular investment avenue or not. Project A, if you can go for it or not. How it is what we are going to see. Now, traditional method has two things. One is called as payback period. The other one is called as accounting rate of return. So payback period and accounting rate of return. These are the two traditional approaches. Nothing great here. Nothing great here. So accounting rate of return. So the accounting rate of return of an investment measures the average annual net income of the project, that is incremental income, as a percentage of investment. Now, what it is, I will just tell you. We will do an example and we will just finish it off. Very simple. But remember one thing, these are what? These two methods, that is payback period and your accounting rate of return, ignores time value of money concepts. Hence, in this case, in this accounting rate of return that we are going to see, we will not be talking about cash flows. We will be talking about profits. Accounting rate of returns, we are going to talk about profits. This is the only method where we will be talking about profits. Sir, you just know you said cash flow should only be considered, your profit should not be considered. Correct. Yes, this is a method which ignores your time value of money. So for this method alone, you should consider only your profits, what it is and all. I will just walk you through. Don't worry about it. So let's go to the second question, which is problem number 2, average rate of return, accounting rate of return. Basically, it can be called as anyways. A project requiring an investment of 10 lakh rupees and it yields profit after tax and depreciation as follows. Look, they are not mentioning cash flow. They are mentioning profit after tax and depreciation. Year 1, 50,000, year 2, 75, year 3, 125, year 4 is 130, and year 5 is 80,000. So if you add up all these things, the total cash flow is how much? 4,60,000. Wait, so just now you said the cash flows arising at different periods cannot be added as such. Yes, if you follow time value of money techniques. That's why I said these methods are not great. They don't follow time value of money techniques. That's why they have added all these things. Are you clear with this? Yes. Now, suppose further that at the end of the 5th year, the plant and machinery of the project can be sold for 80,000 rupees. Determine the average rate of return. They are asking us to calculate average rate of return. Guys, nothing. This is plain vanilla. This is nothing great there in this particular question. This is looking at things from an accounting perspective. So technically, this is not even related to finance. I would say this is an accounting perspective. It is about calculating average rate of profit. That's about it. It's nothing to do with, I would say nothing much to do with finance. What it is, how to calculate. Now, the rate of return can be calculated as follows. Basically, the reason why I'm doing this is there are 2 ways in which you can compute the average rate of return. The first one is what? The numerator should have what? Average profits. Numerator should have average profits. Denominator should have what? Investments. Correct? Average profit, how will you compute? Very simple. Sum total of all the 5 years profits divided by 5. Correct or not? Yes. So sum total of all 5 years profit is how much? 4,60,000 divided by 5. How much is this? 92,000. Correct. The denominator should have investment. Correct. Now the question here generally is, should I take average investment or should I take initial investment? Now in this method, in this ARR method, you can either take initial investment or you can take average investment, but this sum we will do it under both. That is, denominator alone, there is a confusion. So first, if the initial investment is taken, very simple. So what is the numerator? Average profit. Average profit is nothing but total profit for all the 5 years divided by 5 years. Correct? 460 divided by 5 divided by initial investment. What is your initial investment? So it's 10 lakh rupees. Are you clear with this? So divided by 10 lakhs. So it gives you 9.2%. Are you clear with this? So we can say if you invest this, if you invest money, if you park your funds in this project, you get an average rate of return of how much? 9.2%. Now this rate is compared with the rate expected on other products. Suppose the company has a policy. I will invest in a project only if it at least generates me 10% of return. Now this, they will have a yardstick, correct? This project gives me only 9.2%. So reject it. Don't go for this project. Are you clear with this? So these can be used as a yardstick to judge whether or not to go for this particular project. This 10%, how they arrive, they can use it as any parameter, or they can even keep the WACC, weighted average cost of capital. Let's say weighted average cost of capital for this company is 10%, which means if they are deploying their funds, every rupee that they are investing in a project should at least get them 10% or more, correct? Because anyways, I need to pay 10% for every rupee that I have borrowed, source of finance. So when I'm investing it, it should generate at least 10%. This project generates only 9.2%. So now I will not go for it. Are you clear? Suppose the weighted average cost of capital is only 8%. This project generates 9.2%. So yes, since the return that I get from this project is more than my weighted average cost of capital, then the company can decide whether to go for it or not. Are you clear? It is feasible. It's at least an open option that you can keep. Clear? Fine. For example, the management may decide that they will not undertake any project which has an average annual yield after tax less than 20%. Any capital expenditure proposal which has an average annual yield of less than 20% will be automatically rejected. This 20% and all is just a yardstick example that they have mentioned. Don't think always 20% is a yardstick. No, nothing of that sort. Now, This ARR can be also calculated using a different formula. Average profit divided by average investment, correct? This is where many students have a doubt regarding the formula that the institute has given in the study material. Average investment is equal to 1 by 2 into initial investment minus salvage value. So half of initial investment minus salvage value plus salvage value. So why this formula? Look guys, it's very simple. Don't complicate it. Don't complicate it. Now, if I split and write this formula, automatically you will understand this is nothing. Average investment means what? Opening plus closing divided by 2, or half of opening plus closing investment. Correct or not? Yes? Right. Now you tell me, this formula they have given, let us just split it and write. Can I rewrite this formula as half of initial investment, I'm writing it as II, minus half of salvage value, correct? So half into initial investment minus half into salvage value plus salvage value, correct guys? Yes. So can I say salvage value minus half of salvage value? Can I say, if I block these two together, can I say salvage value, 1 salvage value minus 1 by 2 of salvage value is nothing but 1 by 2 salvage value, correct guys? Yes. Salvage value minus half of salvage value gives me what? Salvage value, that is plus half of salvage value. 1 minus 1 by 2 gives me plus 1 by 2, correct? This is nothing but 1 by 2 of initial investment. Or in other words, can I say this is nothing but this formula is nothing but half of initial investment plus salvage value, correct? That is nothing but, if you see in your capital employed and all, you would have seen in your accounts, average capital employed is opening plus closing by 2. This is also the same formula only, but they have just rewritten it like this: half of initial investment minus salvage value plus salvage value. Very simple. So half of salvage minus half of salvage value plus salvage value is nothing but half of salvage value, correct? So half of total investment plus half of salvage value. This is the formula that you get. That is half of initial investment plus salvage value. In this case, you tell me, what is the initial investment? 10 lakhs, correct? What is the salvage value? 80,000. 10 lakhs is the initial investment. 80,000 is the salvage value. Average of this is how much? 10 lakh plus 80,000 divided by 2. Half of this is going to be 5,40,000. That is exactly what you get here. 5,40,000 is exactly what you get here, even if you use this formula. So don't complicate it by yourself. This is nothing. In fact, this is nothing. This is average in investment and all. They have just ignored the time value of money concepts and they have done it. This is nothing but opening plus salvage value divided by 2. That is opening investment plus closing investment divided by 2. They have rewritten it like this. So in exam, can I write this formula, whatever you have mentioned? No. Please write it exactly like this. The logic, you remember it as this. Are you clear with this? Because I don't want to take any chances. This logic and all is not mentioned in the study material. I'm giving it to you. Clear? So if at all you find it difficult to remember this formula, it's very simple. Half of initial investment minus salvage value plus salvage value. If you just split and write it, you will get half of initial investment plus salvage value. That's about it, guys. Are you clear with this? So the denominator can be 5,40,000. So if this changes, obviously the answer will also change. So if you use this method, your average rate of return is going to be 17.04%. Now, sir, should I take 9.2% or 17.04%? It depends on the company. Whichever method they want to take, they can take. In exam, if the question is silent, you can take either any of the method, or if this is a 5-mark question they are asking, you better do both the methods and leave it there. Are you clear with this? That's about it. Beyond this, there is no much of relevance in this area because it ignores all the time value of money concepts, and it does basically they are calculating the average rate of return. That is average profit divided by investment. Numerator, no problem. Average profit is total profits for all the 5 years divided by 5 years. Denominator is, should you take the initial investment alone or should you take the average investment? If you take the average investment, it is nothing but half of initial investment plus salvage value. Or if you want to write it in institute's language, should write 1 by 2 the whole into initial investment minus salvage value, bracket close, plus salvage value, net off, it gives the same result. Are you clear with this? With this, we are done with this. And this ARR, average rate of return, whatever you get, you will compare with the minimum expected return. If the average rate of return is more than the minimum expected return, go for the project, else you don't go for it. As simple as that. This is the decision criteria. Are you clear with this, guys? Yes. So now you just go here and just read it. accounting rate of return, what is the decision rule? A project with a high ARR is generally accepted. So let's say there are project A, project B, project C. I have 3 projects. I need to choose between one project. Now, whichever project has the higher ARR, I will go for that project. So if you are deciding, if your investment decision is based on ARR, then you will go for that project which has a higher ARR. Are you clear with this? That is how it should be interpreted. Next, payback period. Now let's directly jump into the question and see what it is. What do you mean by a payback period? The time required to recover the initial cash outflow is called as payback period. Are you clear with this? Are you clear with this? So a project with a lower payback period is generally preferred. Sir, can you give us an example? Yes, let's go to this question. We will automatically see what it is. Very, very simple, guys. Understand things logically. Please don't ever mug it up. It's very, very simple. Now let's go to the third question. Now, calculate the payback period and discounted payback period for a project with 30,000 rupees of cash outlay and annual cash inflows of 6,000 for a period of 10 years. The discount rate is 15%. Now. Payback period is under the traditional approach, correct? Discounted payback period comes under the discounted approach. That is, if you see, there are 2 methods, correct? These are 2 different methods. If you see in the chart at the beginning, if you see payback period comes under traditional or non-discounting model under the initial phase. Then there is also something called as discounted payback period that comes under what? Discounted cash flow model. Are you clear with this? So we are going to see both. We are going to see both these methods. Now first let us see what is payback period. Related to this is only discounted payback period. That is exactly same as payback period, but in discounted payback period, you consider the time value of money concept. That's about it. What it is, we will see right now. Now, look at this. Look at this. Now, what they are mentioning. Now, a project requires an initial outflow of how much? 30,000 rupees. Correct? Now, let me just put it here. This project requires an initial outflow of how much? This project requires an initial outflow of, so the cash outflow is going to be how much? 30,000 rupees. And what have they mentioned? If you invest this 30,000 rupees every year, let's say I'm investing 30,000 rupees in purchasing this machine. Every year using this machine, yes, I will generate sales. I will also have my cost. So sales minus all the costs. So the cash flows after tax, that is depreciation, adding back all these adjustments. If you see, the net cash inflow that I get after all my expenses is 6,000 for a period of 10 years, right? So basically what they are saying, if you invest this, then for the next 10 years, 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10. For the next 10 years, you will be generating how much cash inflows? So you will be getting 6,000 rupees every year, correct? You will be getting 6,000 rupees every year. 6,000, 6,000, 6,000, 6,000, 6,000, 6,000 and 6,000, right? Now, payback period means what? Payback period refers to how much time it takes to recover my initial cash outflow. I have invested 30,000 rupees in the business, correct? How long will it take for me to get back my initial investment? See, what we will do is cumulative cash flows. So in the first year, you have got how much? 6,000 rupees. In the second year, how much you have got? 6,000. So at the end of year 2, till date, how much you have got? 6,000 plus 6,000. Can I say 12,000? Yes. At the end of year 3, how much you have got in total? 6,000 plus 6,000 plus 6,000. That is 18,000. Correct. At the end of year 4, you have got 18,000 plus another 6,000, 24,000. Right? At the end of year 5, you got how much? 24,000 plus 6,000, 30,000. Yes. So technically speaking, can I say it takes 5 years for me to get back my initial cash outflow. Are you clear with this? And this 5 years is what is called as my payback period. Payback period means what? The time that a project takes to recover my entire cash outflow. Are you clear with this? Now, you tell me, if the payback period is less, it is beneficial for me. Why? Quickly I can recover my entire cash outflow. Yes or no? So, lesser the payback period, better it is for the company. Are you clear with this? So looking at from a payback period perspective, lesser the payback period, better it is for the company. Why? Because you can get your entire amount, you can recover your entire outflow at a quicker point in time itself. Are you clear with this? Are you clear with this? Or since in this question the cash flows are equal, the cash flows can also be unequal, right? Since in this question the cash flows are equal, for equal cash flows there is a very simple formula to calculate this. So you can say that cash outflow divided by annual cash inflow, that is nothing but 30,000 rupees. So your payback period is nothing but 30,000 rupees divided by 6,000 rupees. So how long does it take? I need to recover 30,000. Every year I'm recovering 6,000 rupees, which means it takes 5 years for me to recover my entire capital. Are you clear with this? So this is a formula that you can use provided the cash flows are equal. Suppose the cash flows are unequal, then you need to use this method, that is cumulative cash flow model, and you should see when exactly the cash flow you are able to actually match it, when exactly you are able to recover your entire principal. You need to see it. Are you clear with this? So that is the first part of the question. Payback period is what? 30,000 divided by 6,000, 5 years. So which means it takes 5 years for you to recover back your entire investment. Are you clear with this? What do you mean by discounted payback period? Very simple. In this case, what we did cash flows. We just saw the cash inflows, and directly we saw how long my cash inflows will take, how long my cash flows will take to recover back my entire principal. Yes, this ignored time value of money. Correct. Here we did not consider any time value of money. 6,000 at the end of year 1 is not same as 6,000 at the end of year 2, but we just considered 6,000 everywhere and we just went across. Correct. Now in this discounted cash flow model, what we need to say is we need to discount all the cash flows. That is, all these cash inflows should be discounted. You should arrive at the present value of cash flows, and you should see how long it takes for the present value of cash flows to recover back your original investment, initial outflow. Are you clear with this? I'm repeating. Discounted payback means the period it takes for your discounted present value of cash flows to recover back your initial outflow. We will see with this particular example. In this case, discount rate is given as 15%. Discount rate is nothing but your weighted average cost of capital. So 10 years, every year you have what? Every year you have a cash flow of 6,000 rupees till the end of the 10th year. Yes. What is the present value interest factor? 15 years. Yes, you know how to compute the PV factors and all. We've seen this in the basic concepts, that is time value of money concepts. In case you have not seen it, it's being uploaded in a separate demo lecture. So please watch it. In case you do not know the basic concepts of time value of money, please watch it, because it's a lengthy discussion by itself. Since it is not a separate chapter in our study material, I have kept it as a separate video from this marathon, because if you know time value of money concepts, you need not watch it. You can directly enter into this marathon. Else you need to refer the time value of money concepts and come into this. You can just brush it up. Clear? So now, yes, there is a way in which you can calculate 1 divided by 1.15. I've given you the calculator trick and all, is equal to, you get this once again, 0.870 or 0.8695. So they have rounded off to 0.870. Once again click is equal to, you will get the second figure. Once again click is equal to, you will get the third figure, is equal to fourth figure, and so on. So the present value interest factors, you will get it. Correct? In exam, at times they might give this table itself, or if they have not given you the table, they have just given the rate, you can do it easily with your calculator. 1 divided by 1.15 is equal to first figure. Once again click the is equal to second figure. Once again is equal to third figure, and so on. Right? So what is the present value of cash flow? The relevant cash flow into the present value interest factor. So the present value of cash flows for the relevant year, so you have arrived at it. Are you clear with this? This is nothing but what? This is nothing but the cash flow, that year's cash flow multiplied by present value interest factor. So this 5220 is what? Today's value, the present value of 6,000 rupees arising at the end of year 1. 6,000 rupees at the end arising at the end of year 2 in today's value is how much? 4536. Correct? This is called as time value of money. Yes. So now what we will do? We will do cumulative present value. So at the end of year 1, how much you have earned? So till now, how much cash flow you have? 5220. Now at the end of year 2, how much you have? Till now 5220 plus that year's cash flow of 4536. So till now you have earned how much? 9756. Now at the third year, how much you extra earn? 3948. So 9756 plus 3948. Till now you've got 13,704 rupees, correct, of total cash inflows. Then 13,704 plus your 3432 gives you 17,136. So at the end of year 4 till now you have cumulative cash inflows of how much? 17,136. Then at the end of year 5, 2982 is the amount. So 17,136 plus 2982 gives you 20,188. Then plus 2572 gives you 22,710 plus 2256 gives you 24,966 plus 1962 gives you 26,928 plus 1704 gives you 28,632 plus 1482 gives you 30,144. So technically, how much you have invested? 30,000, but present value of cash flows when you are able to recover at the end of 10th year only, I am able to recover this entire amount of 30,000, or technically speaking, the discounted payback period is how much? Approximately 10 years. Look, the cumulative total of discounted cash flows after 10 years is how much? 30,144. Therefore, our discounted payback period is approximately 10 years as opposed to 5 years under simple payback period. Under simple payback period, what we said, if you invest the money of 30,000 rupees, you will get it back in 5 years. But that was done ignoring time value of money. If you consider time value of money, the discounted payback period doubles in this case. In this case, it becomes how much? It becomes 10 years. Are you clear with this? So for me to get back my original amount of 30,000 by considering my discounted cash flows, it takes me 10 years approximately. Are you clear with this? Yes. So it should be noted that as the required rate of return increases, the distortion between the simple payback and the discounted payback grows. That is, if your rate, that is if your discount rate keeps on increasing, so accordingly what will happen? Accordingly, if your discount rate is increasing, so cash flow divided by 1 plus r to the power n, correct? So if your discount rate increases, the overall value decreases, correct? Since your overall value decreases, now it takes more time for you to recover your cash inflow, or in other words, your discounted cash flow the discounted payback period will be further more. Are you clear with this? So when there is an increase in the discount rate, your discounted payback period will be more. Are you clear with this? This is what they are saying here. But just understand that payback period means what? The time it takes to recover my entire cash outflow. What do you mean by discounted payback period? The time that my discounted cash flows takes to recover my entire cash outflow. Are you clear with this? That is, the first one does not consider time value of money. The second one considers time value of money. And both the methods, you will go for that. So like this, you will compute for multiple projects or multiple machines. You will compute what the payback period and discounted payback period. So if you're going by a payback period or discounted payback period, you will go for that particular machine or that particular investment alternative that has a relatively lesser payback period or lesser discounted payback period. Why? Because lesser payback or lesser discounted payback period means what? You are able to recover your initial investment quickly itself. Are you clear with this? So payback periods, whether discounted or not discounted, always remember, lesser the better. Are you clear with this? As simple as that, guys. As simple as that, right? So now, so directly we have completed two other models in this particular area. So we have completed what? We have completed two other models, that is payback and discounted payback period. So payback is done. Discounted payback period is also done. Clear with this? Yes. Now let's go to the next few methods in your discounted cash flow methods. Let's go to the next few methods. We will see this NPV, profitability index, and IRR. What these are, we will be seeing right now. NPV, profitability index, IRR. So what are they? This is what we are going to be seeing right now. Yes, and modified in IRR is actually a rarely tested area, and it's an intricate discussion that requires a lot of reasoning and all that. So in my marathon, I'm not discussing this alone. MIRR alone, I'm not discussing. I'm not doing some relating to that. I think in the study material itself, there is only one or two some. But the main area which are important from an examination perspective, I'm going to focus on that. In fact, I'm going to do a couple of case studies relating to your NPV methods, a couple of case studies which generally students find it difficult and all. That is what we are going to focus more on from an examination perspective. Overall, this chapter also we are covering everything except MIRR. Clear with this? Yes. Now let's go to this NPV, profitability index, IRR. So what are all these things? This is what we're going to do right now. NPV method. Obviously, this method considers what? Time value of money. What do you mean by NPV? The net present value technique is a discounted cash flow method that considers the time value of money in evaluating the capital investments. The net present value method uses a specified discount rate. What is a specified discount rate? KO, correct? So when you are doing NPV, you already have a discount rate with you, correct? To bring all the subsequent cash inflows after the initial investment to the present value, correct? The time of the initial investment here is 0. So what do you mean by net present value? The present value of cash inflows minus the present value of cash outflows. Outflow is nothing but your initial investment. Are you clear with this? So what do you mean by net present value? So present value means what? Bringing everything into today's value by discounting. Why is it called as net? You are netting out your inflows with your outflow. That is why it's called as a net present value. So net present value means what? The present value of cash flows after tax minus my initial investment. Initial investment is already in today's value. It is already in present value. So because initial investment is made in T0, that is year 0, correct or not? And this NPV concept, we have already seen it. We have already seen it from a numerical perspective in this basic concepts. Right now, from an investment perspective, we will be seeing. So how will you calculate the NPV? So NPV is equal to present value of cash inflows minus initial investment, correct? Minus initial cash outflow. The initial investment is I, correct? Minus I, fine. Whereas the present value of cash inflows, how will you get it? Cash flow at the end of year 1 divided by 1 plus k to the power 1 plus cash flow at the end of year 2 divided by 1 plus k to the power 2 plus cash flow at the end of year 3 divided by 1 plus k to the power 3 and so on till cash flow at the end of year n divided by 1 plus k to the power n, correct? The life of the project will be given. So every year's cash flow you need to discount it. Now in this case for NPV, what they will do is the discount rate will be given in the question, which is generally your overall cost of capital. Are you clear with this? Why am I stressing on this? Because in IRR, we will be calculating a rate. And that rate is not a discount rate. That rate is called IRR rate. What it is, I will tell you when we are getting into IRR. But for the time being, you just understand in NPV method, the discount rate that we use is your weighted average cost of capital. Are you clear with this? Using this weighted average cost of capital, you bring all the cash flows in today's value, in present value, and net present value means present value of cash inflows minus present value of cash outflow. Your present value of cash outflow is nothing but your net initial investment. Are you clear with this? Now, if your NPV is positive, that is, if your cash inflows, the present value of cash inflow is greater than present value of cash outflow, which means NPV is positive, correct? If the NPV is positive, then it means that overall, this project, this investment avenue generates some positive return. So you can go for the project. Are you clear with this? If your present value of cash inflow is less than the present value of cash outflow, so what happens? Your NPV is in negative, which means you should never go into this project. Why? If you get into this project, there is a loss after considering the time value of money. Are you clear with this? Yes. Are you clear with this? Yes. Look at this. If the NPV is greater than or equal to 0, you can accept the proposal. If it is less than or equal to 0, you should reject the proposal. So technically speaking, this equal to should not come here also in both the places. If the NPV is greater than 0, generally you can accept it. If it is less than 0, you should reject the proposal. Are you clear with this? Are you clear with this? This is about your NPV. Are you clear with this? Now, an extension of NPV is only called as profitability index. Now, what they are saying is, this is just for representation purpose. There, NPV is what? NPV is present value of cash inflows minus present value of cash outflow, correct? Now, profitability index, this is nothing but, this is a ratio. This is present value of cash inflow divided by present value of cash outflow. Or in other words, you can say if your profitability index is greater than 1, it means what? The numerator is more than the denominator. Yes. Or in other words, inflow is more than outflow. It means that the NPV is positive. Are you clear with this? If your profitability index is less than 1, meaning what? Inflow is less than outflow or in present value, so your NPV is in negative. Or in other words, can I say, if the profitability index is greater than when 1, you can accept the proposal. If the profitability index is less than 1, you should not go for the proposal. Technically speaking, it's an extended arm of NPV method only. Are you clear with this? Yes, are you clear with this? So if it is greater than or equal to 1, accept it. If it is less than or equal to 1, reject it. Ideally here also, if it is greater than 1, accept. Less than 1, reject. That's how it generally should be. Are you clear with this? In case of mutually exclusive projects, the project with a higher profitability index should be selected. What does it mean? Let's say I have an option. I'm telling you A, B, C. Out of these 3 machines, you can only invest in one machine. Then what will you do? Let's say machine A has a profitability index of 1.2. Machine B has a profitability index of 1.4. Machine C has a profitability index of 0.9. Which machine will you choose? I will go for machine B. Now that is called as mutually exclusive. Mutually exclusive means what? You can only choose one. Suppose it is not mutually exclusive. They are saying you can choose how many ever projects you want. You can go for A, B, C or A, B, whatever you want you can take. Then I will say I will go for A as well as for B. Why? Because in both these projects, the present value of cash inflow is greater than the present value of cash outflow. So both these projects are profitable. I will go for it. Suppose they are asking me to choose only one, that means mutually exclusive. So in case of mutually exclusive decision, what I will do? I will go for that project that has a highest NPV or highest profitability index. Are you clear with this? Are you clear with this? This is about your profitability index. Next. So profitability index is nothing but sum of discounted cash inflows divided by initial outlay or the total discounted cash outflow, as the case may be. Are you clear with this? That's about it. That's about it. Next. Internal rate of return. We have seen this in depth in our basic concepts. The video is already there in our YouTube channel. Please watch it in case you do not get a hold of this IRR. This is something that we saw in our basic concepts, because the concept of IRR was also there in our cost of capital chapter and all. So that is the reason why I already did this in basic concepts, which is also uploaded in our YouTube channel, right? So now, what is your IRR, internal rate of return? What is your internal rate of return? Guys, very, very important. Remember one thing, IRR is a percentage. Clear? IRR is a percentage. It is calculated in percentage. That is what we will do is, suppose in this question, let us say, okay, so let us say this is what they had given. Okay, so 100 crores is given. Let's say, let me just take this example as a model. 1 second. Okay. Now, let us say this is the data given in the question. What is the data given in this question? They are saying this is all is given in the question, guys. Please carefully listen. Students again get confused here. So that's why I want to give you a lot of clarity on this area. This is the data given in the question. Let's say the company can invest in machine number A. Okay. If the company wants to invest in machine A, initial outflow is how much? 100 crore rupees. They need to, let's say machine A or project A, correct? It's an investment alternative, fixed asset, non-current assets, whichever way you want, you can say. Now, if I want to invest into this project, initially I will have to spend how much? 100 crores in buying the machines and all that. And at the end of year 1, it generates a cash flow after tax of 30 crores, year 2, 25 crores, year 3, 15 crores, year 4, 10 crores, and year 5, 12 crores. Clear with this? Fine. Just 1 second. Okay. So I'm just changing this cash flows. You don't worry why I've changed the figures. I'm just giving you an example, right? So let's say if I want to invest in this machinery, beginning in today I need to invest 100 crores. If I pay 100 crores and buy this machine, using this machine, I will be able to generate the following cash inflows. That is 40 crores at the end of year 1, 38 at the end of year 2, 35 at the end of year 3, 20 at the end of year 4, and 15 at the end of year 5. Let's say these are the cash inflows that I will be able to generate. Now you tell me, what is the return that I am able to get out of this particular project? That is, what is the return, net return? How much am I earning from this particular machine? If I invest 100 crores today and get this following cash flows, technically, what is the return that I am getting out of this project? This return calculation is only called as IRR. Are you clear with this? Or in other words, outflow is given, inflow is also given. Calculating R is called as, calculating the discount rate is called as what? It is called as your IRR. Now let me just give you a small example. Let's say you have invested 100 rupees today, right? Yes, you have put it in an FD. At the end of year 1, you get how much? Let us say 110 rupees. They pay along with the interest. Now tell me, what is your so what is going to be your return in this case? Now what is going to be your return in this case? Now can I say it's very simple. What is the big deal, sir? 100 into 1 plus r the whole power 1 is equal to 110. They have paid some interest, we know that, correct? They have paid some interest, or in other words, 100 into 1 plus r the whole power 1 is equal to 110, correct? Or can I say 1 plus r the whole power 1 is equal to 110 divided by 100, correct? Or in other words, 1 plus r the whole power 1 is only 1 is equal to, can I say 1.10? Or can we say guys, can we say r is equal to 1.10 minus 1? So r is equal to 0.10 or 10%, correct or not? Yes. Now a simple, so forget this IRR for the time being. Simply I'm just saying you invested 100 rupees on an FD. At the end of year 1, you got 110 rupees. What is the return? This is simple. One cash outflow, one cash inflow. Directly you can use the simple interest, the compound interest formula you can use and directly find the R value, correct or not? So we just said 100 to 1 plus R the whole power 1 is equal to is equal to what? Is equal to your is equal to 110, correct? Or in other words, can I say 1 plus r the whole power 1 is equal to 110 by 100? Or in other words, if you do this, you get the net return as 10%, correct or not? Yes. Or in other words, what we are doing here, in other words, what we did here, so basically for us to find this out, what we did, for us to find this out, what we are doing, we just did 100 into 1 plus r the whole power 1 is equal to 110. We equated the cash inflow with the cash outflow, correct? Or can we say 100 is equal to 110 divided by 1 plus r the whole power 1? This is what we did. Or in other words, can I also say the rate that equates my present value of cash inflow with my present value of cash outflow is called as IRR. Are you clear with this? So basically, inflow outflow is all given. The balancing figure is R. That alone we need to find. Or in other words, can we say the net rate of return that I get is nothing but the rate that exactly equates my present value of cash inflow with my present value of cash outflow. Or you can say present value of cash outflow with my present value of cash outflow. Present value of cash outflow with my present value of cash inflow is called as IRR, correct or not? Yes. Now, in this case, it was a very simple calculation. Why? Only one cash inflow, one cash outflow. That's about it. Whereas here, there is one cash outflow followed by a series of cash inflow. Yes or no? Now, in this case, there is no formula method and all. There is no method to calculate. There is actually no formula to calculate IRR till date. Are you clear with this? So then how will we calculate, sir? By using trial and error method. So what we will have to do is, so what do you mean by IRR? IRR is the rate that equates my present value of cash inflow with my present value of cash outflow, correct? So present value of cash inflow should be equal to my present value of cash outflow when the rate is IRR rate. Are you clear with this? Now, in this example, you tell me, what is my present value of cash outflow? 100 crore rupees, correct? Guys, actually, I've done all these things, the basic concepts, still I'm just touching it upon once again. this should be equal to the present value of cash outflow. So since this is an investment decisions, there is an initial outflow followed by a series of cash inflow. Are you clear with this? Yes. So initially, how much I spent? 100 crores was the inflow. Sorry, 100 crores was the outflow. I had to shell out 100 crore rupees in purchasing this equipment, followed by a series of cash inflow. I get 40, 38, 35, 20, 15 respectively. Yes. Can I add it as such? No. I need to convert, I need to discount everything into present value. So how will I do it? Can I say this is equal to 40 divided by 1 plus r to the power 1 plus what is the second year's cash flow? 38. 38 divided by 1 plus r to the power 2 plus what is the third year cash flow? 35. 35 divided by 1 plus r to the power 3 plus, can I say this is 20? 20 divided by 1 plus r to the power 4 plus finally you have 15 crores. 15 divided by 1 plus r to the power 5. Yes or no? Or in other words, can I say the rate that equates my present value of cash outflow with my present value of cash inflow is called as IRR. Yes or no? Now, one more additional thing I'm saying. Now, can I say if I take this present value of cash outflow to this other side, so can I say 0 is equal to present value of cash inflow minus present value of cash outflow, correct or not? So if your rate at your IRR, your present value of cash outflow will be equal to your present value of cash inflow. Yes, that is the rate that equates my inflow with my outflow is only called as IRR, correct? Or in other words, can I say at IRR, my present value of cash inflow minus present value of cash outflow will be equal to 0, correct? Now, present value of cash inflow minus present value of cash outflow is popularly called as NPV. Yes, guys. Or in other words, can I say IRR is the discount rate that makes my NPV equal to 0. So, can we say 0 is equal to 40 divided by 1 plus r to the power 1 plus 38 divided by 1 plus r to the power 2 plus 35 divided by 1 plus r to the power 3 plus 20 divided by 1 plus r to the power 4 plus 15 divided by 1 plus r to the power 5. This is the present value of cash inflows minus 100 crores, minus 100. Are you clear with this? So the present value of cash inflow minus present value of cash outflow gives you your NPV, or in other words, NPV is the rate that makes my IRR, I'm coming again. So your IRR is the rate that makes your NPV equal to 0. Are you clear with this? Are you clear with this? So now, sir, how will we calculate? How can we find this IRR? So you said there is no formula. You need to do some trial and error method only. How will you do it? What the first assumption, just an example. Let R is equal to 10%. You substitute it in the equation and see if you are getting exactly equal to 0. Let us say you are getting some positive figure, it is not 0. Then what you need to do? So now you need to take a second trial. So you will take the second trial as, let's say, 12% or 15%, as the case may be. You can take any figure. So you will get one negative IRR. Correct? You will get a negative NPV, right? So you clearly know that. So for a positive NPV, if you take your discount rate as 10%, you are getting a positive NPV. If you get a 12% discount rate, it is negative NPV. So basically, your IRR lies somewhere in between what? 10% and 12%. You do that interpolation. What is that interpolation? That formula is only given here. Lower rate, that is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Or in other words, what we do is we take this as the base, 10%, just an example, 10%, this is the lower rate, plus NPV at the lower rate. So for 10%, whatever is the NPV, this positive figure you will write down, correct? Now divided by what is the NPV that you require? So you have a positive NPV here. You want to make this as 0. Are you clear with this? So what we do here is NPV at the lower rate minus NPV at the higher rate. That is the difference between these two we take. correct, the difference between these two figures, these two NPVs we take, correct, into high rate minus low rate. This is what we get. This is what we get for the difference between these two rates, 12 minus 10, 2. Then how much should we get? How much should we get to make this difference of lower rate? This is what is called as interpolation. So for this figure, how much should be the extra discount rate that we need to get? So that is the formula. Logically, we have seen all these things in our IRR detailed explanation with numerical problems we have seen. So lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. None of this needs to be mugged up. Are you clear with this? Now, let's say, for example, now this 10%, 12% or not. Sir, how will I know to take 10% or how will I know to take 12%? It need not be between this. If you first take 1%, say you take 15%, see whether you get a positive NPV or negative NPV. Sir, I'm getting a positive NPV, which means what? Which means what? If you're getting a positive NPV, which means if you now need to reduce, if you're getting a positive NPV, what you now need to do, you need to bring down the overall NPV to 0. So you increase your denominator. If you increase your discount rate, so it will be your overall NPV will reduce. So the next trial you take above whatever you have taken in the first trial. Are you clear with this? But make sure that one trial gives you a positive NPV, one trial gives you a negative NPV, and using the interpolation technique, you can find your exact IRR. Sir, in real life, is it so difficult to calculate IRR? No. In a click of a button, you can just calculate IRR using various various softwares. The basic software that you can use is even spreadsheet, your Excel spreadsheet. So equal to XIRR, and if you just put the figures, it will automatically come. There are so many softwares. We just key in, basically, if you just enter all the cash flows, the end of relevant years, automatically calculate IRR. If you just one click of a button, it will calculate. But for examination purpose, since they want to test you on the concept, they are asking you for trial and error method. But understand, in real life, IRR calculation is very simple because there are a lot of softwares that can compute this in a fraction of a second. Are you clear with this? And this entire IRR, how to calculate this and all, we have seen it in our basic concepts, chapter. In case you have not seen it, in case this particular area you are finding it difficult, I would suggest that you please watch the IRR video in the basic concepts, so that it's a separate video that's been uploaded. So please ensure that you watch it in case you have an issue with this particular IRR understanding, because I have made a separate video on this. It's a very elaborate discussion. So I would suggest that in case you are finding it difficult to follow this IRR area, you go to that video, watch it and come back. Are you clear with this? Yes. So with this is what is called as IRR, and we have computed the internal rate of return. Basically, what do you mean by IRR? IRR is nothing but you are calculating the return on investment. So return on investment is easy only, no sir? Yes. It is very easy to calculate return upon investment, correct? But provided there is only one cash flow, you have multiple cash flows, then you need to do it only like this. So technically, IRR in this chapter represents what? What is the net amount of return that I get for the investment that I have made? Are you clear with this? Now this is called as IRR. Yes. Now be very, very clear. IRR is the rate that makes my NPV 0, correct? Whereas NPV calculation is generally done by taking your discount, R as discount rate. Discount rate is what? Their weighted average cost of capital. Yes or no? So always remember, NPV is calculated by taking R as what? Discount rate. That is your weighted average cost of capital. Whereas this particular question, this particular area, IRR, the question itself is about calculating the discount rate. The discount rate, IRR, is nothing but the rate that makes my NPV equal to 0. That is called as my IRR. Are you clear with this? So there are two discount rates in this chapter. One is called as weighted average cost of capital, which is the relevant discount rate used for computing your NPV. Whereas IRR calculation itself is a calculation of the rate that makes my NPV equal to 0. Are you clear with this, guys? Are you clear with this? So basically, IRR is the rate that makes my present value of cash inflows equal to my present value of cash outflows. Now you tell me, IRR is nothing but the net return that is generated out of my investment, correct? Now, sir, why is IRR useful? Guys, very, very simple. Now look at this. I know that if I raise funds, there is something called as cost of capital, KO, correct? And if I invest these funds here in various investments, I know the net return that it generates, IRR, Very simple. If your IRR is greater than your weighted average cost of capital, you can go for the project. If your IRR is less than your weighted average cost of capital, then you should not go for the project. Very simple, guys. Yes, are you clear with this? That is what they have mentioned here. If your IRR is greater than or equal to the cutoff rate, popularly known as WACC, accept the proposal. If it is lesser than the cutoff rate, then reject the proposal. Are you clear with this? Are you clear with this? This is all the story about your IRR. How to compute IRR, we have already seen in basic concepts. I just gave you a bird's eye view here. If you are not clear with it, please watch the basic concepts video separately. That is separately there in our channel. But this one, are you able to understand how this IRR is related to our investment decisions? Are you clear with this? So with IRR, what will I do, sir? Compare it with the weighted average cost of capital. IRR is your return. Weighted average cost of capital is your cost. It is a cost used for raising my finance. IRR is nothing but the return that I generate by investing the finance. So if my return is more than cost, I will go for it. Or in other words, IRR greater than WACC, go for the proposal. IRR less than WACC, don't go for proposal. Are you clear with this? As simple as that, guys. It's very, very simple. Clear? So what is NPV? NPV is nothing but present value of cash inflows minus present value of cash outflows. How will you arrive at the present value? By using the discount rate as your weighted average cost of capital. Here IRR has no role to play. Are you clear with this? The discount rate is your weighted average cost of capital. Then what is your profitability index? Your present value of inflow divided by present value of outflow. So basically, if it is greater than 1, you will accept. If it is less than 1, you will not accept the proposal. And IRR is the rate that equates your present value of cash inflow with your present value of cash outflow. Or in other words, IRR is a rate that makes my NPV equal to 0. So what is the decision criteria here? If your IRR is greater than WACC, go for the proposal. IRR less than WACC, don't go for the proposal. Are you clear with this? These are the 3 things that I wanted to tell you. Now there is a very interesting question given in the study material. So I want to explain this question. So let's quickly get into this particular question. This question is about missing figures. Missing figures using the concept of IRR, NPV, cost of capital, profitability index or not. So now this is nothing more than testing how well you know this particular concept. Are you clear with this? So let's get started into this area right away. The following data is available for a capital project. Annual cash inflows. Every year it generates cash inflows of how much? 1 lakh rupees. Useful life 4 years. Salvage value at the end of the project 0. IRR is given as 12%. Guys, be very clear. I told you IRR is different. Your cost of capital, discount rate is different. Clear? IRR is 12%. PI means what? Profitability index is 1.064. You are required to calculate the following: cost of the project, cost of capital, net present value, and payback period. They are not asking you for discounted payback, just a payback period. Are you clear with this? These are the missing figures. Now, what I would suggest is pause this video right now. Take a rough notebook. Try to crack this by yourself. Don't look at the solution. Try to crack this by yourself. It's an institute study material question. Now, if I am an examiner, I would be interested in testing you this question for a simple reason. I'll tell you the open reason why I would be, if I put myself in the shoes of an examiner, I would be interested to pick this question because single question tests you on concepts of IRR, NPV, cost of capital, profitability index. Sir, here many things are given already. You will at least know how to use it. You should know how to use it. Don't think all questions are computation driven. Certain questions are also logic driven. In fact, most questions are logic driven. You should know what to use, how to use this data and arrive at the missing figures. Very, very important. Are you clear with this? So now let's get started. So in case you're still not aware of this particular question, please pause it right now and try to crack this question by yourself and then check the answers. Now, what have they given? PV factors also they have given. Look, 12%, 11%, 10%, 9%. They have given the PV factors also. Right. So now let's see how to do this particular question. Now, what have they given? What have they given? Guys, where do we start with it? They have given that annual cash flows are how much? 12%. They have also given IRR is 12%. Life is 4 years. Can I say? Now. IRR is the rate that equates my present value of cash outflow with my present value of cash inflow. Yes or no? Yes. Now, what is my present value of cash inflow? Every year, I am having 1 lakh. 1 lakh equal amount. So, can I say 1 lakh into present value interest factor annuity of 4 years at the rate 12%? Yes or no? So can I say the initial cash outflow is equal to my present value of cash inflow? Yes. Present value of cash inflow is nothing but annual cash flow. Since it is equal, I can use the annuity table into present value interest factor of annuity of 4% for 12 years. Yes, guys. Now they have given 12 years, they have given the discount present value table. So if I add these four, I will get the present value interest factor of annuity. Yes or no? So can I say annual cash inflows is 1 lakh? Yes. So considering the discount factor of 12%, the present value interest factor of annuity of 4 years for 12% is going to be how much? 0.893 plus 0.797 plus 0.712 plus 0.636. It gives you a total of how much? 3.038. Guys, these are all time value of money concepts, correct? So 3.038, correct? So basically it's nothing but 1 lakh into 3.308. So the sum total of the cash inflows is going to be how much? 3 lakh 3,800, correct? And at IRR, your cash inflow is equal to your cash outflow. So basically your cash outflow, or in other words, the project cost is how much? 3,03,800. Are you clear with this? This is how you need to do this particular question. So first they had asked for what? Cash. They have asked for the cost of the project. They had given the annual cash flows. They have given the IRR rate. What do you need to do? The present value of cash inflows using the IRR rate will be equal to my present value of cash outflow. Present value of cash outflow is nothing but the cost of the project. Are you clear with this? Cost of the project. That is the only cash outflow I have. Yes or no? So you just need to take 1 lakh into present value interest factor of annuity of 4% for 12 years and you will get this answer. Guys, that's simple it is, provided you know how to apply it. Next, calculate what? Calculate the cost of capital. You should calculate what? Cost of capital. Now, how can we calculate cost of capital? We should use profitability index. Now, profitability index is equal to what? Present value of cash inflows divided by present value of cash outflows. Now, remember guys, for profitability index and NPV, the present value of all the cash flows should be done at what? It should be done at the discount rate here should be what? Your cost of capital. And we need to calculate that only right now. So don't consider 12% for this, because 12% is your IRR. That makes your NPV equal to 0. Are you clear with this? Here we are only going to we are going to compute the discount rate only right now. The discount rate is the weighted average cost of capital that is used for your NPV and profitability index calculation. Now what is your profitability index? 1.064 is equal to present value of cash inflow divided by what is the present value of cash outflow? That is the project. What is the project cost? We just got the project cost as 3,03,800. Yes, guys. Divided by 3,03,800. Yes or no? Or in other words, can I say, present value of cash inflow is equal to, just cross multiply 3,03,800 multiplied by 1.064. So how much do you get? 3,03,800 into 1.064. So how much do you get, guys? So 1 second. So 3,03,800 into 1.064. You get how much? You get 32 lakh. 1 second. I'm sorry. 3,03,800 into 1.064. That gives you, yes, 3,23,243.2 approximately. Correct? So this gives you 3,23,243.2 approximately. Yes, guys. Or can I say the present value of cash inflows is equal to 3,23,243. Yes, guys. Present value of cash inflows, how will you get? It is nothing but 1 lakh rupees. Every year there is 1 lakh rupees into present value interest factor annuity of X percentage. I don't know how much the percentage. That's what I need to calculate. For how many years? For 4 years is equal to 3,23,243. Yes. Or can I say present value interest factor of annuity for X percentage 4 years is going to be how much? 3 lakhs divided by 1 lakh. So can I say this is 3.23243. Yes, guys. So now what you need to do in this table, you should go and see if you add up at what rate it becomes 3.23423. Yes. At what rate? 3.23. So at 3.232, at what rate it becomes? When your R is 9%. So you calculate R 9%, you sum total of this. Since it's an annuity table, you are sum totaling this. 0.917 plus 0.842 plus 0.772 plus 0.708. How much is that? 3.239. Are you clear with this? So 3.239 approximately, you are getting it here. So can we say that here the relevant discount rate x at the rate of 4%, x percentage is how much? 9%. So now can I say the cost of capital is how much? 9%. Are you clear with this? Are you clear with this? So what we did, we started with profitability index. What is profitability index? Present value of cash inflows divided by present value of cash outflows. You have the profitability index, you have the present value of cash outflow. So the balancing figure is how much? Present is what? That is your present value of cash inflow, correct? So my present value of cash inflow is this. So present value of cash inflow is nothing but my annual cash flow into present value interest factor annuity of x percentage into 4 years. This x percentage is only my cost of capital percentage. Why? Because profitability index and NPV and all is calculated only using my weighted average cost of capital. This is different from my IRR, correct? So this is going to be how much? This is going to be 9%. Guys, are you clear with this? Is everyone clear with this? So technically, if you see in this question, what is cost of capital? 9%. Yes. Now just a small understanding. So your cost of capital, weighted average cost of capital is how much? 9%. Correct? That is, you have borrowed, you have raised funds by paying 9% and you are investing it in projects that is generating how much? 12%. So that's why you can go for the proposal or not. Yes, that is the reason why this profitability index is also showing 1 point something. It is greater than 1. Why greater than 1? Because the present value of cash inflow is greater than my present value of cash outflow. That is the reason why you are actually showing what? You are showing actually a profitability index of more than 1. Why is it more than 1? Because my IRR is greater than my cost of capital. Guys, are you able to connect the dots here? Are you able to connect the dots? It's as simple as that. Simple finance, if you just know it logically, you will be able to apply it. Then net present value, very simple. Present value of cash inflow minus present value of cash outflow. We just calculated the present value of cash inflow using the weighted average cost of capital. So 3,23,243, correct? So 3,23,243. Look at this, 3,23,243.2 minus 3,03,800. Present value of cash outflows, the cost of project. So it's going to be how much? Positive. NPV showing positive 19,443. Why NPV showing positive? Obviously because my IRR is greater than my weighted average cost of capital, correct? Since my IRR is greater than my weighted average cost of capital, what happens? My NPV is actually greater than 0. Yes, guys, or in other words, my profitability index is greater than 1. Why? In the numerator you have inflows, present value inflows. In the denominator you have present value outflows. If your present value of inflows is greater than the outflows, only then it will be greater than 1. Guys, are you able to connect all these three things together? Your IRR, NPV, profitability index, these are all some interrelated things. Students think these are some different things that we need to know. No. This is like a chain which you need to understand together. Are you clear with this? Because my IRR is greater than my weighted average cost of capital, it makes my NPV greater than 0, which makes my profitability index greater than 1. Are you clear with this? So suppose my IRR is equal to my weighted average cost of capital. Suppose my IRR is equal to my weighted average cost of capital. So basically what happens in this case? So it is an indifference thing. So whatever is the return that you make out of your investment, exactly that you need to pay to your sources of finance. So basically it doesn't generate you any revenue at all. Or in other words, this makes your NPV exactly equal to 0. This makes your NPV exactly equal to 0. Yes, guys, are you clear with this? That is your IRR and WACC. If you are equating it, that is, if these two are coincidentally equal, this is what will happen. But that is not the subject matter of study here. Understand always, if IRR is greater than WACC, it generally means that your NPV is greater than 0, which makes your profitability index greater than 1. Understand the link between all these formulas. Are you clear with this? Yes. And finally, they had asked for payback period. So payback period is very simple. Payback period or discounted payback? Only payback period. So which means what? So I need to, how much time it will take for me to recover my entire investment? Very simple. What is the total investment? It's going to be What is the total investment? It's going to be 3,03,800 divided by 1 lakh, equal cash flows only. So you will not put the cumulative table and all. So it takes 3.038 years to recover your entire cash flow. Sir, can years be in decimals? Yes. So basically there's nothing but 0.038 years into 365. We do, it's actually 13.87 days. Approximately, this is nothing but 3 years and 13 days. That is the meaning of this. Are you clear with this? That's why they put it as decimals. Yes, you can keep it in decimals. Don't round it off. Are you clear with this, guys? So approximately it takes 3 years and 13 days to recover my entire investment. This is the meaning of payback period. Guys, are you able to get the clarity? It is as simple as that. Are you clear with this? So we have seen all the methods right now. Now let's go to 2 problems which are exclusively case study types. Now these are some interesting questions which I feel are typically the exam type of problems that you can be tested. So let's go to question number 5 right now. Let's go to question number 5. Capital budgeting with working capital. Now this is a question which many students find difficult because they are not able to understand the question itself. Now guys, understand one thing. There is nothing new that we are going to study in this particular question. Understand that this is nothing more than applying the facts given in the question with whatever data we have studied till now. Are you clear with this? There is no rocket science that we are going to generate here. Whatever we have studied, we are just going to apply that with the relevant facts given in the question. Of course, one thing extra that we are going to see is something related to working capital, which ideally you will also get clarity once we do that working capital chapter revision. But anyways, it can be done right now, so that shouldn't be a problem at all. So if you see this question first, don't fear, because in my past interaction with students, they generally feel that if this big sum comes in, it is very difficult. It is very difficult to crack. Guys, I'm telling you, these are all some easy questions, provided the first thing is you should not have the fear when you read this question. Oh my God, this is a big question. So how am I going to crack it? No, throw the fear off. First, you read it. You logically think. You need not be a finance expert to crack this question. Logically, you think. I will explain word by word logically. You will see how easy these questions are. Clear? Fine. So let us do this question. Have the patience. Read it along with me. Follow my instructions. Trust me, automatically you will be able to crack these kind of questions. These kind of questions are typically can be tested for 10 marks, guys. And this chapter time and again gets tested for 10 marks. Every attempt, it gets tested for 10 marks. Almost every attempt. Remember, this is 10 out of 60 marks currently in the old syllabus. In the new syllabus, it's going to be 50 marks total. Out of the 10 marks, generally this chapter never gets missed out. Reason, it's a very important chapter. This chapter is also there in your CA final. In AFM, Advanced Financial Management, this chapter is as such there in your final, but of course with certain incremental learnings we will be having, but for that the base is going to be the same. So remember, this is a very important chapter for your entire CA career. Are you clear with this? At least till the time you finish your CA, you need this chapter for sure. Are you clear with this? Yes. Now let me just read this question out for you. Please do not have any kind of aversion against this chapter or this type of questions. Have an open mind. I'm saying this again and again because I have seen students who just cribble about this particular question. These kind of questions, like big questions, they are giving some case scenarios, they are giving, and they are doing some complex calculation. What is this? We don't even understand. Patiently, you just listen. I'll tell you, every single thing is logical. Now, a large profit-making company is considering a machine to process the waste produced by one of its existing manufacturer process to be converted into a marketable product. Wait, what they are saying? A company is that a large profit-making company. Yes, what they want to do is considering to install a machine to process the waste produced by one of its existing manufacturing process to be converted into a marketable product. Now, let me just give you an example. Now, guys, if you have seen in this cosmetic products like Fair and Lovely or your Fiamma de Ville and all these L'Oreal, the face wash and all that, what they generally show is there will be a model and they will show some real fruits and all. They will show papaya extract and all. They will show the real fruits and they will say that this cream or whatever thing that they are selling is made of the real fruits and all. They will say like that. Yes, but technically speaking, you know what happens? So if they are showing orange pulp, they will definitely use, but more than the orange pulp, they will use what? They will use that orange peels and all. That is the outer shell of that orange. Now, don't think that it is bad. It is good only. Don't worry. But what I am saying is, in these advertisements, they show more of that orange pulp and they say we have made it using orange or we have made it using papaya and all. But actually what they do, I'll tell you. Yes, they also use some extracts. I'm not denying it. You know, these companies like Tropicana, these companies that manufactures juice, what they do is they actually enter the juice. I mean, they enter the vegetables or they enter the fruits in the typically fruits, correct? There are also a few vegetables on the basis of which juices are made, but let's not talk about that. Generally, they actually input the juice, they input the fruits into the process, correct? And the processing happens, and then fresh juice comes as an output, and then this particular peels and all the leftover waste comes out as an output, correct or not? This also comes out on the other side, yes or no? So typically these kind of companies, just imagine they manufacture mango juice, papaya juice, whatever it is. Input is fruits, yet their output, their main output is juice, correct? But coincidentally, something else also comes out that is nothing but all these waste. Waste as from their viewpoint, it is a waste. Clear? Don't think it's waste means it is not a usable product. So some papaya peels or some pulp, leftover pulp and all will be there. Now, all these pulp and all these things is there, no? Correct? What these guys do, they do some further processing. Slightly, they just process it and they sell this who? Tropicana. All their leftover waste. From their viewpoint, it's a waste. Again and again, I'm telling you, waste, don't take it as such. From their viewpoint, it's a waste. And that waste, they sell it to all these companies like Pond's, Fiamma Devils and all these companies. Are you clear with this? Cosmetic industry. Are you clear with this? So advertisement, they show real papaya. What goes inside, I just told you. Right now, you decide. Now, coming back, I just took example of a few companies, guys. Nothing against these companies. Again, please don't make a big issue about it. I'm just telling you an example with reasoning. Now, what happens? Currently, what Tropicana is doing is, whatever is the waste that they are getting, all the fruit peel and all, they are throwing it away. Right? Now, for throwing it away, what happens? They are incurring some cost and all. Now, this company Tropicana is thinking that look, there is a ready market for us. If we slightly process this waste, we can sell it to this cosmetics guys. Are you clear with this? That is the thought process of this company. Now you read it. A large profit-making company is considering installation of a machine, new machine. What? To process the waste produced by one of its existing manufacturing process. Existing manufacturing processes, the juice manufacturing process. It generates what waste? That waste is only your fruit peels and the leftovers. Clear? This can be converted into a marketable product. At present, the waste is removed by a contractor for disposal on payment by the company of 150 lakh rupees per annum for the next 4 years. So what they are doing? Currently, the company is throwing away all the peels. By hiring a contractor, you don't think it will be this much amount of peel. See, in your house, if you cut fruits and vegetables itself, you have this much amount of wastage left over, right? Now, just imagine a company which is into this business of manufacturing juices. They have a lot of waste. If from their viewpoint, they can't use it further, it has to be disposed of. So they are saying every year they incur 150 lakhs to just dispose of. No revenue from this. They are just disposing it off. Are you clear with this? Currently, the company is treating this as a waste and they are disposing it off by spending 150 lakh per annum. They have entered into a contract with an outside contractor for the next 4 years. Now, suppose this waste, if it can be processed and converted into a marketable product, now it need not be disposed of, correct? I can cancel this contractor and this contractor can be terminated upon upon installation of the aforesaid machine on payment of a compensation of 90 lakh rupees before processing operation starts. So what they are saying, now currently we have already entered into a 4-year contract with a operator, with a particular contractor. What is a contract? He has to come and remove all the, dispose of all the waste, and he should take up all the waste and throw it away. Correct? For him, I will pay 150 lakhs per annum. It's a contract already done. Suppose I don't want to dispose it, but I want to convert it into a marketable product. Then I should cancel my contract with this particular contractor. He's saying if you want to cancel it, you need to pay a penalty of 90 lakh rupees. If cancelled, pay a penalty of 90 lakh rupees so that for the next 4 years, I will not trouble you. So all this 150 lakhs per annum and all, you need not pay. Are you clear with this? So if I wish to go for this, converting this waste into a marketable product, what I need to do, I need to incur additionally 90 lakh rupees. I need to pay to this contractor and say, wait, I had entered into your contract by mistake. Now I have changed my mind. I want to convert it into a marketable product. So I don't need your disposal services. So what I will do is I will pay this 90 lakhs as a penalty upfront. Are you clear with this? And this compensation is not allowed as a deduction for tax purposes. Clear? Next, the machine required for carrying out the processing will cost 600 lakhs. Now, if I want to process this waste into a marketable product, I need to buy a new machine exclusively for this. Correct? That will cost one-time investment 600 lakh rupees. At the end of the 4th year, the machine can be sold for 60 lakh rupees, salvage value. And the cost of dismantling and removing will be 45 lakh rupees. That is, at that time, if I want to dispose of this machine, I will have to incur 45 lakh rupees. Are you clear with this? These are the details relating to the machine that I'm going to buy newly if I want to take up this further processing of wastage. Clear? So what are the costs? Initial 600 lakhs, correct? At the end of the 4th year, salvage value is 60 lakhs, but wait, the cost of dismantling will be 45 lakhs. So basically net off, you will get how much? 15 lakhs of cash inflow you can generate at the end of year 4 at the time of selling it off, scrapping it off. Clear? Now, the sales and direct costs of the product emerging from the waste processing for 4 years are estimated as under. So what they are saying, so now this project can have a useful life of 4 years, correct? It's a project. Fine. Now, if I use all these machines and with this machine, if I'm looking at this business proposal, year-wise, how much is the sale is given. Year-wise, how much material consumption is required, how much wages is required, how much other expenses is required, how much factory overhead is required, and how much is the depreciation computed as per income tax rule. Year-wise, these data are given below. Are you clear with this? So why have they given all these things? Yes, with this only we can compute the cash flows and all, correct? So sales, I need to take minus the material consumption, wages and all these costs, other expenses and all. Look at this, factory overheads is given and then depreciation is also given. Year-wise data is given. Clear with this, guys? Yes. Now, one more para they have given. Initial stock of materials required before commencement of the processing operation is 60 lakhs at the start of year 1. The stock levels of materials to be maintained at the end of year 1, 2 and 3 would be 165 lakhs. And the stock at the end of year 4 will be nil. Now, first, this particular line item, let us see. This is the important line item because many students get it wrong only here. Now, this is where I said this chapter is relating to your working capital management. Correct? We will be seeing details about the working capital management chapter in the next revision. Don't worry about it. It is an upcoming thing. We will be doing it in the next lesson. But right now, understand what is this. First of all, you should understand these are not costs. These are cash flows. Remember this, they are not cost, they are cash flow. So what you are saying now, every year, what is the material consumed is given 90, 120, 255, 255, it's given. That is year wise, raw material cost is already given by them. Correct, guys? That is not a problem here. Look what they are saying. Initial stock of materials required before commencement is 60 at the start of year 1, and the stock levels to be maintained at the end of year 1, 2 and 3 will be what? Will be 165 lakhs. Now what they are saying, guys, patiently listen. Year 1, 2, 3, 4. Opening stock, closing stock. Raw material consumed, that is only my cost required to calculate my cash flows, every year cash flow. Look at this here, they are talking about the stocks. What they are saying, initial stock of material, that is at the beginning, T0 itself. This is T1, year 1's opening stock. Generally, this is nothing but T0, correct or not? Today itself, I need to have a stock of how much? 60 lakh rupees. Guys, please understand this. I need to bring in stock worth 60 lakh rupees, correct? But during the year, I will be purchasing and I will be utilizing 90 lakhs. Don't worry, but I should definitely have my stock policy stays. I need to have an opening stock of 60 at the beginning. And look at this, the stock levels to be maintained at the end of year 1, 2, 3 will be 165. Now, my closing stock should be 165. Correct, guys? Correct? Yes. Now my closing stock should be 165. Yes or no? Yes or no? Now I have already brought in stocks worth 60 rupees. Correct? Now extra how much I should bring to maintain 165 rupees of closing stock? I should bring in 105 lakhs at the end of year one. Why? Because they have given that the company's stock policy is such that they need to maintain a stock of this is what, 165, right? So 105. So they should maintain an overall stock of 165 at the end of year one. Or can we put it like this? So what they have mentioned, here, guys, a very interesting adjustment. In my opinion, this is a very, very good adjustment, and this is a likely exam question. So please focus on this. This is the certain type of question that can be tested for your exam. So look at this: year 0, year 1, year 2, year 3, year 4. Correct? What are they saying about the stock policy? What are they saying about the stock policy? Now, at present, you should bring in 60 lakh rupees worth of stock. Correct? Now, at the end of year 1, year 2 and year 3, the closing stock should be 165, 165, 165 respectively. This is what they had mentioned. At the end of year 1, 2, 3, the stocks will be 165, and stocks at the end of year 4 will be nil. At the end of year 4, it will be 0. Now, what they are saying, so year 0, that is at the beginning itself, you bring in 60 lakhs. Correct? So at the end of year 1, how much you should bring to make the stock 165? You should bring how much? 105 lakhs extra rupees. Correct or not? Yes, 60 plus 105. Now you have a closing stock of 165. Yes. Now you already have a stock of 165. At the year 2, you should bring anything? No, I did not bring anything. Why? I already have 165. The closing stock will be 165. At the year end 3, should I bring in anything? No, it is already 165. I have already introduced 165 rupees worth of stock. Yes. At the end of year 4, what happens? Remember, working capital is a cycle. Amount that got invested initially will come back. It will get released at the end of the life of the project. Or in other words, here it is an investment. I need to bring this working capital at the end of year 4. This amount of 165 lakhs will be released from my system. How is that it will be released? At the end of the project, what I do, whatever stock I have, I will just sell it off and I will realize cash. Correct, guys? Yes. So I invested money to have these stocks, and at the end of the period, I just sold these stock and realized money. So initially, when I brought in the stock, it was a cash outflow, and when I'm just selling it off and realizing money, it is a cash inflow. Yes or no? Always remember, till now what we have done, the only investments, the cash outflow that we have seen is our capital investment. Remember that there can also be working capital investments in the working business cycle. Are you clear with this? In the life of the project, apart from my capital expenditure investments, there can also be working capital investments. The only difference between the two is working capital investments will actually be an outflow initially, and it will be an inflow at the end of the project. So if I am an examiner, I wouldn't have given this word. And the stock at the end of, so I would have given this stock at the end of year 4 will be nil. Yes, I need not have given this out at all. Why? Because at the end of the project life is over. Now, what are you going to do with the stocks? You will sell it off and realize money. Are you clear with this? So even if this is not given, you should know that. At the end of the life of the project, what happens is the entire value of your working capital gets released from the system. Are you clear with this? Gets released from your cycle, gets released from your project. Are you clear with this? So with respect to working capital inventory, I will say at T0 outflow 60 lakhs, T1 end of year 1 105 lakh, 2, 3 nil, no cash outflows. At the end of year 4, I get a positive 165 lakh rupees. Are you clear with this? This is not a cost because material related cost is already taken into account here. So then this 90, 120, 255, 251 and all, what is this, sir? Apart from the stocks, they themselves have given, they have not given material purchased, they have given material consumed. So basically they have purchased and consumed 90 in year 1, 120 in year 2, 255 in year 3 and 255 in year 4. Purchase, consume. That has been done parallelly. Apart from that, they are maintaining the stocks. Are you clear with this? That is the understanding that you need to make. Are you clear with this then? The storage of material will utilize the space which would otherwise be rented out for 30 lakh rupees per annum. The second one. What they are saying, suppose I wish to process this waste and convert it into a marketable product. What I'm doing is, look, if I'm not converting this waste and all into a marketable product, then this place would have been empty, correct? And I could have rented it out and generated 30 lakh rupees per annum of what? Rent receipts. But because now I'm going to use this place for keeping my equipments and convert the waste into a marketable product, I will lose this 30 lakh rupees of rental value, correct or not? So in other words, for the purpose of my decision making, is this 30 lakhs relevant? Yes. This 30 lakhs will be treated as an outflow. Sir, how is it an outflow? Basically, sacrifice of inflow is nothing but an outflow only. I would have got this 30 lakhs because I'm going for this project. I am losing 30 lakhs, so it's going to be a negative 30 lakhs. Are you clear with this? Then labor cost will include the wages of 40 workers whose transfer to this project process will reduce the idle time payments of 45 lakhs in year 1, 30 lakhs in year 2. So what they are saying, there are already some workers, the factory who are idle. If not for this project, they would have remained idle and we would have paid some money. Fine. But since we have this process, we are saving some idle time cost of 45 lakhs in year 1, 30 lakhs in year 2. Basically, these are cash inflows. That is, I am able to save 45 lakhs in year 1 and 30 lakhs in year 4. Or in other words, reduction of cash flow is same as what? Your increase in cash inflow, correct? Reduction of outflow is equal to your increase in your inflow. Yes or no? This is a reduction of outflow, or I can even say that this is my cash inflow. It's a positive for me. Next, factory overheads include apportionment of general factory overheads except to the extent of insurance charges of 90 lakhs rupees per year payable on this venture. Now, what is the meaning of this? This is another point where students make mistake. Factory overheads includes apportionment of general factory overheads. What do you mean by apportionment? This is actually a costing area wherein, see, factory overheads, what we do, in this factory, there will be so many projects, project 1, project 2, project 3, 4, and so on, right? There is a common area, and for this common area, there is a cost incurred. What they do is, this common cost, they will apportion it between the projects and say, these projects, I'm giving a share of so much amount of the common cost. Now you tell me, whether I run this particular project or not, I cannot save this common cost, correct or not? That is what they are saying here. Factory overheads, these figures 165, 180, 330 and 435 and all, this is share of a common cost that is being given to this project. Now you tell me, whether I run this project or not, can I save this factory overheads? No, but they are saying out of these figures that they have given, what is relevant to this project is only to the extent of 90 lakhs. Factory overheads includes apportionment of general factory overheads. It is only general except to the extent of insurance charges of 90 lakhs payable on this venture. Or in other words, this factory overheads, all these figures you can just ignore. Why? These figures are directly coming from my apportionment. That is, whether or not I have this project, anyways, it will continue to be there. The only factory overheads relevant is 90 lakhs every year. Why? Because that is only dependent on the decision of this project. Suppose if I don't have this project, this 90 lakhs alone I can save. If I don't have this project, I will continue to be incurring all this extra cost. Are you clear? So they are saying this 165 includes 90. So technically 90 rupees is the relevant cost for this concept, for this project. The extra 75 is nothing but a share of common factory cost that is getting apportioned to this particular project. Are you clear with this? So all the common costs you need not consider, you ignore it. You take up only the relevant cost that impacts your project. Consider the cost of capital at the rate of 14%. So they have mentioned the discount rate, right? The present value factors are given for 4 years. So they have given the present value table. Advise the management on the desirability of installing the machine for processing the waste. All the calculations should form part of your answer. So now pause this video, read the entire question and then digest the facts. Now let's get into the solution of this particular question. So now first, let us calculate the statement of operating profit from processing the waste. Now, if I decided to process the waste, what will be the operating profit, year-wise operating profit? Now, year-wise, the sales figures are given 966, 966, 1254, 1254, correct? So, copy paste the figure. These figures are given, correct? So this is your sales revenue that you will be making. Then minus material consumption cost. How much is this? This figure is also given. So this figure is given. This is also given as how much? 90, 120, 255, 255. Correct, guys? 90, 120, 255, 255. Yes. Wages. Year-wise wage cost is given 225, 225, 255, 300. Yes. Now wait. There is an adjustment in this wages. Look at this. The labor cost includes the wages of 40 workers whose transfer to this process will reduce the idle time payments of 45 lakhs and in year 1 and 30 lakhs in year 2. So year 1's labor cost will be 225 minus 45 savings. The net amount will be how much? 180 only. Are you clear with this? 180. In year 2, how much will it be? Year 2's labor cost will be 225 rupees minus 30. How much is that? 195 rupees. This is going to be 195. Year 2 and year 3, there are no idle cost savings and all. So whatever is the data given, you can use it. Are you clear with this? So this is nothing but given data minus savings in idle time cost. Are you clear with this? Savings in idle time cost. Are you clear with this? Yes. Other expenses data is given as such 120, 135, 162, 210. So you can just plug these figures. This data is also given in the question. Then factory overheads, very important. Put an important symbol here. What is the relevant factory overheads out of whatever is the figure they have given? The only figure that is avoidable because of this decision is how much? The insurance expense only. Are you clear with this? You should only consider, we are not calculating profits for reporting purposes. We are calculating the profits that are relevant for the decision making. Remember that. So 90, 90, 90 and 90 respectively. Here we are not preparing the financial statements and reporting the exact profits. For that you will consider everything. We are talking about decision making. If I take the decision of running this machine and processing the waste, the only extra cost that I will be incurring because of my decision is the insurance cost, because all the other costs are general expenses being apportioned to this project. That's all. It cannot be saved just because of this particular decision. That is the meaning. One more thing is there. What is this? Loss of rent on storage. Clear. Opportunity cost. What is this? Because I am going for this decision, now in this place I will be placing all my equipments and I will be doing the process. Had I not taken this decision, then this place would have been empty, which I could have rented out for 30 lakhs per annum. So now I'm going to lose that 30 lakhs per annum. So this is also my cash outflow, correct? So 30 lakhs is also considered. Look at this, guys. So this is the sales revenue, right? Here we are computing all the costs here, correct? And we are totaling it here. Are you clear with this? The costs are being totaled here. So don't worry about this. So this is also a cost. Every year I lose how much? 30 lakhs. So losing money or reduction in cash inflow is treated as a cash outflow, correct? Then depreciation as per income tax rules 150, 114, 84 and 63. This data is given in the question. Clear with this, guys? Yes. Now, what is the total cost? You have the figures, you add it up, you add up all the costs, you get the respective figures. So what is the profit? What is the profit that I generate because of this particular decision? If I use this factory facility for processing the waste and converting it into a marketable product, the extra profit that I will be getting is sales minus total cost. So it is 306, 8282, 378 and 306. Are you clear with this? Less tax at the rate of 30%. We have got the profit after tax of these figures. Are you clear with this? These are some calculation driven thing. So just apply this 30% on the respective profit before tax. You will arrive at the tax. So now your profit before tax minus tax gives you profit after tax. Wait, we have not computed cash flow after tax. We have just computed the profit after tax. Look, there is a way in which you can do this sum using something called as incremental cash flow model. I will explain that to you. Clear with this, guys? Yes, till now are you able to clear with this? That is, if I go for processing the waste and converting it into a marketable product, because of this alone, because of my business decision, I am generating an extra profit after tax of 214.2, 197.4, 264.6 and 214.2. Are you clear with this? Yes. Now see what they have done. Statement of incremental cash flows. What do you mean by incremental cash flows? Extra cash flow. Extra means what? You need to compare between two alternatives. Yes, processing the waste as compared to disposing the waste. So because I'm going to process the waste, how much is the extra cash flows generating at every year as compared to my disposing of decision? So because I'm going to process now, overall, what is going to be my incremental cash flows? Cash flows can be cash inflow as well as cash outflow. First, what is the year 0, year 1, 2, 3, and 4? Now, because I'm going to process now using a machine, first at the T0 itself, today itself, what is going to be my first cash outflow? Cost of machine. How much is the value? 600 lakhs. Are you clear with this? Will I be incurring this cost of machine anytime else? No. Nil for all the remaining years. Then material stock. This is not a cost. This is a working capital investment. Working capital investment means what? It is an outflow initially and it will be an inflow at the end of the life of the project. Sir, what is the calculation? This is what I said. At T0, it's going to be 60 lakhs. T1 is going to be 105 lakhs and 2 and 3 is going to be nil, and at the end of year 4 it's going to be 165 lakhs. Are you clear with this, guys? So this is a stock policy, minus 60 minus 105 and plus 165. Why is this? Initially itself I'm bringing a stock of 60 lakhs. At the end of year 1 I should maintain stock worth 165 lakhs. I have already have a stock of 60, so the difference between that is 165. Now I have made my stock balance as 165, so that stock should only be maintained for the next 2 years, and at the end of 4 years, the 4th year, the entire stock will get released. So this is going to be 165 positive. Guys, get this clarity. This is an important thing. Basically, this and your factory overheads, these two are very, very important adjustments that generally students miss out. Then now one more thing is very important. Now if I want to process this particular waste and convert it into a marketable product, now what I need to do is what? I also need to pay the compensation for cancelling the contract. Correct, guys? How much you need to pay? 90 lakhs at the beginning itself. Correct? They have said if you want to go for this process, what you need to do is currently you have some contractual obligation. So you need to cancel that contract, and that contract they have given what? They have given the contract can be terminated upon payment of 90 lakhs. This is what they have given. Correct? What does the contract say? Every year you need to pay 150 lakhs if you are using our services. Correct? Now, if you're going to process and not dispose, you want to terminate the services. They are saying, okay, so since you are terminating our services, pay us a penalty of 90 lakh rupees. It's a compensation. That's all. Every year you need not pay me 150 lakhs and all. We are not going to provide any service. But since you have agreed and now you are cancelling the contract, pay us 90 lakh rupees. That's what they are saying. Are you clear with this, guys? Are you clear with this? Yes. So now look at this. Look at this. The compensation for contract is going to be how much? 90 lakhs. But wait, because you're paying this 90 lakhs, from now on, you are going to save 150 lakhs. Yes or no? So contract payment saved initially 0. At the end of every year, it's going to be plus 150 lakhs. Are you clear with this? Sir, why are we doing all this? We are comparing how much extra cash flow we are able to generate if we process and not dispose of. So how much extra, how will you compute when you compare the relevant cash flows as compared to the two alternatives of processing and disposal? So if I process, I will be incurring 90 lakhs, which is going to be a negative, but I will be saving 150 lakhs every year. That is going to be a positive. Guys, are you clear with this? Since you are comparing the two cash flows parallelly, it's called as incremental cash flow approach. Then now what happens here? Every year you are now doing what? You are now saving for 150 lakhs. Correct? On this 150 lakhs, till date, this 150 lakhs was a tax deductible expense. Yes or no? This 90 lakhs is not allowed for tax purpose, they told, but this 150 lakhs was a tax deductible expense whenever I was paying. Since I am not paying that 150 lakhs right now, I am saving 150 lakhs, but I'm losing out on the benefit of 150 tax benefit on this 150 lakhs. Or in other words, on this 150 lakhs, I am also losing out the tax benefit. Till date, I was paying 150 lakhs. It was an expense for me. When this was an expense, I was also paying lesser tax. Now, since I am not paying this 150 lakhs as an expense, I incremented it and I considered it as a cash inflow. Correct? Now, what happens parallelly? Now the tax benefit on that is also something that I'm losing. So I need to reduce that. So that is going to be 45 lakhs every year. That is, what is the percentage of tax? It's 30% on 150 lakhs is going to be 45 lakhs. So every year, I save the contract payment, but I lose the tax benefit. Net off, if you see, technically, the net amount of contract payments saved post-tax is only 105. If you want, you can directly put 105 and give the calculation. That is also fine. Yes. So now you tell me, what is the incremental profit. If I go for this particular project, every year, what is the incremental profit that I earn? 306, 282, 378, and 306. Correct? You fill these figures here. This figures is nothing but the figure C that we calculated above. Are you clear with this? Fine. So these are all some relevant cash flows. Then this C is nothing but the exclusive cash flow that we are able to generate from this processing. Now, in this 306 or in this particular calculation, we have considered depreciation. Correct, guys? Yes. So add back the depreciation. Why? Because depreciation is not a cash outflow. So you add back the depreciation, respective year's depreciation, you add it back. Correct? But you should subtract the tax on profits. Correct? The tax on profits for the respective year, 91.8, 84.6, 113.4, and 91.8. These four profits you just subtract. That is, this is cash flow. This is actually profit before tax and depreciation. Sorry, this is profit before tax. Correct? This is the line item here that we have got. Profit before tax. Add back depreciation and reduce your taxes. You get what? Net cash flows after tax. You get your net cash flows after tax. Now, one more thing that we need to consider here is what? Now, at the end of the life of the project, what happens is we are able to sell this machine. Correct? How much you are able to sell this machine for? They had given the data. What is it that they had given? 60 lakhs is the value at which they have sold. Yes, but wait. For you to sell this, you should incur some dismantling cost of 45 lakhs. So 60 minus 45 gives you 15. The net cost is going to be how much? Only. So the net cash inflow is only going to be 15 lakhs. Are you clear with this? So here we will say the profit on sale. Technically, it should not be called as a profit. I will say net proceeds on sale of machinery, but institute has used this language, so let's also follow it. It's going to be 15. How we got this 15? 60 minus 45. Are you clear with this? So these are the relevant cash flows. So the total incremental cash flows after tax, year 1, this is year 0, 1, 2, 3 and 4. So year wise you have the relevant cash flows. Present value interest factor you can use at whatever is the discount rate mentioned in the question, 14%. You can just copy paste these discount rate, but for the first year 0 alone, be very careful. Year 0 is already in present value, it's in 1. So the discount rate should start from year 1. So it's going to be at the rate of 14%. You apply this. The relevant cash flows multiplied with the present value interest factor gives you what? The present value of cash flows. So you get the every year's present value of cash flows. So your net inflow, your present value of inflow minus your present value of outflow gives you the net present value. And if you do this in this question, you are getting a net present value of positive 528.16. Since the NPV of the cash flows is 528.6, which is positive, the management should go for installing the new machine. Are you clear with this? So what all we did here, we considered every single line item. Yes, first we calculated the operating profit generated from processing of waste. Then we computed the incremental cash flows. What do you mean by incremental cash flow? Because I'm going for processing of this particular waste. So what happens? I need to spend extra on my machine. Yes, which is an outflow. Correct. Then there is some working capital changes and all. Yes, I need to introduce some working capital amount which gets released at the end of the period. Compensation for contract payment. Then what happens? I save every year. Annually, I save some annual contract payment, but on that I lose out on the tax benefit that needs to be considered. The incremental profit I have by comparing the two, but plus extra incremental profit, how much I generate year wise, we have the figure. Add back the depreciation, less your taxes, you get your what? And of course finally you get your you should add your residual value also, the net sale proceeds by sale of machinery. All these the relevant cash flows. You get your incremental cash flows after tax, and multiplied with the relevant present value interest factors, you get the present value cash flows, and you sum total all the present value cash flows, you get your NPV. And since your NPV is positive, you can go for this particular project. Are you clear with this? Look at the notes that they have given. Material stock increases are taken in cash flow. This is what I explained. Idle time wages have also been considered. This is also explained. Apportioned factory overheads are not relevant and only the insurance charges of this project are relevant. This has also been explained. Sale of machinery, net income after deducting removable expenses are taken, and tax on capital gains has been ignored. This has also been considered. And then savings in contract payment and income tax thereon is considered in the cash flows. So all these are notes that they have given. This is a study material sum, and I'm expecting this kind of question in exams. Please guys, please follow this question, and I would suggest just mark this question as important category question, because see, this could be a full-fledged 10-mark question, and in case they are testing you on this particular area, it's a beautiful question. Now you tell me guys, in this question, is there anything new that I taught apart from the working capital? I accept, because working capital is chapter that we are going to see next. Apart from that, is there anything new that I have taught you? Everything else was something that we've already seen. The problem was only interpreting the question and applying it accordingly. That was the only problem. I understand. So if you patiently read the question, you will be able to understand this and do this question by yourself. The decision is what? Whether to process and sell the waste, or is it better to dispose of? We found out the incremental cash flows, and since the incremental NPV was positive, we said go ahead with processing the waste and selling it. In case the incremental NPV came out to be negative, we will say no, then you better continue with disposing of itself. This is not a viable project. Are you able to understand this investment decision? Where I should invest my funds, whether it's worthwhile investing these funds in a machinery and converting my waste into a marketable product and selling, or disposing of my waste itself as such. So this is an investment decision that we are doing on the asset side. Should I make this investment? Is it worthwhile making the investment on my equipment or machinery or not? Are you clear with this? And that's about the sum. Please mark this as important. Are you clear with this? So now let's quickly go to the next question. The next question is equally important, guys. Next question is equally important. So please mark this sum also as important, because in marathon, I'm covering the typical examination related problems as well. So case study questions. This is about capital budgeting in replacement nation. So what it is, we will see. HMR Limited is considering replacing a manually operated old machine with a fully automatic new machine, right? So currently what they have, some old machine they have, which is manually operated. They want to purchase what? Fully automatic new machines. The old machine has been fully depreciated for tax purpose, but has a book value of 2,40,000 on 31st of March 2021, right? This is given. The machine has begun causing problems with breakdowns, and it cannot fetch more than 30,000 rupees if it is sold in the market at present. So today, if I want to dispose of the old machine, I will not get beyond 30,000 rupees. That's what they are saying. It will have no realizable value after 10 years. Suppose I am not I don't want to dispose of, some emotional reason, I want to continue using this old machine for 10 years. At the end of 10 years, it will not even have this 30,000 rupees of value. It will have zero value only, right? The company has been offered rupees 1 lakh for the old machine as a trade-in on a new machine, which has a price before allowance of trade-in of 4,50,000. What they are saying. Now, let's say you are going to a big company, right? Let's say you are going to purchase a new machinery. Now, what these guys are saying is, look, we are allowing you for an exchange offer. Now, exchange, now you would have seen in your mobile phones, correct? If you want to buy a new mobile phone, in this example, if you want to buy a new machinery, it will cost how much? 4.5 lakhs. But if you are willing to exchange your old machinery, we will take that old machinery for 1 lakh rupees. It is enough if you pay me 3.5 lakh rupees. This is the meaning of this. Are you clear with this? Fine. So technically, if you sell this machinery, let's say you have an old phone, correct? In this example, I'm just taking. If you sell that old phone in OLX or open market, second-hand market, you will get only 30,000 rupees, correct? But if you exchange it with Flipkart for a new phone, they are ready to actually exchange it by paying you 1 lakh rupees. Are you clear with this? This is the meaning. This is the context that is given in the question, right? Technically, in Flipkart and all, it works other way around. If you sell it in the second-hand market, you get more money, while Flipkart doesn't pay much for all these exchanges. But anyways, right? Coming back to the discussion. The expected life of the new machine is 10 years and the salvage value is 35,000. The new machine, if you purchase it today, 4.5 lakhs minus 1 lakh, net investment is 3.5 lakhs that you need to pay. But wait, you can use it for 10 years. And at the end of 10th year, what will happen? 35,000 rupees salvage value also you have. Further, the company follows straight line method of depreciation, but for income tax purpose, return down value of method of depreciation at the rate of 7.5% is allowed taking that this is the only machine in the block of assets. So for books, for the purpose of accounts, they have taken into account SLM, whereas income tax, what is allowed is WDV. So what we now need to do, we need to reverse this SLM, compute WDV method of depreciation. Based on that, you need to compute the tax and once again add back the depreciation. This is what we need to do. Given below are the expected sales and costs from both old and new machine. Now, old and new machine, using the old machine or the new machine for the next 10 years, every year I can generate 8,10,000 rupees of sales. Whether I use old or new, that is not a problem. The problem comes on the cost side. Look at this. If I use the old machine, material cost is 1,80,000. Whereas if I use the new machine, the material cost is only 1,26,250. Why? Because the new machine is more efficient. Correct? So it requires a lesser consumption. There is lesser wastage in my new machine. Next, labor cost 135 in old machine, new machine only 110. Why? Because this is actually this is your manual machine, whereas new machine is only automated, so lesser wastage cost, lesser labor cost. Then variable overhead is also lesser. The variable overhead is 56,250 for old machine, whereas just 47,500 for the new machine. These are the required data given, and of course fixed overheads respective figures, depreciation respective figures, profit before tax is given, tax is being given, and then your profit after tax for each of the two alternatives have been given. Now, from the above information, analyze whether the old machine should be replaced or not if the required rate of return is 10%. What do you mean by required rate of return? Your KO, the weighted average cost of capital. Ignore the capital gains tax. So basically what they are saying, look, currently we have a machine, old machine we have, and this machine, it doesn't have, we have already, it is already there in our books, correct? Today, should I pay anything to buy it? No, I already have it. Are you clear with this? Yes. So if I continue with this for the next 10 years, yes. So this is the sales and cost data given in the question. No. If I purchase a new machine, what happens? The initial cash outflow and year-wise sales and cost is given. Apart from that, you also have something called as a salvage value for the new machine. Then depreciation is also given. The question is, should the old machine be continued or you should replace the old machine with a new machine? That is why we call it as replacement decision. Are you clear with this? Very simple, guys. Pause this video for a while. Just go through the facts of the question and then let's get started with the discussion. Now, look at this. Workings. The first one is calculation for the base for depreciation or the cost of the new machine. New machine, what is the purchase price? 4,50,000. But wait, if I am buying the new machine, obviously I will discard my old machine, correct? So I can exchange it with him. He is ready to take it for 1 lakh rupees. So my net cost, if I buy the new machine, is only going to be 3,50,000. So at the beginning of T0, if I am going for the new machine, I need to shell out extra cash of how much? 3,50,000, right? Now, look at this. Profit before tax as per books. Profit before tax as per books. Now, look at this. Old machine, new machine, difference. 3 columns we are having. Now, profit before tax as per books. Where is the data given? So, they have given profit before tax 324,750, 387,250. Yes, guys. So 324,750, 387,250. So the difference between the profit before tax is how much? 62,500. Or in other words, if I go for this new machine, the extra profit before tax that I will be getting every year is how much? 62,500 rupees. Correct? Add back depreciation as per books. This depreciation, we don't need it. Why? Because it is under SLM method. Depreciation as per books. So 24,000 and 41,500. Add back these depreciation. So 24,000, 41,500. You add it back. You get how much? 17,500 is the difference. Then profit before depreciation and tax. So if you add it back, so old machine gives you a profit before depreciation and tax. How much is this? 3,48,750. New machine gives how much? 4,28,750. So the overall extra profit before tax and depreciation, if you use the new machine, will be how much? 80,000 rupees. Remember, if I use the new machine, the extra profit it generates before considering my income tax and depreciation is going to be 80,000. This is the meaning. Are you clear with this? Or in other words, every year, I will be able to generate 80,000 rupees of extra profit without considering my income tax and depreciation. Guys, are you clear with this? This is not cash flow. This is just a profit. So we need to compute the incremental cash flows right now. Since we are comparing two alternatives, we can directly compute the incremental cash flows. Are you clear with this? Calculation of incremental NPV. Now, what is the life of this particular asset? 10 years, correct? So 1 to 10 year wise, you put this data. The present value interest factor for 10 years, this comes in the first column. Are you clear with this? Now, every year, the starting point is what? Every year, what is the incremental profit before tax and depreciation? What is the extra? What is the extra profit before tax and depreciation that I will be earning if I go for the new machine as compared to the old machine? 80,000 rupees every year I will be earning extra. Yes or no? Now this earnings, this profit is what? Before tax, before depreciation. In this method, some SLM method of depreciation was given. We added it back. So this is actually profit, extra profit before tax and depreciation. Are you clear with this? So now we need to reduce the depreciation, but this depreciation should be as per what method? As per WDV method. Yes or no? Now, guys, 1 minute. Now you tell me, they have given it very clearly in the question. They have given it very clearly in the question. Look at this. So somewhere they had given that this, yes. Look at this. The old machine has been fully depreciated for the tax purpose, which means from the perspective of income tax, if you're continuing with the old machine, will you have any depreciation? No. If there is no depreciation, will you have any tax savings on depreciation? No. That is this old asset got fully depreciated from the viewpoint of income tax. So there is no tax shield, or there is no depreciation if you continue with the old machine. If you go with the new machine, what they are saying, they are willing to provide you 7.5% under WDV method. WDV means what? Written down value method. So which means every year the extra depreciation will be only coming out of the new machine. Are you clear with this? Or in other words, if I go for this new machinery, whatever is the depreciation on the new machinery, that itself is the incremental depreciation. So this incremental depreciation means what? See, this is the incremental profit that I will be generating if I go for the new machine as compared to the old machine, correct? Yes, this should also be incremental depreciation if I go for the new machine as compared to the old machine, correct? Now, old machine, what will be the depreciation if I'm continuing for the next 10 years? 0, correct? So what will be the depreciation for the new machine? 7.5% per annum for what? For on WDV method, correct or not? So technically, the extra depreciation that will be happening, that I will be incurring every year because of this decision, will actually be nothing but your 7.5% on WDV minus 0. Why minus 0? Because under the old machine, it's fully depreciated, no depreciation at all. So basically, the extra depreciation that I need to compute is nothing but the depreciation on the new machine. But remember, this depreciation on the new machine should be under WDV method. So now, how will you compute this? Guys, in this question, in study material, they have not given you the manner. I mean, they have not given you the working note for calculating this depreciation. So quickly, I will just take an Excel file and I will just compute it. I will just show you how to do this. So now, right? So now you tell me what is the value of this particular machine. So we are just going to compute what? We are just going to compute the depreciation. We are just going to compute the depreciation under WDV method. So we are just going to compute the depreciation under WDV method. So now look at this. So now let's take this as the opening balance. This is depreciation at the rate of 7.5% on opening balance, correct? So this is going to be your closing balance. Yes, fine. Are you clear with this? Yes. So now year 1, 2, 3, 4, 5, 6 and so on. Next 10 years you got. Yes, so the next 10 years. Opening balance. What is the base on which depreciation is calculated? We calculated 3,50,000 rupees. Correct, guys? Yes. So depreciation for the first year is going to be what? Equal to 7.5% into the opening balance. Correct, guys? It's going to be how much? 26,250. Yes or no? It's going to be 26,250. Right? Fine. So now it's going to be 26,250. Now just a minute. So I'm putting all these things in figures, right? So now what is going to be your closing balance? That is your closing WDV. So I will put this as opening WDV and I will put this as closing WDV, right? Okay. So now look at this. What is going to be your closing WDV? Opening WDV minus depreciation for the year. This is going to be your closing WDV, guys. Yes or no? Then the second years, in the second year, what will be your opening WDV? It is going to be the closing WDV of the previous year. Yes, guys, correct. And what is going to be the depreciation for year 2? It is nothing but 7.5% of the second year's opening WDV. Yes, guys. Yes. So what is going to be the closing WDV for year 2? It's going to be opening WDV minus the depreciation on the opening WDV. That is opening WDV minus depreciation. So here you have what? F4 minus G4. That is this 723,750 minus 24,821.25. This is going to be a closing WDV. So this calculation you need to do for how much? 10 years. Now in Excel, if you do automatically, you can just get these figures. So, but in exam, you don't have this luxury. What you need to do every year, you need to compute the WDV. So the WDV is going to be this. The WDV, year-wise WDV is going to be 26,250, 24,281.25, 22,460.16 and so on. This is exactly what they have done here in this question. Look at this. 26,250, correct? Then 24,281.25, 24,281.25. Directly go to 7th year. See 16,442.95. See 16,442.95. Can I see these figures? Last year 13,013.82, 13,013.82. Ideally speaking, if you ask me, this should come by way of a working note. This should ideally come by way of a working note. In my opinion, this should come by way of a working note. In exam, you don't have all this facility of using spreadsheets. This is a calculation that you need to do. Simple accounts calculation. Your WDV calculation is something that you need to do. Are you clear with this? So now, what is it that we have calculated till now? Extra profit before tax and depreciation. Now we have calculated the extra depreciation that I will be incurring every year because of what? Because of depreciation. Correct? Yes, I mean because of going for the new machine. Now, what is the profit before tax? Profit before tax, that is the incremental profit before tax. That is profit before tax and depreciation minus depreciation. This is the incremental profit before tax, or in other words, year wise we are computing how much extra profit before tax we are able to generate if you are going for the new machine as compared to the old machine. Are you clear with this? On this only we are computing the tax. This is nothing but the tax payable on that extra profit generated every year. So this is nothing but column number 4 into 30% tax. Are you clear with this? So what is going to be my incremental cash flows after tax? What is going to be my incremental cash flows after tax? Be very, very clear about this. Profit before tax minus tax, add back depreciation. Are you clear with this? This is the extra profit before tax I generate every year minus extra tax I pay on this extra profit. Add back the extra depreciation that was reduced to arrive at this PBT, because it's actually not a cash expense. Are you clear with this? So profit before tax, column number 4 minus tax, which is column number 5, plus the incremental depreciation, column number 3, you get the incremental cash flows after tax. Are you clear with this? So this is ideally the extra cash flow after tax that I am generating because I am going for the new machinery. Are you clear with this? So multiply the respective cash flows with your present value interest factor table. You will get the present value of cash flows, the present value of all the cash inflows. You will get how much? 3,81,102.44. Correct? Wait. At the end of the life of the asset, what happens? You also have salvage value. Remember, the salvage value is there only for new machine. So in old machine there is no salvage value. So technically this is 35,000 minus 0. correct? If I'm going for the new machine, I get 35,000. Old machine does not have any salvage value. So what is the extra salvage value that I get? 35,000 into 0.368. What is this 0.368? That is a discount factor for the 10th year. So this is also what a cash inflow for me. So the present value, total present value of incremental cash inflows is 3,94,612.44 minus the cost of machine. Today, how much extra I have to incur? 3,50,000. This 3,50,000 is nothing but 4.5 lakhs minus 1 lakhs, correct? Minus 1 lakh, 3.5 lakh. So incremental net present value is going to be 44,612.44. Or in other words, if I opt and go for this new machine, if I replace my old machine with my new machine, the incremental net present value I get is 44,612 rupees 0.44. So since the incremental NPV is positive, the old machine should be replaced. Are you clear with this? Are you clear with this? That's an alternative way of doing. You compute the NPV for new machine, then separately compute the NPV for old machine, and obviously the NPV of new machine will be more than the NPV of old machine. NPV of new minus NPV of old, the difference will exactly be 44,612.44, and you can say since the NPV of new machine is more than the old machine, you can go for it. That way you can do, but this incremental cash flows is what institute expects you to do, because this solution I'm discussing it as such given in your institute study material. So this is very, very important. Are you clear with this? Guys, this is again a very important question. Please go through it once, solve this question by yourself. Solve this question by yourself. And with this, we have covered this entire chapter of capital budgeting. So basically this sum, the fifth and sixth sum are very important sums. Please mark them as important. Even the fourth sum that I did was very important because it had all the time value of money techniques. All the capital budgeting techniques were there in this particular question. This is also a very good sum. So please mark these sums are important. It's very, very important. Fine. So basically this chapter is all about how am I going to invest, where am I going to invest the funds that I have raised from different sources of finance, where I should invest. So how will you find out, how will you take this investment decisions? How will you take using multiple techniques? These techniques could be what? These techniques could be time value. These techniques could be traditional techniques, or it could be time adjusted techniques, traditional techniques, payback period. What do you mean by payback period? Payback period means the time taken for me to recover back my initial investment without considering time value of money. Accounting rate of return, average profits divided by investment. The denominator investment can either be an initial investment or an average investment. NPV, profitability index, IRR, we have seen it. NPV is nothing but present value of cash inflow minus present value of cash outflow. So if the NPV is positive, go for the project, else don't go for it. Profitability index is present value of cash inflow upon present value of cash outflow. If the profitability index is 1 or more, then you can go for it. IRR is the rate that makes my NPV equal to 0. What is the decision criteria? If your IRR is greater than your weighted average cost of capital, then you can go for this particular project. And discounted payback period, what is it? It is same as payback period, but here the cash inflows are discounted using your weighted average cost of capital. So the time it takes for me to recover my discounted cash flows is called as the discounted payback period. And MIRR is a rarely tested area, which is a detailed discussion by itself. There are some limitations of IRR that gets actually compensated by this concept of MIRR. Since it's rarely tested, I just focused more on this predominant portion of this chapter, and the important facts of this particular chapter lies in this area. Especially the heart of this chapter is going to be your NPV, profitability index, IRR. Basically your NPV, IRR, this is the area where it's going to be important. Are you clear with this? So basically I've also given this one-page summary I have just given it here. I've just taken it from your study material. So non-discounted method, payback, correct? So when for independent projects or mutually exclusive project, independent projects means what? A, B, C. Let's say there are 3 projects. You can choose A, B, and C, or one or more than one project can be chosen at a time. In that case, what you will do, when payback period is less than or equal to the maximum payback period, you accept it. Now, generally, I can accept if the payback period is only 2 years, correct? I want to recover my money in 2 years. So lesser the payback period, it is better. Are you clear with this? Mutually exclusive means what? A, B, C are 3 projects. Out of these projects, you are allowed to select only one. So the project with the least payback period, you should select. Accounting rate of return, you should choose the project with the maximum accounting rate of return. NPV, what do we do? If it is greater than 0, we accept it. If it is less than 0, we reject it in case of independent projects. In case of mutually exclusive project, that is competition is there, what you do? You choose that project with the highest positive NPV. Then profitability index greater than 1, accept, less than 1, reject. Or if it is a competing project, mutually exclusive project, choose the one that has the highest profitability index. IRR, what do you do? IRR is greater than K. K means what? Weighted average cost of capital, accepted. If it is less than K, rejected. Then the project with, in case of mutually exclusive projects, compare the IRR of multiple projects and choose the one with the maximum IRR. Are you clear with this? With this, we have revised this entire chapter thoroughly. So now let's move to the next chapter. So now let's get started with the revision of the 5th chapter, which is working capital, management of working capital. Now, what is this chapter all about? So as usual, let us first bring the context and let us see why we are studying this chapter, and then we will proceed into the technicalities of this particular chapter. Now, as we all know, our subject financial management has broadly 3 objectives. So what are the 3 objectives that our subject financial management has? Yes, the first one is financing decisions, that is taking decisions with respect to raising of funds, raising of capital. Then you have investment decisions, that is taking decisions regarding where these funds need to be invested, right? And then finally you have dividend decisions, right? Now, we saw some chapters in financing decisions like your cost of capital, leverages, and your capital structure decisions. Then investment decisions, we saw the capital budgeting chapter. Yes. Now, in dividend decisions, there's a separate chapter called dividend decisions. Now, this chapter, working capital management. Now, where does this chapter fit into? Or in other words, this chapter fits into which of the 3 objectives? Now, strictly speaking, this working capital management is actually something separate by itself, or if you want to plug it under any of these 3 objectives, the most relatable objective under which you can classify the working capital management is your investment decisions. I will just tell you what it is and all. I will tell you what it is. You need not have to worry, but this can also be classified under financing decisions. But that is the reason why I'm saying I don't want to bring it under any classification. This working capital management, you treat it as a separate animal as such. It is a separate study as such, called as working capital management. Are you clear with this? I will just go about the introduction. I will tell you what is working capital, why we are studying all these things. And of course, there are a few concepts that we have studied in costing that needs to be related while studying this particular chapter. Are you clear with this? So for the time being, you just understand this is a separate study under financial management by itself. So don't try to plug it under any of the 3 objectives, because in this chapter, you have both the financing decisions as well as the investment decisions. How it is, I will tell you as we proceed into this particular chapter. So now, what do you mean by working capital? What do you mean by working capital? Working capital means current assets minus current liabilities. This is something that you have already studied. This is something that you would have already studied even right from your school days, your 11th and 12th, wherever, right from your commerce, in your accounts, you would have studied all these formulas. Working capital refers to current assets minus current liabilities. All these things are fine. But now we are going to look at this logically. We are going to understand what exactly do you mean by working capital and all. Clear with this? Now, what has happened? The company has chosen the sources of finance, correct? Let's again drop the balance sheet of the company. There are multiple sources of finance like equity share capital, your retained earnings, preference share capital, your debentures, right? There are multiple sources of finance. So the company has designed the optimum capital structure. They have decided from which source of finance, how much should be the amount raised. Financing decisions is over. Now, once this is over, they have also purchased all their fixed assets. That is, they have taken the capital budgeting decisions, investment decisions. The company has purchased a nice big factory. Inside that, all sophisticated machines are all there. Everything is set right now. Now, the company has raised money, and they have also purchased whatever they want. All the fixed assets, the equipments and all have been purchased. Now, can I start the business today itself, right from this second? Can I start the business? I have everything with me, no? I have all my factories. I have my inside the factory. I have all my sophisticated machinery, equipments. I have everything, right? So can I immediately start my business? Let us say I am a pen manufacturer. Fine, I have everything right now. Can I start my business? No. Why? Because for you to start your business, yes, you have all the facility. All the facility is there with you. Yes, no doubt. But to start your business, you need to first purchase some raw materials, correct? Then you need to actually function, start the factory, correct? And you need to put your workers to actually convert this raw material into a finished goods. For this conversion, you also need some electricity, power and all. Are you clear with this? There are so many things that are required for my day-to-day running of business. Yes. So technically speaking, my fixed assets are not the only investment that goes into the business. There is also something that I actually need to run my day-to-day operations, and that is called as working capital. That is called as working capital. So what is it? What is it? Can you explain it? Now let us just take an example. Why do we need working capital? Let us just take an example. Now I have all these things set, long-term sources of finance I have raised, yes, and then I have purchased machineries, equipments, and everything is set. Now I need to start my business. Let us say I get my first order. Let's say I am getting my first order from a big client. Okay, I'm a pen manufacturer. I'm getting an order from a big client. Now, what happens is, now this company is saying, for me to get this order, this company is saying, my client, they want to know whether I have the capacity to fulfill my honor. That is, I have the capacity to fulfill my commitment. That is, I have the capacity to fulfill the order. So what they are saying is, look, you should readily have 3 months of your raw material stock. Whatever is a raw material stock that you generally have, it should be held with you for a period of 3 months. Only if you hold your raw material for 3 months, I will be ready to accept your order. Or in other words, I will be ready to give you this particular order. So now what they are saying is, first, what the company does, so first they introduce cash into the business. So I am the pen manufacturer. I bring in cash, correct? Now, using this cash, what I do, I purchase raw material, right? I purchase raw material. Now, what happens? The raw material, I need to keep it in my stores, in my godown for 3 months. Let us say that is the precondition of this order. Generally, I maintain 3 months of stock in my godown. Clear? Now, after this raw material needs to be converted into WIP, correct? So let us say for a period of 3 months, the raw material stays in my godown. After that, I will issue this raw material into my factory shop. That is, the production will start. Let us assume the production will take 1 month. Okay, let us assume for the raw material to get converted into an FG, that is in WIP stage, the entire process will take about 1 month. Yes or no? Now, after this, immediately will I be getting the cash? No. This WIP will be converted into what? This WIP will be converted into an FG, correct? This WIP will be converted into an FG. Now, let us say in this FG, let us say generally, the company holds this for, let us assume, 1.5 months. So the moment I manufacture, the moment I convert my raw material into FG, will I immediately able to sell it? No. Let us say that it needs to stay in my warehouse for a period of 1.5 months. Then what happens? After this FG is actually present, now what I will do? I will sell the FG. Now, if I sell the FG, will I get the cash today itself? No. What will happen? My customer will ask for some credit period. So there will be debtors. Now this guy says, no, I want 2 months time to actually pay you the money. So after this 2 months only, I will be getting my cash back. correct or not? Or in other words, first if I introduce cash into my business, yes, I need to purchase raw material, and the raw material stock will remain with me for a period of 3 months, correct? Then what happens? This raw material needs to be converted into an FG, and for that conversion, it takes 1 month for me to produce. The moment I complete my production, I cannot sell it immediately. It will be in the finished goods will be in my warehouse for a period of 1.5 months. Right after that, when I am selling, I will not be able to get the cash immediately because the debtors are asking me a credit period of 2 months, and after that only I am able to get the cash. Or in other words, if you see here, so if I introduce cash into the business, when will I get back this cash? It takes 3 months plus 1 month plus 1.5 month plus 2 months, correct? So 3 plus 1, 4 plus 1.5, that's going to be 5.5 plus 2, 7.5. So in this example, just an example, so technically it takes 7.5 months for me to get back my cash. The time period that I take to actually bring my cash back into my business is called as working capital cycle. It is also known as operating cycle. Are you clear with this? So what is this basically? So now apart from my investment in all my fixed assets and machinery, for me to run my business, I need to introduce cash, correct? I need to bring in an investment. This investment is for what? This investment is to purchase raw material, and then there are some factors of production, labor, overheads and all I need to incur for the purpose of converting raw material into FG, and that FG cannot be sold immediately. It will stay as FG stock for some period, and then it will be converted into a debtors for some period, and after that only I will get back my cash. This cash includes profit. So what I actually introduce into my working capital cycle will be my investment, but finally what I get back will be slightly more than the investment. Why? Because debtors is at sales price. Sales price will include a margin. Are you clear with this? So basically what will happen, look, this is what happens. Just an example. Let us say the overall working capital, just an example. The overall working capital is how much? Let us say 100 crores. The overall working capital is 100 crores. Now, let's say for the cycle to get over, after let us say this working capital cycle of 7.5 months in our example, let us say I will get 105 crores. This includes profit. Clear? Now, what will I do? Can I take back this 105 crores now? No. The next working capital cycle will continue. Why? I am running a business. So obviously the cycle needs to keep on moving. The moment 7.5 months gets over, the next working capital cycle will start. Now what I will do, in the second cycle, I will invest back 100 crore rupees. Correct. And then it takes another 7.5 months to come out of this. Correct. So basically, out of this working capital, in this working capital cycle, I introduced 100 crores. At the time when I get it back, I will definitely get slightly more than that. So ideally speaking, I can take this 5 crores out of my business, and this 100 crores again needs to be reinvested back. And this 5 crores, I can use it to actually finance. I can use it to pay my interest on whatever is the loan that I am borrowing. Let me come to that in a short while from now. So basically, this working capital is a permanent amount that gets blocked into the business, and now it gets released after the cycle gets over. Again, it gets reinvested for the next cycle. Then after that cycle gets over, again it gets released. Then again it should get reinvested, and the cycle goes on forever. Now, when will the cycle stop, sir? When the company stops the business. In the last cycle, yes, after that you need not reinvest it back. You can just take back the entire working capital amount. This is why, let's connect the dots. This is why I said in the previous chapter, that is in investment decisions, I told you your working capital is an outflow initially, and at the end of the life of the project, it becomes an inflow. I told you, right? So basically, this 100 crores I'm putting into the business, it's not a cost. It's an investment. So I need to invest this amount. It gets recycled once again, and life just keeps on going. Are you clear with this? So basically, I need to introduce this extra 100 crores into my business. This 100 crores is my working capital. This 100 crores is my working capital. Are you clear with this? Are you clear with this? Now, I need to bring this 100 crores into my business. Yes, I need to bring this 100 crores. This is over and above my capital investment, that the amount that I invested in my plant and machinery, all the equipments and all that. Now, and this is a cycle that keeps on going. So the moment I borrow this 100 crores and introduce it into the business, it always remains in the business. Now, I need 100 crores for what? For my working capital, day-to-day functioning. Now, how can I get this 100 crores? How can I get this 100 crores? Broadly, there are two ways. So, working capital investment, how much is the working capital investment amount that I need? 100 crores, correct? How will I finance this working capital? There are broadly two ways. One is you can go to a bank and you can ask them for a loan. Now, remember this one thing very clearly. How much will you ask them for? 100 crores. Now you tell me, this 100 crores, can you repay it after 7.5 months? No, this is a long-term loan. Why? So after 7.5 months, in this example, 7.5 months, after this working capital cycle, again this 100 crores needs to be reinvested into the next cycle, and it just keeps on going like that. But what happens is, every time the cycle gets over, I get an amount that is slightly more than my investment. Using this extra money, I can pay them the interest and I can keep on servicing the loan. Are you clear with this? So technically, when you are borrowing money, when you are funding for working capital, that is also a long-term borrowing only. Are you clear with this, guys? Are you clear with this? So when I go for sources of finance to fund my working capital, remember that working capital is generally a long-term source of financing, right? Now, what is the alternate source? What is another source for financing your working capital? This could be your current liabilities, that is trade creditors or bank OD, etc. Short-term borrowings, etc. Sir, what is this? Now, you look at this, what I said. Once I bring in cash into the business, right, I am purchasing the raw material. The raw material stays in my stock for a period of 3 months, correct? So technically, immediately once I make the investment in my raw material, I cannot convert it into money. It stays idle for a period of 3 months. After that, another 1 month is required for converting it into FG. Yes, and then 1.5 months it remains in the FG stock. Then 2 more months it takes to actually convert it into my debtors. Correct? Now, what I can do is, instead of financing this entire amount, I can go to my supplier. The supplier is what? The supplier of raw material. I can ask him, sir, I am also doing a business, so I am having this cash liquidity and all. I will continue to do business with you only. I will be your customer. You don't worry. I will purchase only from you. But you don't ask me to pay the cash today itself. You give me some credit period. You give me some credit period. You allow me time for payment of this particular raw material. I will not pay you today itself. You just give me 2 months credit period, sir. So I will pay you after 2 months. So technically speaking, my funds get blocked into the business for a 7.5 months, no doubt. But now in this case, out of the 7.5 months, 2 months, this raw material supplier, he is ready to fund you indirectly. Or in other words, he says he is not funding me by way of paying me cash, but he is funding me by supplying the raw material. So he says, I will give you the raw material today. You need not pay me today. You pay it to me after 2 months. So indirectly, it is also a source of finance only. Correct? So technically, my gross working capital cycle is 7.5 months. But out of the 7.5 months, 2 months, this guy, my supplier, is ready to bear the burden. So technically, my net working capital cycle is now reduced to 5.5 months. Or in other words, this is also this creditors, trade creditors are also an indirect source of financing. Are you clear with this? So that is the reason why working capital is generally called as current assets minus current liabilities. Current assets we saw here, 3 months for raw material, 1 month for WIP, 1.5 months for FG, all these are inventories, 2 months for debtors, correct? Gross working capital 7.5 months, less creditors gives me a credit period of 2 months. So net off, if you do overall, the net 5.5 months is going to be my working capital cycle. So technically, the period that I take to convert cash into cash is called as working capital cycle, and this is partly funded by external sources of finance like bank loan and all that. The other one is imbibed in the cycle itself, that is by way of trade creditors and short-term borrowings. Are you clear with this? So the reason why we call working capital as current assets minus current liabilities is this is the gross amount of investment that is required for my day-to-day functioning. Out of this, to the extent of current liabilities, it is being funded by my suppliers, etc. Are you clear with this? So the net funding that I need to bring into my business for the purpose of running my day-to-day operations is called as working capital. Are you clear with this? So now working capital, two things are there. You should find out how much amount of working capital you need for your business, correct? Then once you find out the amount, you should next find out how will you fund this, correct? So there are two decisions that you need to take in this particular chapter. The first one is working capital investment. How much is the amount of working capital I need for my business? That is number one. Number two, yes, I know that I need 100 crores. Now, how am I going to fund it? That is the second decision. That is, how am I going to finance this working capital? That's why I said this chapter is both financing decisions as well as your investment decisions. But then the only issue here is we are talking about current assets and current liabilities, so it is slightly different. From what we saw in our capital budgeting and all. Are you clear with this? Yes. So now let us just go to this particular area. So management of working capital. Now in our study material, generally this chapter gets tested for 10 marks. Now, this chapter is divided into 6 units as per our ICAI study materials, divided into 6 units. Introduction to working capital management. This is the basic concepts of working capital. Then they go on to explain each and every component of working capital. So working capital is what? Current assets minus current liabilities. So current assets typically can have what? It can have stock, correct? Then it can have debtors. Then it can have cash, correct? Right? Then current liabilities can generally have what? Payables, correct or not? Or creditors, yes. So each of these components, there are some decisions that you need to take that are covered here. Look at this: treasury and cash management, management of inventory, management of receivables, management of payables, and finally you have something called as financing of working capital. This is technically a theory area. Clear? So overall, the scope of this chapter is, the first part is about the general study of this chapter. Then the next 4 units are regarding studying certain different components of working capital, and the last part is about how am I going to finance. So this is basically a theory part. So this is going to be the agenda for this particular chapter. Are you clear with this? So working capital is nothing but current assets minus current liabilities. So current assets include what? Inventory. Inventory means it includes your raw material, WIP, finished goods, receivables, cash or cash equivalents, prepaid expenses, and all of that. Right? And then your current liabilities will include the payable and any kind of outstanding payment that you've got. Okay, so now working capital management on the basis of value: gross working capital, net working capital. Gross working capital means what? Your current assets. Gross amount is current assets. Net working capital is current assets minus current liabilities. Are you clear with this? Are you clear with this? See, gross working capital refers to the firm's investment in current assets, whereas the net working capital refers to difference between the current assets and current liabilities. Now, on the basis of time, working capital can be classified into permanent working capital, fluctuating working capital. Permanent working capital is this amount that I told you, this 100 crores. At any given point of time, I need this 100 crores for my business, correct? Now, let us say for one season alone, let's say I am a sweet manufacturer. During Diwali time, I have an excess demand. For that period alone, for my day-to-day operations, since the demand is more, I need to have more funding, but once the Diwali season gets over, then I can just push it away. I can just remove this investment from my business and take it back. So the short-term requirement, suddenly for seasonal extra requirement if I need, that is called as fluctuating working capital. So permanent working capital means what? The amount of working capital that I need generally at any given point of time for running my day-to-day operations, whereas fluctuating working capital means the extra working capital that I might need seasonally, occasionally in my business. Are you clear with this? Yes. And a positive working capital indicates the company's ability to pay its short-term liabilities. So what do you mean by working capital? Current assets minus current liabilities. So if the current assets is more than your current liabilities, it means that even in a worst case scenario, tomorrow, if everything goes wrong, if you're shutting down your business, now if I sell all my current assets, that value itself will be sufficient to pay my current liabilities, correct? So it talks about the solvency of the company, short-term solvency of company. Even if something goes wrong, if I sell my current assets, the amount that I'm able to generate from the current asset should be able to recover my current liability. So generally, it is ideal to have a positive working capital. Are you clear with this? Yes. So now, why do we need adequate working capital? Now, what do you mean by the word adequate? Adequate means not high and not less. Remember this. What do you mean by adequate working capital? The working capital that you have in your business, it should not be too high. It should also not be too less. Sir, why, sir? A large amount of working capital would mean that the company is having idle funds, correct? Now, 100 crores I'm saying I need for working capital, for running my business. If you're borrowing 100 crores now and you're putting it in your business, this 100 crore rupees is blocked in your business. It is not a cost. It is blocked in your business. This can be released only after you permanently shut down your business, correct? So for this 100 crores, there is a cost that comes along with it. Now more, let us say I want to be more cautious and I borrow more and I have more working capital. You tell me the cost that comes for financing this working capital will now increase for me. That is a huge burden. So I should not have high working capital because the funds are blocked into my business. It remains idle. Sir, then if we have less working capital, what will happen? That is also bad. Inadequate working capital. If you have a lesser working capital, what will happen? You will not be able to meet your day-to-day commitments. Let us say you are investing lesser amount of money in your purchasing your stocks and all that. You get a huge order today. He's saying, I immediately want this particular order. So give it to me. Because of lesser working capital, you are not able to fulfill that order. So now what happens? You are losing out on your business. So there will be some opportunity losses and all. So this is what it is. The firm runs the risk of insolvency. You will not be able to generate business. Now what happens? Your current assets will not even be sufficient to recover your current liability. The paucity of working capital. Paucity means scarcity of working capital may lead to a situation where the firm may not be able to meet its liabilities. It may also mean that the firm may not be holding enough inventory in order to meet the customer's demand and hence would lose the sales and eventually some reputation as well. So basically, the working capital investment in this company, in any company, should neither be too high, it should not be too low. Why should it not be too high? Because your investment, the working capital investment comes with a cost. So it's basically an amount blocked in the business. More the amount blocked in the business, more will be your finance cost associated with your working capital borrowings, correct? Then what happens if you have lesser working capital? If you have less working capital, you might lose out on your opportunities to run your day-to-day operations and it will affect your solvency position. So what is the most important thing here? You need to maintain adequate, means what? The right amount of working capital. Are you clear with this? Now determination of working capital. Yes. So this is what it is. Now what it is, look at this. In the scope of working capital management, now we will be reading something about liquidity and profitability. Then investment and financing. Investment and financing, I told you. Investment talks about how much amount of working capital I need. Financing talks about where from I am going to get this amount. Where from I am going to get this amount. Clear? Now, what is the issue relating to liquidity and profitability? Liquidity means what? Liquidity means what? Liquidity means having more cash. Having more cash is called as liquidity. Profitability means what? Having more profit. Remember, these two are different things. More cash does not mean more profit, and more profit does not mean more cash. What it is, we will see. For uninterrupted and smooth functioning of day-to-day business of an entity, it is important to maintain the liquidity of funds evenly. Liquidity means what? You should have the cash in the business. Clear? As we have already learned in the previous chapters, each rupee of capital bears some cost. So while maintaining the liquidity, the cost aspects need to be borne in mind. Also, a higher working capital may be intended to increase the revenue and hence the profitability. If you have a high working capital, what will happen? Now you have more funds, so you can generate more sales. More sales will generate what happens? More profit will be there, correct? But at the same time, unnecessary tying up of funds and idle assets not only reduces the liquidity but also reduces the opportunity to earn a better return from a productive asset. So what happens right now, this is one side of it, but the other side of it, what happens here is now you are tying up more funds in your business. Because of this, there is some cost associated to this. Clear? Hence, a trade-off is required between liquidity and profitability. Sir, which is good, liquidity or profitability? No, you cannot say that this is only best. There needs to be a trade-off, means what? Balancing between the two. Right? More liquidity, less profitability, that is also bad. More profitability, less liquidity, that is also bad. So you need to strike a perfect balance between the two. Ensure that there is sufficient cash, and with this sufficient cash, you are also able to generate sufficient profit. That's about it. Are you clear with this? This is all about 3 E's. That is economy in financing, efficiency in utilization, and effectiveness in achieving the objectives. All these are theoretical parts. Are you clear with this? Fine. Now, this is what I said, investment and financing. Investment means how much amount is required. Financing of working capital means where from the amount is required, right? And estimation of working capital needs, I told you, this is also called as working capital operating cycle, also known as working capital cycle. It's also known as cash cycle. So generally it is done by way of holding period of assets. I told you, right? So I need 3 months for my raw material stock. Then my raw material stock remains in my godown for 3 months, and then it takes one month or 1.5 months for me to convert it into an FG and all of that. We will be seeing a comprehensive numerical sum, so don't worry about it. Now let's get started with this first problem. By way of this problem, we will learn more about this working capital, right? So first, let's get started with this problem. On 1st January, the managing director of Naurin Limited wishes to know the amount of working capital that will be required during the year. From the following information, prepare the working capital requirements forecast. So the managing director of a particular company, he wants to know how much is the amount of working capital investment that is required for my day-to-day running of my business, right? What they are saying. Production during the previous year was 60,000 units. It is planned that this level of activity would be maintained for the present year also. So the upcoming year, I'm going to produce how many units? 60,000 units. The expected ratios of cost to selling prices are given as follows. Raw material is generally 60% of my sales value. Direct wages is generally 10% of my sales value. Overheads is generally 20% of my sales value. So raw material 60, wages 10, and overheads 20%, right? Next, raw materials are expected to remain in store for an average of 2 months before being issued to the production. So basically they are saying, if I purchase a raw material today, immediately I will not start converting into an FG. It has to wait in the godown for 2 months. It is the company's policy, correct? Then each unit is expected to be in the process for 1 month. The raw material being fed into the pipeline immediately, and the labor and overhead cost accruing evenly during the month. What they are saying? So raw material stock 2 months. They are saying WIP, what will happen? It remains in the process. It takes 1 month for them to convert the RM into WIP. Clear with this? So then and there, evenly your raw material will be fed into this particular machinery, and evenly the production will happen. The labor and overheads will be incurred evenly during the course of this particular month. Then once the production is completed, finished goods will be there. Now immediately, finished goods, can it be sold? No, it has to stay in the warehouse awaiting dispatch to customers for approximately 3 months. So finished goods, my money gets locked up by way of finished goods for a period of 3 months. Then credit allowed by creditors is 2 months from the date of delivery of raw material. Credit allowed to debtors is 3 months from the date of dispatch. Now, after FG, what happens? Debtors. Now, immediately will I be able to generate, the moment I sell my FG, will I be able to generate money? Will I be able to generate cash? No. The debtors say that they want 3 months of credit period, right? Right? But wait, parallelly, the creditors are also saying that they will give me, the creditors are saying that they will give me 2 months of credit period. So this is an advantage for me. Are you clear with this? Yes. Next, selling price is 5 rupees per unit. There is a regular production and sales cycle. Wages and overheads are paid on the first of each month for the previous month, and the company normally needs cash in hand to the extent of 20,000. What we need to do, we need to calculate the working capital requirement, right? So pause this video right now, read this question once, and then let us continue with the discussion further. So now, first, let us calculate the component wise amount that gets blocked into the business. Component wise amount that gets blocked into the business. Now, recall in costing, we have learned something called as cost sheet, right? Fine. If you do not know, if you have not learned costing, if you're directly entering into FM, right, there's something called as cost sheet. So what is basically a cost sheet? In cost sheet, basically we have direct material plus direct labor plus direct expenses. It gives you something called as prime cost. To this, you will add your production overheads. You get something called as gross works cost, right? Add opening WIP minus closing WIP. You get something called as net works cost, or popularly known as factory costs, right? From this, add your opening FG minus closing FG. You get something called as cost of goods sold. To this, you will add administrative overheads and add selling and distribution overheads. You get something called as cost of sales. To this, if you add profit, you will get the sales value. Now, basically, this is a format of cost sheet. So what happens is, for me to produce and sell one unit, what are all the costs that I will be incurring? Direct material, direct labor, direct expenses, correct? So all the direct expenses put together is called as prime cost. To this, I will also be incurring some indirect expenses that are incurred inside the factory. Example for production overheads, indirect expenses incurred inside the factory. This is going to be factory rent. Just an example, right? Now, if I add all these things, I get something called as gross works cost. Now, not every units are completed in all aspects. So the incomplete units are called WIP. So adjust for WIP, add opening WIP minus closing WIP, you get the net works cost or the factory cost, correct? So this is also known as cost of production. That is, for me to produce every single unit, I incur material, labor, direct expenses, and production overheads. Or in other words, I incur all the costs incurred inside the factory. Yes, to this I adjust for my opening and closing FG, I get cost of goods sold, correct? Yes. Now I add my administrative overheads and selling overheads. So what do you mean by administrative overheads? Any expenses incurred for my administration activity. For example, I can call it as office rent, correct? Office rent, or I would say MD salary, all these are administrative overheads. Selling overheads, the example for selling overheads will be sales commission, or we can even say warehouse rent, correct? Warehouse rent. So any kind of indirect expense incurred in the sales area is called as selling and overheads. So to my cost of goods sold, if I add my administrative overheads and selling overheads, I get the cost of sales. What do you mean by cost of sales? The cost incurred in respect of every unit sold But whereas what is the cost of production? This is nothing but the cost incurred in respect of every unit produced. What is the difference between the two? Here only the cost incurred inside the factories are considered. That is nothing but direct material, direct labor, direct expenses and production overheads. Whereas in case of units sold, apart from over and above my cost of production, I will also incur my administrative overheads and selling overheads. Are you clear with this? To which if I add profit, this is going to be my sales. Now I'm just giving you a bird's eye view of this particular cost sheet. Now in cost sheet, in your costing paper, cost sheet will have a few more line items, like there will be something called as research and development expenses, quality control cost and all. Technically, all of that is a part of production overheads. There it's more format driven, but right now here we are just looking at it from a conceptual viewpoint, which is relevant for the purpose of this particular chapter, working capital management. Now, what they are saying, now, I should calculate the amount of working capital that I need to be invested into my business for my day-to-day operation. Now, what they have said, the company is planning to produce how much? 60,000 units in this particular year. 60,000 units of what? FG, correct? Now, what they have said, generally raw material comprises of 60% of the cost. 60% of the cost for what? The 60% of the cost of my sales, correct? So, now you tell me, raw materials, if I buy today, I will be keeping it for a period of 2 months before I issue it to the production. So basically, what is the amount of investment that is required for raw material? Can you tell me? Now, can I say this is nothing but, look, the cost of materials for the whole year, this is cost, not the investment. Cost of materials is 60% of the sales value, correct? So what is the total sales? They have given 60,000 units they are going to sell. Every unit is going to be sold at ₹5, correct? And they have mentioned that 60% of my sales value is generally my raw material cost. I'm not talking about raw material investment. This is the raw material cost, correct? So generally in a year, the raw material cost is going to be how much? 1,80,000. Now, should I introduce 1,80,000 right now itself? No. I just need to in my first working capital cycle, I just need to introduce 2 months equivalent of my raw material consumption. So in one working capital cycle, I just need 2 months of my annual consumption. Annual consumption is going to be 1,80,000 rupees worth of raw material. But for my per working capital cycle, I only need to fund for 2 months. Or can we say the raw material amount, the raw material value that gets blocked into my working capital cycle will be 1,80,000 rupees into 2 divided by 12. So how much is this? So into 2 by 12, this is going to be 30,000 rupees. So first, the amount of raw material, the funding of raw material, the amount of raw material that gets blocked into the business is going to be 30,000 rupees. Are you clear with this? This 1,80,000 is the annual raw material cost that I will be incurring, but I'm talking about how much amount of working capital investment I need to bring in. For this, I need to actually stake some finance also. I just need to take up the funding for this. So 2 months equivalent of my annual raw material cost is only the amount of raw material that gets blocked into a particular working capital cycle. Are you clear with this? It's enough if I just fund for the first working capital cycle. Why? Because now if I fund my one working capital cycle, obviously it will generate cash. That cash generated from the first cycle can be used for the second cycle. Then the cash generated from the second cycle can be used for the third cycle. Or in other words, basically the amount of working capital investment that I need is basically the working capital investment pertaining to one cycle. Are you clear with this? And in that cycle, there could be current assets and current liabilities. In that current liabilities, one of the components is going to be raw material. So raw material, how much amount I need in one particular cycle? I need 2 months of my annual requirement. Annual requirement of raw material is 1,80,000. 1,80,000 into 2 by 12, 30,000 rupees would be the raw material amount that is required in the business. Are you clear with this? Then what happens? Then this raw material now needs to be converted into finished goods. This process of conversion is called as WIP, correct? Now you tell me, You tell me, guys, what happens is, now for a period of 2 months, raw material remains as raw material. It is not touched by anyone, correct? Then what they are saying, next, it takes 1 month. It takes 1 month for the company to carry out the process, or in other words, for the next 1 month, the processing happens, correct? Now during this 1 month, when I am processing, the entire raw material will be blocked, correct? That is, the entire raw material is utilized for this 1 month of processing. Apart from that, for this processing, I will be having labor as well as overheads, correct or not? That is, for a period of first 2 months, raw material cost gets blocked as such. Then for the next 1 month, raw material will now enter into the WIP area. So now the cost gets accumulated. Over and above the raw material cost, I will also be incurring labor cost, and I will also be incurring overhead cost. Are you clear with this? So in my WIP area, what happens? The amount of the value of WIP. So basically, the value of WIP is what? The WIP is valued at material plus labor, direct expenses if it is given, plus overheads. So every unit that gets processed, now the amount that gets into the value of the WIP will not just be raw material, it will be labor, and overheads should also be included. Now look at this, what they have given. Each unit is expected to be in process for 1 month. The raw materials being fed into the pipeline immediately, and labor and overhead costs accrue evenly during the month. What they are saying, look at this, very, very important. Now look at this. This is a machine, right? This is a machine. Now what they are saying, first, raw material, I had this raw material for 2 months, right? We saw the raw material was remaining as raw material untouched for 2 months. Now what happened? Once this 2 months got over, now I poured this entire raw material into what? Into this machinery. This is where my processing happens. So what happened? This entire raw material, it entered into my machine, correct? Now on this, immediately this raw material will not get converted into an FG and go out. No, it will take 1 month time to convert this raw material into an FG. Are you clear with this? That processing is called as WIP. Now what they are saying is, raw material cost is incurred at the beginning itself. The moment the WIP process starts, entire raw material is poured, correct? But the process of conversion takes 1 month time, or in other words, conversion costs is nothing but your labor and overheads. But the labor and overheads, overnight I will not incur. It incurs evenly during the course of the entire month. That is, I will not be incurring the labor cost and overhead cost in a single day. Every day people will be working, the power will be consumed evenly for the entire month. Only the labor and overhead cost will be incurred, whereas the raw material cost, it is incurred at the beginning of the month itself. Are you clear with this? So can I say this raw material cost gets locked for a period of 1 more month inside this working WIP? Are you clear with this? So can we say, in this WIP, raw material stock gets locked in for 1 more month, correct? Or this is nothing but 1,80,000 is the annual raw material consumption, correct? Into 1 divided by 12. So 1,80,000 by 12, how much is it? 15,000 rupees. So inside my WIP consists of raw material, labor and overheads, correct? So now the raw material sitting inside my WIP is 15,000 rupees. That is 15,000 rupees worth of raw material gets blocked at the time of processing for a period of 1 month. This is the meaning. Are you clear with this? Now WIP is not just about raw material, it is some processing happens, so labor and overheads will also be incurred. Now what they are saying, look at this, please look at this very, very carefully. They are saying wages is generally 10% of my sales value, overheads is 20% of my sales value. Fine. Now in a year, what is the total wage cost that I will be incurring? Can I say it is nothing but 60,000 into 5, correct? 60,000 into 5, this is my overall sales value, correct? On that 10%. So that is 30,000 rupees will be the labor cost that I will be incurring for an entire 1 year, for an entire year. Now, when I am, what are we talking about? Working capital. So we are talking about the amount of working capital investment that we need to bring in. Now, we are not talking about the cost of labor that I'm incurring. We are just saying at the time of actually starting for running my business, how much amount of this particular labor cost I need to bring in. That is the point I'm saying, because in a year there could be many working capital cycle. I'm just talking about one cycle. The requirement of labor costs inside my WIP in one particular cycle is the topic that we are talking about right now, is the particular issue that we are talking about right now. Now, what they are saying is, sir, I need 1 month of wages in advance itself. No, correct, because wages also gets blocked for a period of 1 month. No, this is not like raw material. If you see, on day 1, you incur some wages. Fine. The first day, you don't incur any wages. Actually, the work has not yet started. Day 1, you slowly start incurring some wages. Day 2, you incur some wages. Day 3, day 4, day 5. And the 30th day, you incur the full wages, and the entire WIP gets, or entire raw material gets converted into FG. Or in other words, labor and overheads, unlike raw material, they get accrued evenly during the period of my WIP. Correct or not? Or in other words, at the beginning of this 1 month, I don't incur any labor and overhead costs. Correct? At the end of this 1 month, I incur the entire labor and overhead cost. Correct? For this entire raw material. Or in other words, can I say on an average, can I say 50% is only the amount of cost that gets blocked into my business, and can I say 50% of 1 month, which is going to be 0.5 month. So I need 0.5 months equivalent of labor and overheads to be funded upfront in my business, so that I can smoothly run my operations. Are you clear with this? Because labor and overheads are not incurred at the beginning itself. They are incurred every day. So what we do, since they are incurred evenly, we take a simple average and we say it is not 1 month's requirement, because at the beginning of the period nothing was incurred. At the end of the period, you need to pay the entire labor and overheads. So basically, there is only half months, 50% of the labor and overheads is the funding that I need to bring in. Are you clear with this? And that is what they have mentioned here. It states, so look at this, 30,000 into 0.5 divided by 12. If 30,000 is the labor cost for 12 months, how much will it be for 0.5 months? So how much is this 30,000 into 0.5 divided by 12? That gives you 1250. Similarly, it is for overheads. So overheads is 20% of my overall sales value, correct? So 20% into 60,000 into 5 into 0.5 divided by 12, you get 2,500 rupees. So overall, in my WIP stock, wow, how much in one cycle, in one working capital cycle, in WIP consists of 15,000 rupees worth of raw material, 1250 rupees worth of labor, 2,500 rupees worth of overheads. Overall, your WIP stock, the amount that gets blocked inside your WIP stock is going to be 18,750 rupees. Are you clear with this? Look at this. It is stated that it accrues evenly during the month. Thus, on the first day of each month, why month? Month is because the processing takes 1 month, WIP. It would be 0, and on the last day of the month, it would include 1 month's labor cost. 100% of the cost will be incurred. On an average, therefore, it would be equivalent to half the month's labor cost. So the funding that I need to bring is pertaining to half a month. Are you clear with this? Sir, annually there is 30,000 I need. No, sir, don't worry about this. Once this is for 1 year. I just need to bring for 0.5 months. That is only a part of this particular cycle. Once this cycle gets over, it will generate cash to fund the next cycle. Are you clear with this? So basically, I need to calculate the working capital requirement for one cycle alone. Once you are able to do it, automatically the cycle will keep on running. That's why we are calculating the working capital requirement for one particular cycle. Are you clear with this? Yes. So now with this, we have finished. The amount that needs to be blocked in your working WIP is 18,750. Clear with this, guys? So in raw material, what is the amount that gets blocked? 30,000 rupees needs to be blocked in your raw material. How much amount gets blocked in your WIP? 18,750 gets blocked in your WIP. Now, how about finished goods? They are saying finished goods, 3 months cost of production. That is, after producing, first I had my raw material for how much? First I had my raw material for 2 months, correct? Here, only raw material cost was blocked, correct? Then for the next 1 month, raw material cost plus labor cost plus overhead cost, but labor and overheads were incurred proportionately, that is, they were incurred evenly. So I took only 50% of labor and overheads, correct? Now, after this 1 month, can I immediately realize cash? No. It will enter into my FG area. It will enter into my FG area, and in my FG, it stays for how many days? It stays for a period of 3 months, correct? It stays for a period of 3 months. Am I right? Now, for the period of next 3 months, what is the amount that gets blocked into my business? Material plus labor plus overheads. This time, everything is incurred upfront. That is, I have incurred all material, labor, overheads, the entire amount of labor and overheads also, not 50%. These are completed goods. Now, I don't incur anything now. I just keep it idly for the next 3 months. That is because of my business decision. So why would someone keep it idly, sir? Maybe you should, if you always go to actually some wholesale shop now, they will have some ready stock. Why? Because demand can come at any point of time. You don't know. Fine. So if someone comes and asks you, and if you say, sorry, sir, I don't have stock, then it will not look nice. So you will have 3 months equivalent of every year's sale, 3 months worth of stock you will keep with yourself at any given point of time. That is the meaning of this, correct? So now what is the amount that gets blocked in your FG? Material plus labor plus overheads, everything is incurred now. Then for the next 3 months, I would have paid for my material, labor, overheads, all the costs have been incurred. For the next 3 months, the FG's value is going to be the extra amount that I need to bring into my business, or in other words, now if you see, it's very simple. So now you tell me labor cost, raw material cost is how much? 60% of my sales. Labor is 10% of my sales. Overheads is 20% of my sales. 60 plus 10 plus 20. Overall, can I say the overall cost that I incur, the overall cost for every unit of completed product, can I say is 90% of my cost of sales? Yes. Now, what is my sales value? 60,000 into 5 rupees, correct? On that 90% is the cost I have incurred, correct? So can I say 60,000 into 5 into 90%, 2,70,000 rupees. 2,70,000 rupees is the overall cost incurred for the entire period, correct? But I just need to maintain 3 months worth of stock. Only that gets blocked into my business by way of FG, correct? So 3,70,000 into 3 divided by 12. So how much is this going to be? 67,500. So now for the next 3 months, another 67,500 rupees needs to be introduced upfront into the business. So the working capital, how it works is, for a period of 2 months, the raw material cost gets blocked. For the next 1 month, raw material plus evenly 50% of labor, 50% of overheads. Then for the next 3 months, entire raw material, labor and overheads gets blocked in your business. Are you clear with this? Yes. Now what happens? Now, after this 3 months, immediately you will sell it, and can you get the cash immediately? No. What happens now? Now you tell me. So first, what happened? So here, now raw material, 1 second. So first, raw material, how long it took for raw material? 2 months. Then WIP took 1 month. Then FG took 3 months. Now after this 3 months, will you be able to realize the cash? No. Now you have your debtors, correct? What are they saying? How long will the debtors take to pay this money? They are saying the debtors, the time limit allowed for debtors is 3 months. So for the next 3 more months, I will be having debtors, and for the next 3 months also I will not get back my money. Or in other words, the next 3 months amount should also be funded by me only, correct or not? Now what is the amount that gets blocked for the next 3 months? The value of the goods sold. Yes or no? The value of the goods sold. Now you tell me, for every unit sold, now for every unit sold, what is the sales price? What is the selling price? So for every unit sold, the selling price is 5 rupees, correct? Now this 5 rupees includes profit margin. Yes or no? Now profit, is it an amount that I need to block? No, I'm blocking. What is the amount that gets blocked in my business? Only the cost. Correct? Or in other words, can I say 60,000 units into 5 rupees into 90 percentage is the overall cost that I incur, cost of sales pertaining to the entire year, which is 2,70,000 rupees. Correct? Yes. Now 2,70,000 is the cost of sales made for the entire year. Now I need to fund only to the extent of 3 months in my debtors with respect to my debtors. So 2,70,000 into 3 by 12. So another 67,500 rupees gets blocked by way of debtors. Are you clear with this? Another 67,500 rupees gets blocked by way of debtors, where the total cost of sales is raw material plus wages plus overheads plus opening FG minus closing FG. Here opening and FG, closing FG is not given. We can assume it to be equal. So now your overall value, overall total cost is going to be 2,70,000. This is where I said the format of cost sheet also you can use. Are you clear with this? So now basically what happens? What is the amount that get blocked in your raw material? Now amount that gets blocked in your raw material is how much? Rupees 30,000, right? Yes, the amount that gets blocked in your raw material is how much? Rupees 30,000. Then the amount that gets blocked in your WIP, how much is that? That is going to be 18,750. This also I need to bring into my business initially, 18,750. Then what is the amount that gets blocked by way of FG? 67,500 rupees, 67,500. Then what is the amount that gets blocked as debtors? The amount that gets blocked as debtors is going to be how much? So it's going to be 67,500 once again. It's going to be 67,500 once again. Are you clear with this? Are you clear with this? Now, what happens? Apart from that, okay, let us also say the company requires some cash balance, all of this, fine. Now, what happens? Now, there is an advantage for the company. What is it? Now, their creditors, their suppliers are ready to give 2 months of credit period. Now, their suppliers are indirectly funding my creditors for what? For raw material. They are saying, don't worry, you need not pay the cash immediately. You pay it after 2 months. But till now, what I have done it on the assumption that cash needs to be paid immediately. Based on that, only raw material stock 2 months and all I have taken, correct? So now from this, I will reduce the amount that gets funded, indirectly funded by my creditors. Yes or no? This is indirectly funded. How can you say it's funded? They are not funding in cash. They are funding it in kind. They are giving you the raw material today. They are saying you pay it after 2 months. Are you clear with this? So now what happens here? What is the amount that they are indirectly funding? What is the amount that they are indirectly funding? Very simple. Annual purchases will be what? 60,000 into 5, that is your total sales on that 60%. 60% on my annual sales is the overall purchase, raw material cost, correct or not? Yes, on that 2 months equivalent credit they are giving me. So into 2 by 12, that is indirectly 30,000 rupees of my gross working capital is being funded by my creditors. Are you clear with this? So this 30,000 rupees, I am subtracting it. Why? Because to this extent, my creditors are saying they will finance it for me. This is not a cost. I'm saying about the amount of funding and investment required. Next. Now, they have also said something. What have they said? Look at this. Wages and overheads are paid on the first of each month for the previous month, which means now wages and overheads also these guys are saying, now you need not pay today. This month you extract all the work, you pay it in the first of next month. Or in other words, wages and overheads, we are getting 1 month credit. Outstanding wages, outstanding overheads and all, we are getting 1 month credit, correct? Indirectly, these expenses are also getting funded. Yes or no? Now, wages is how much? Wage cost is how much? 10% of my sales value, correct? So 10% of my sales value into 1 by 12 is the funding. So 10% of my sales value into 1 by 12, this is the amount that is actually being funded. I'm not saying this, they are bearing the cost. No, to the extent of this 2,500 rupees, it is being, these workers are saying we will take it later. That is, you need not pay me every day as and when I work. So I will work for 1 month, you pay me later. Because of this timing difference, I require a lesser funding of 2,500, correct? And then overheads is 20% of my total sales into 1 by 12. It's going to be 5,000 rupees is the amount that gets indirectly funded by way of delay in payment in your overheads. Here it is assumed that the inventory level is uniform throughout the year. Therefore, opening inventory equals closing inventory. We've seen it. Now, statement of working capital requirement. What is the amount that I need to bring in initially itself into the business, and this will enter into the cycle and keep on rotating. Raw material, I need to bring in 30,000 rupees. We have already done this. 30,000. Yes. For WAP, I need to bring in 18,750, FG 67,500, data 67,500. Wait, they have also said at any given point of time, the company should maintain a cash balance of 20,000 rupees, correct, to meet any kind of contingencies. So the gross working capital that the company should meet, that is, they should definitely introduce 2,03,750 rupees. Apart from that investment in all the capital asset, they should have this money to run the show. Are you clear with this? Are you clear with this? Now what happens? Wait. This can be funded by borrowing, or this can also be funded through your current liabilities. So to the extent of current liabilities, how much is getting funded? Creditors are indirectly funding for a period of 30,000 rupees. They are not bearing the cost, since they are saying I am accepting the payment after 2 months. Because of the time gap, you have 30,000 rupees of finance. So from this, I have this gross, this capital assets, that is, sorry, your current assets, your gross working capital has been computed by not taking into account any of these cushions that I have, correct? I'm assuming that the entire payment is being made as and when it is required. But from this, I am now reducing whatever credit period that I can avail. So in the creditors, 30,000 rupees, outstanding wages 2,500, outstanding overheads 5,000. So out of this 2,03,750, inside this, the current liabilities itself is funding me to the extent of 37,500. So now I need to introduce 1,66,250 rupees into my business. Are you clear with this? So now what happens? What happens right now? So 1,66,250. Now what will happen? So I will go to the bank. I will ask them working capital loan I want to the extent of 1,66,250. Let us say the bank is giving, or you can also raise it through any of the long-term sources of finance. You are getting it. Now you will introduce this into your, business, correct? Now, what is the working capital cycle for this company? 2 months, 1 month, 3 month, 3 month, and then creditors give you 2 months credit period, and then your overheads, right? Your labor and overheads, you have about 1 month each. Labor and overheads, you have about 1 month each, right? So basically, what do we have here? 2 plus 1, 3. 3 plus 3, 6 plus 3, 9 minus 3. This is going to be 6 months approximately. Fine, approximately 6 months is your working capital cycle. Now, you will get back this amount after a period of 6 months. Now, when you get back this amount, you will get slightly more than this, slightly more than 1,66,250. Why? Because you will be getting along with the profit, correct? Now, this extra amount, if you want, you can take it out of the cycle. But once again, for the next cycle, you should reinvest 166,250. Are you clear with this? And now what happens? It generates slightly extra than that. It keeps on going like this. Or in other words, in 1 year, in this case, in this example, if working capital cycle is 6 months, in 1 year, you have 2 cycles, correct? In a year, you have 12 months, and one cycle is for a period of 6 months. So in this case, in a year, you can have 2 working capital cycles. Are you clear with this? Are you clear with this? And then what happens? Since I'm able to generate more than the amount that I have actually invested. So what happens? This extra money that I have, using this, I can service my loan also and balance whatever money I have. I can use it as my profit. Are you clear with this? So this is the main reason why companies or the economy itself is thriving. Without working capital borrowings, without working capital funding, no company can work. The banks are happy because they earn interest. Now, these companies are happy. The company, the businessmen, they are also happy. The entrepreneurs are happy because they get the money, right money in the time, so that they are able to run the show. And then whatever profit that they generate out of that, they pay the interest balance amount, they enjoy it for themselves. And this cycle keeps on going forever, till the time the company permanently shuts down. So this amount which they are borrowing as working capital, this cannot be repaid after one cycle because it gets reinvested. So permanently this will remain in your business, correct? And every time parallelly, you will also be servicing the loan by way of paying an interest. Are you clear with this? This is a very, very important understanding of working capital. So you cannot just directly jump into this and say, okay, current asset minus current liability, that's all. No, you need to understand under each components of current assets, how much is the amount that gets blocked. We are not calculating the cost. We are taking the annual cost. On that, we are saying in one cycle, how much is the amount that gets blocked. So we are trying to find out how much is the amount of working capital investment required. To that extent, I will have to finance it. Are you clear with this? So this is the overall story about this working capital initial, the first unit of working capital management. So with this, we have finished the first part, which is the most important part, which is introduction to working capital management. So now let's go to the second unit, which is treasury and cash management. Now let's get into the second unit of this particular chapter, which is treasury and cash management. Now, what does this area talk about? This talks about how well you're going to manage your cash. This exclusively talks about the cash component. Cash, by cash, I mean cash or bank. Clear? Fine. So this cash and bank is one of the items in your current assets. So we are just going to see how this cash and bank should get managed. So basically, they have given a lot of theoretical part in this, but of course, we'll be doing a comprehensive numerical problem in this particular area as well. So you should ensure that basically with respect to cash management, remember that you should not have too much of cash balance. You should not also have too less of a cash balance. Why? Too much of idle cash is a waste. Correct? Funds idly you are keeping it, which means what? It comes with a cost. It does not come free of cost. Correct? So too much of idle funds increases your cost, whereas too less of funds is also bad. Why? It affects your liquidity. Whenever you have to make some payment, you need to make it, else it affects your reputation, it affects your business. So you should have adequate and sufficient cash balances. Are you clear with this? So now how will I control this? How will I maintain a control over this? Generally, companies prepare something called as a forecast or a budget. So this is what we are going to see in the next illustration. So this illustration, I have actually taken this from ICAI study material only. So let's actually jump to ICAI study material. So and have a look at this particular problem. It's on page number 10.52. So in case you are from the new syllabus, don't worry, this exact sum is also there in the new syllabus study material for May 2024 and onwards. This sum is there, a very, very good problem. See, the thing is actually this sum looks big. The question itself looks very big. See, it runs into 2 pages, just a question. Fine, but the solution is just 1 page. Now, many students, they don't have this energy to read this question. They feel it's very big, it's very difficult. No, big doesn't mean difficult. Now, for you to crack this sum, you don't even need to know anything related to financial management. You just need to have some common sense and logic. So I will just read out the question for you. And then this question, I will tell you how to approach this in the exam. Mark this as important. This question can be tested. Prachi Limited is a manufacturing company producing and selling a wide range of cleaning products to wholesale customers. The company has 3 suppliers and 2 customers. So this company, Prachi Limited, they have 3 suppliers, 3 creditors they need to pay, and they have 2 debtors. They will receive money from 2 people. Correct? Prachi Limited relies on its cleared funds forecast to manage its cash. What do you mean by cleared funds forecast? What do you mean by that? Now, let us say I am depositing a check in the bank. In my bank account, I am depositing a check today. Correct? Now, for the check to be cleared and for my bank account to be credited with the money, let us say it takes 2 days. Correct? Now they are saying they will prepare all this cash budget and cash forecast only when the check gets cleared and when my bank account is reflecting the amount. They will not actually account for it, or they will not prepare, or they will not plan their budgets based on whenever they are receiving the check or whenever the transaction is happening. They will actually consider this transaction has happened only when the bank accounts gets debited or credited, or in other words, only when the amount reflects in my bank account, in my bank statement. only then based on that only they prepare their cash budgets and all. This is what they are saying. That is the meaning of cleared funds forecast. Are you clear with this? You are an accounting technician for the company and have been asked to prepare a cleared funds forecast for a period of Saturday, that is 7th August, to Wednesday, that is 11th August. So 7, 8, 9, 10, 11. So what we need to do, we need to prepare a cleared funds forecast. That is the cleared cash budget, cleared cash and bank budget for each of the 5 days that they have asked us to do. Are you clear with this? Very simple, no? That is, when will you actually consider things in your budget? Receipts minus payments, that is going to be your excess or your deficit cash, correct? So when will you do this? You will account for it in a particular day only when your bank account is actually reflecting this particular transaction. Yes, very simple. Now, you are provided with the following information. So basically what we need to do, we need to prepare a cash budget for each of these 5 days. But remember, there is only one condition here. What is it? You should record this particular transaction only when your bank statement reflects it. So now basically, just look at this. So what they have prepared, they have prepared the cleared funds forecast for 7th, 8th, 9th, 10th and 11th. For each of these 5 days, they have prepared a forecast. Look at this. Receipts they have, minus payments they have, and you will have what? You will have the excess of cleared excess receipts over payment, that is A minus B. You have this. Now you need not know anything here. Why am I saying this? In this particular question, what we will do, since the question is big, as and when we read a particular line item, we will go and fill up this particular column. Are you clear with this? In exam, you also follow this. First, you prepare this template and you just go on. It's nothing but preparing a cash budget for each of the 5 days. But the only condition is you can record the transaction only when it reflects in your bank statement. We will see what it is. Now, first, receipts from customers. The company has how many customers? We saw 2 customers, correct? Right. Carefully listen. We are preparing this budget for 7th, 8th, 9th, 10th and 11th of August, correct? These are the 5 days. So only the banking transaction that happens for each of these 5 days should be accounted by us. Clear? So now what happens here? Look, now W Limited is whom my customer, Prachi Limited's customer. The credit period that I am giving for W Limited is 1 calendar month, correct? And for X Limited, there is no credit period, which means immediately they need to pay. W Limited generally makes the payment through a mode called BACS. It is like NEFT, IMPS, like that. BACS is one payment method. You need not know all this. They themselves have given. BACS stands for Bankers Automated Clearing Service. And it is instantaneous, meaning what? The moment they make the payment, it will immediately come to my bank account. Are you clear? The moment my customer initiates the payment from his bank account, it will be credited instantly in my bank account. There's something similar to your GPay or IMPS. Immediate transaction will happen. Now, what they have given, the sales value made on 7th of August is given. The sales value made on 7th of July is also given. Are you clear with this? Now, for W Limited, you tell me 1 month credit period we have, or in other words, during this period, I am preparing budget only for 7th, 8th, 9th, 10th, 11th of August, correct? Now, during this period, you tell me which is the amount that I will be receiving. They have 1 month credit period. So basically, this 1,30,000 of sales made 1 month before, I will be receiving it on 7th of August. Correct or not? How much is the amount I will be receiving this 1,30,000 rupees today? Yes or no? So basically, what we can do, we can immediately go to this statement and fill this up. W Limited on 7th August, you receive how much? 1,30,000 rupees. Are you clear with this? Fill it up then and there. Then now go up. Now, X Limited, there is no such thing called as credit period, which means immediate payment they need to pay. Now, what happened? 7th of July sales they have given. 7th of August sales they have given. Here, 7th of July, 1 month credit and all is not there. This is not at all relevant. Why? Because it is outside my budget period. Now, this sale of 1,80,000, this is relevant. Now, what they are doing, So if I am making the sale on 7th August, on 7th August itself, X Limited is giving me the check. Are you clear with this? But wait, what happens here? X Limited's check will be paid into Prachi's Limited bank account on the same day. I will deposit the check the same day, but it will clear on the third day following the payment. Now, what happens here? If on 7th August, if they deposit the check, leave 7th August, 8th, 9th, only on 10th, this 1,80,000 will reflect in my bank statement, correct? So now what I will do here, I will go here and I will put it as 7th, nothing will happen, 8th, 9th, nothing will happen. On 10th only, this amount of 1,80,000 gets cleared in my bank account. That's why we call it as cleared fund forecast. Are you clear with this? Which means for the period of these 3 days, 1.8 lakhs remains uncleared. Yes or no? For the period of these 3 days, yes, I have received, that is, I would have accounted it in my cash book, but ideally I have not yet, this has not yet been reflected in my bank statement. Or for these 3 days, 7th, 8th and 9th, this 1,80,000 is an uncleared amount, correct? Yes, so they are parking it under uncleared funds. They are saying for the first 3 days, this 1,80,000 remains to be uncleared. Are you clear with this? So in this question, they have also asked us to prepare this uncleared funds. So we are actually mentioning that, we are mentioning it properly here and there. So what we are doing, for a period of the first 3 days, this 1,80,000 rupees remains to be uncleared. Are you clear with this? Yes. Next. What is the next transaction that they have mentioned? So this is about your receipts from customers. Next, payment to suppliers. We have 3 suppliers, right? These are payments. A Limited, B Limited, C Limited. A Limited, if I make the purchase today, I can pay him after 1 month. B Limited, if I make the purchase today, I can pay him after 3 months. C Limited, no credit, which means I need to pay immediately. Now, payment methods are not given. For A Limited, standing order, B Limited, check, and C Limited, check, right? Now, look at this. A Limited, 1 month is the credit period, correct or not? Which means the purchases that I made 1 month back, I will be paying it today, correct? Now, we are preparing budget for what period? 7th to 11th August, correct? So between 7th to 11th August, which payments will come? The purchase made on 7th of July, correct? Or in other words, this 55,000 rupees, yes or no? So this 55,000 rupees is actually the amount of payment that comes into, 1 second. So look at this. This is 1 calendar month, right? This is 1 calendar month. So basically on 7th of August, what will be the amount that they will be paying? So what happens? What is the relevant purchases that I will be making? So that is the 1 month before, whatever was the purchase, 55,000 rupees that I need to pay. Correct or not? But wait. Read this along. Prachi Limited has set up a standing order. Standing order means what? They have given an instruction to the bank for 45,000 rupees a month to pay for supplies from A Limited. So Prachi Limited has told their bankers, they have told, look, every month pay flat 45,000 rupees on 7th of every month you should pay, correct? This payment will leave the Prachi's bank account on 7th of August. Every few months an adjustment should be made, and this adjustment is not made during this period. So technically, from a cash flow perspective, during the time that I'm mentioning, 7th, 8th, 9th, 10th, 11th, during these 5 days, what is the amount of payment that goes from Prachi Limited to A Limited? It is not 55,000. It is 45,000 rupees only. Sir, how is it enough if I pay 45,000? The adjustment, the difference amount, they will pay it later. That adjustment does not happen during our budgeted period. Are you clear with this? So technically speaking, what happens here? Only 45,000 rupees moves out of my bank account, but it happens instantaneously. Are you clear with this? So this standing instruction, standing order of 45,000 rupees, it gets debited on what date? On 7th of August. So 7th of August, the amount that gets paid to A Limited is 45,000. So immediately go down and write down 45,000. Be very careful. It's not 55,000. 55,000 is actually the purchases made. Correct, 1 month. That's what we will think. But look at the wordings. They have given some standing order and all. So whatever is the amount that they have told their bankers to pay, that amount will only move out of their bank account. Are you clear with this? Yes. Then what happens? Now, Now B Limited, check payment. So now what have they said? Prachi Limited will send out by post the checks to B and C Limited on 7th August. The amounts will leave its bank account on the second day following this day of posting. Now what they are saying, now B Limited gives us 2 months credit period. So now what they are saying, so the purchase that I have made 2 months before, that will be paid today in 7th of August, correct? The purchases made on 7th of June will be paid today on 7th of August, right? Then for C Limited, no credit period, which means the purchases made today on 7th of August, that will only be paid today. Are you clear with this? So now this 75,000 and this 95,000, the checks will be posted on 7th of August, correct? Now what they are saying, will it be immediately debited, reduced from my bank account? No, they are saying it will be the amounts will leave their account on the second day following the day of posting. So on 7th day post, 8th, 9th, on 9th, this two amounts, 75,000 to B Limited, 95,000 to C Limited, these two amount will actually be what? These two amounts will be debited only on 9th. That is, it will reduce from my bank balance only on 9th. So I will issue the check on 7th, but this amount 75,000 and 95,000 respectively will be reduced from my bank only on 9th. Are you clear with this? So what we will do, so on 9th, 75,000 and 95,000 is a payment that we are making, but this was initiated on what? On 7th. So 75 plus 95, how much is this? 1,90,000. This 1,90,000, sorry, this is 1,70,000. This 1,70,000 remains to be an uncleared amount for the first 2 days. On 7th as well as on 8th, 1,70,000 remains to be what? Uncleared. It has not yet gone out of my bank account, but I had posted it in my books of accounts as a payment. Are you clear with this? This 300 we will come to it. Maybe some other payment is there that needs to be added. Are you clear with this? So this 1,70,000 remains to be uncleared for the 2 days since the check got issued. Next. What is the next thing that they have mentioned? Wages and salary. For the month of July, for the month of August, weekly wages 12,000, 13,000, monthly salaries 56 and 59. Read this immediately. The factory wages are paid in cash wages weekly. They will be paid 1 week's wages on 11th of August for the last week's work done in July. So basically, this 12,000 rupees weekly wages will be paid on what? 11th of August. Are you clear with this? It will be paid in cash. So obviously the amount will go out of their funds immediately. So 12,000 rupees will reduce on 11th of August. So just go down and say 12,000 rupees will be reduced on 11th of August. It comes under payment. Are you clear with this? Then what about the next figure? What about the next one? The office workers are paid salaries on a monthly basis under BACS. BACS is what? That instant automatic payment. Salaries for the month of July will be paid on 7th of August. So this 56,000 rupees will move out of my bank account on 7th of August, correct? So now on 7th of August, 56,000 rupees will move out of my account by way of what? By way of salaries. Are you clear with this? Yes. Then the next one, other miscellaneous expenses. Every Saturday evening, the petty cashier withdraws 200 rupees from the company's bank account for petty cash. The money leaves Prachi's bank account straight away. So basically, Saturday evening, when is the Saturday coming here? 7th. Every Saturday, the petty cashier is withdrawing 200 rupees from the account. So immediately it gets reduced. Are you clear with this? Yes, this 200 rupees gets reduced every Saturday. Right? Fine. That's a payment that goes out. Now, the room cleaner is paid 30 rupees from the petty cash every Monday morning. Very important. Now, what is this? Now, this petty cash 200 rupees is withdrawing and keeping with the cashier. Correct? I have reduced this 200 from my funds. Now, from this 200 that the cashier has in his hands, out of this he is paying 30 rupees, 20 rupees, whatever it is. Now, this will not impact my bank balance. Why? Already I have withdrawn 200 rupees. Out of that only I am spending something. So obviously it will not impact my bank account now. When I withdraw 200 rupees, that will impact my bank account. From the amount withdrawn, if I am spending it, how will it impact my bank account? Are you clear with this? We are calculating the cleared funds forecast. Are you clear with this? Yes. Next, stationery will be ordered by telephone on Sunday, 8th August to the value of 300 rupees. This is paid for by the company using their debit card, and such payments are generally seen to leave the company account the next working day. So on 8th August, I made a purchase of stationery to the extent of 300. But when will it impact my bank account? 9th August only. So what happens? On 9th of August, there is a payment of 300. But wait, this payment was initiated on 8th. So on 8th, it remains to be what? It remains to be uncleared payment. That is why here the total uncleared payment is 1,70,000 plus 300. Are you clear with this? Are you clear with this? Yes. So this is the meaning of it. This is the meaning of this. Next. 5 new softwares will be ordered over the internet on 10th of August at a total cost of 6,500. A check will be sent out on the same day. The amount will leave Prachi's bank account on the second day following the date of posting. So if I make the payment on 10th, that is if I issue a check on 10th, 11th, 12th, only on 12th, it will move out from my bank account. Now, you tell me, I am preparing this budget only up to 11th. Correct. So basically it will not impact my budget for a period of 7th to 11th August. Are you clear with this? So basically it will not impact my clear funds for up to 11th August. Correct. Because the amount gets reduced from my bank account only on the 12th. Yes, but wait, the 6,500 rupees was a transaction initiated on 10th. So for 10th and 11th, this amount of 6,500 rupees remains as an uncleared fund that got uncleared fund payment. Yes or no? That is one uncleared payment. So this 6,500 rupees remains as an uncleared payment for the last 2 days, that is 10th and 11th of August. Are you clear with this? Yes. So this is what they have given. And then the balance of Prachi's bank account will be 2 lakh rupees on 7th of August. Opening balance is 2 lakh rupees. This represents both the book balance and the cleared funds. Prepare a cleared funds forecast for a period of Saturday, 7th August to 11th August, inclusive, using the information provided. Show clearly the uncleared funds float each day. So day wise, we have seen how much amount has received, how much amount has been paid. So every day, we are just calculating the difference between the two. So 1,30,000 minus 1,01,200. So excess amount, how much? Day 1, that is on 7th of August, I have how much excess? 28,800. The opening balance is already 2 lakhs. This is given in the question. So the cleared closing balance is 2,28,800. Yes or no? Now this closing balance will become the opening balance of the next day. In the next day, there is no receipts, no payments, no transactions. So that will automatically become the closing balance. Fine. This closing balance will become the opening balance for the next day. Yes. In the next day, what happened? There was no receipts, but there was only payment of 1,70,300. So minus 1,70,300, the closing balance will be 58,500. This 58,500 becomes the opening balance for the next day. In the next day, if you see, there is only a receipt and no payment to the extent of 1,80,000. So 1,80,000 plus 58,500, the closing balance for the next day is going to be 2,38,500. This becomes the opening balance for the last day, 11th August. So now for the last day, if you see, no receipts but only payment. So minus 12,000 is the amount that has gone outside the bank account. So 2,38,500 minus 12,000. So the clear fund balance as on 11th August, the last day, is going to be 2,26,500. Are you clear with this? And then the uncleared float also we are actually tracking here. 180 minus 170. So on the first day, you have 10,000 rupees of uncleared float. Second day, 9,700. The third day, 1,80,000. On the fourth day, minus 6,500. Sixth day, minus 6,500. What is the meaning of all this? To the extent of net amount of 10,000 rupees, net amount of 10,000 rupees. So I am yet to receive. That is the transaction has been initiated, but my bank account is not yet credited with respect to 10,000 rupees. It is uncleared fund. Are you clear with this? Uncleared fund. Then on the second day, if you see, still I am yet to receive 9,700 rupees. It is a transaction that has been initiated, but it has yet to be reflecting in my bank account. Then on the third day, if you see, 1,80,000 rupees I am about to receive, but it is not yet reflecting in my bank account. On the fourth day, if you see, actually 6,500 rupees of payment I should have made, but it is actually, the payment was initiated, but it is not reflected in my bank statement. And on the 5th day also, the same 6,500 rupees of transaction which was initiated but still not reflecting in my books. This is only being mentioned here. So this is actually, these amounts are recorded in my books, but they are not reflecting in my bank statement. This is similar to the BRS that we do. So the clear funds plus the uncleared funds gives you the total book balance. So 2,28,800 is the actual balance that I have in my account, plus 10,000 rupees. I know that I will be receiving it in the next 1 or 2 days. That's because of my clearing difference and all. So the total book balance is this cleared balance plus my uncleared fund float. It's going to be 2,38,800. Here it's going to be 3,38,500. 2,38,500, 238,500. Look at this. For the 4th and 5th day, I have a cleared balance of 2,38,500, but I am about to pay 6,500. I've initiated the transaction, which is not reflected in my books. So the net balance is only 2,32,000, and on the last day also the balance is 2,20,000. Are you clear with this? So basically the sum is actually easy, provided you know what you are doing and how you do it. So there is actually a way in which you do the question. So once you read this question, what you can do is quickly give it a glance once and then prepare this template. As and when you read a paragraph fully, just go and do the posting, so that by the time you finish reading the question itself, you will be done with about 80% of the problem, and this entire sum will be over. Clear with this? If at all this comes, this can come for a 10-mark question. And this is nothing but logic, common sense. Just because the sum is big, some students find it difficult. So please don't fall into the trap of feeling that this sum is difficult and all. It's pretty much a straightforward question. Are you clear with this? Are you clear with this? Yes. So with this, we have finished the cash management. Of course, in cash management, it's more to do with how do you manage your cashes and how do you manage your cash and all that. Fine, there are also different, a few other problems, but in this marathon, I wanted to cover the important aspect that is covered in our cash management. So that is what we have seen now. So now let's move to the next unit. Let's now move to the next unit. So now let's move to the third unit in this particular chapter, which is inventory management, right? So technically this segment of the chapter is actually covered in costing. It's covered in your cost and management accounting. There is a concept called as EOQ, economic order quantity, and there is a concept called as stock levels. Okay, so EOQ actually is nothing but how much quantity should I place an order for. So every time I place an order from the supplier, how many units I should place an order for. And the stock levels has something like minimum level, maximum level, reorder level. Reorder level means when I should place an order. EOQ stands for whenever I'm placing an order, for how much quantity I should place an order. Now, why are all these things coming under working capital management? Because this squarely comes within the ambit of inventory management. Now, similar to any other component of working capital, inventory, we should maintain adequate inventory. We should not have too much of inventory. Why? If you have too much of inventory, you are actually blocking your funds on idle inventory. Inventory is a dead stock, correct? If you have too much of non-moving stock, it means that you need to bring in more capital, and every rupee that you bring into the business for your working capital, it has a cost associated with it. It should also not be too less. Why? If it is less, then you will run out of your orders. So whenever you're getting an order, since if you don't have the stock, then you will not be able to produce the products, because if your raw material, you don't have the stock, how can you start your production and honor your commitments? Are you clear with this? So basically, you should not have too much of stock. You should also not have too less of stock. There should be an optimum stock that you need to maintain. Are you clear with this? So that's why they've also given inventory management has been discussed in detail in chapter 2. That is material cost chapter. Clear? So now we will just do one question in this particular area. Technically, it is covered in costing, nothing related to your financial management. It's covered in costing, but anyways, I will just do the sum just so that you can get a hang of it. Now, problem number 3, Marvel Limited uses a large quantity of salt in its production process. Annual consumption is 60,000 tons over a 50-week working year. So every year they are consuming 60,000 tons of salt. It costs 100 rupees to initiate and process an order, and the delivery follows 2 weeks later. So if I place an order today, after 2 weeks only the delivery will happen. Storage cost of the salt are estimated at 0.1 rupees per ton per annum. And so this is basically your carrying cost. Yes, this is basically your cost of holding it, holding cost or carrying cost, right? The current practice is to order twice a year when the stock falls to 10,000 tons. Identify an appropriate ordering policy for Marvel Limited and contrast it with the cost of the current policy. Now, there is a concept in material cost called as EOQ, economic order quantity, right? Now, in case you do not know this, you can refer the costing marathon video that we have uploaded. In that, in part 1 itself, I have discussed in detail about this material cost concept. You can just go and watch it. It's available on YouTube on our channel, right? So now in this EOQ, we would have learned what do you mean by EOQ? Economic order quantity. How many units should I place an order for so that my overall cost is kept minimum? The logic for this formula and all is explained. So the EOQ is actually root of 2 into A into O divided by C, where A stands for annual raw material consumption, that is 60,000 tons, correct? O stands for ordering cost per order, that is rupees 100, and C stands for carrying cost per unit per annum, which is rupees 0.10. So how many units should I place an order for? Root of 2 into A, that is annual requirement, 60,000 into O, 100 divided by 0.10. So if you calculate this, you will get how much? 10,954. So it is the best optimum quantity is actually 10,954. So every time you place an order, you should place an order for how many tons of raw material? 10,954 tons of raw material, which means in a year, how many number of times you will order? Overall, I need 60,000 tons. Every time I am placing an order, I will place an order for 10,954 tons, which means in a year, I will place an order for representatively 5.5 times. So the number of orders that happens in a year is 5.5 times. Are you clear with this? Yes. Then. Now, what is your reorder level? What is your reorder level? So basically, what do you mean by reorder level? So reorder quantity, that is EOQ, stands for how many kgs to order, whereas reorder level means when to order, correct? So reorder level is nothing but, so what is your reorder level? So reorder level is your lead time into consumption per day or per week of lead time, correct? Yes, all these things are covered in costing actually, right? So what is the lead time that it generally takes here? What is the lead time that he generally takes? He takes, if I place an order today, it takes him 2 weeks to deliver the product. Yes or no? So they have given it here. So it takes 2 weeks to deliver the product. Yes. So it takes 2 weeks to deliver the product. And what is the consumption per week? So 60,000 is the annual consumption, and in a year there are 50 weeks. So basically I should make sure that the moment my stock touches this level, I should pick the phone and place an order for how many kgs? For 10,954 kgs or tons. Are you clear with this? So what is the reorder level? The reorder level is 2,400. So what do you mean by 2,400? The moment my stock balance is reaching at 2,400, I will pick the phone and I will place an order for 10,954 tons. Are you clear with this? And when we do this, automatically your overall cost will be minimum. This is what the concept of EOQ says. So the total cost at optimum policy. Optimum policy means what? If your order quantity is at EOQ, that is 10,954. So what is your total cost? Total cost is holding cost plus ordering cost. So what is your holding cost? So holding cost is nothing but average inventory into C, that is carrying cost per unit per annum. Yes or no? Now average inventory, what is the average inventory that you will keep? What is the average inventory that you will keep? Average inventory, now if you see here, at every point of time, see, if you place an order, you will get for 10,954 units, correct? So by the time it reaches the delivery, by the time the supplier delivers your product to you, again you will get this 10,954 units. Or in other words, at one point of time in a period, there will be 10,954 kgs in your tons sitting in your warehouse. At some point there will be zero, so the average inventory will be half of 10,954. Yes, or in other words, half of order quantity, half of EOQ is your average inventory. So 1 by 2 into 10,954. This is going to be your average inventory into carrying cost per unit per annum. It is going to be how much? Into 0.1. Are you clear with this? So this is going to be your overall holding cost or carrying cost. So 0.1 into 10,954 divided by 2. Why this divided by 2? This is nothing but average inventory into carrying cost per unit per annum. Then what is your ordering cost? Ordering cost per order into number of orders. So what is the number of orders? Annual requirement, that is, I need 60,000 tons every year. Every time I place an order, I place an order for 10,954 tons. So which means 60,000 divided by 10,954. I am placing 5.5 orders in a year, and every time I place an order, I incur a cost of 100 rupees. Yes or no? So basically the ordering cost will be 100 into 60,000 divided by 10,954. So basically it is going to be 547.7 plus 547.74. So your overall cost is going to be 1,095 if you are maintaining, if you are placing an order at your economic order quantity level. If you are following the economic order quantity, your overall cost will be 1,095. Are you clear with this? Now what they are given, currently what the company is doing, the company is only ordering twice a year, and that too when the stock balance falls at 10,000 tons. So which means twice a year, which means every time they place an order, in a year they place an order only 2 times. So every time they place an order, they place an order for how many tons? 30,000 tons. Yes or no? So in one order there is 30,000 tons, and like that in a year they are ordering twice. Correct? Yes. So now are they following the EOQ? No. EOQ says every time you place an order, you should place an order only for 10,954 tons. Correct? Whereas they are placing an order for 30,000 tons. So obviously, since they are deviating from EOQ, they will be incurring more cost. This is what we saw in material cost chapter, right? That is exactly given. Nothing new that we are learning. Every single thing is the same. So now what they have given here. So to compare the optimum policy with the current policy, the average level of stock under the current policy must be found. Why we should calculate the average stock under the current policy? Yes. Now, what is my holding cost and what is my ordering cost? Holding cost is average inventory into carrying cost per unit per order. What is my ordering cost? Ordering cost is nothing but number of orders in a year multiplied by ordering cost per order. Yes or no? Now holding cost is average inventory into the carrying cost per unit per annum. What is the carrying cost per unit per annum? The carrying cost per unit per annum is 0.1. Now you tell me what is going to be my average inventory. Now what they are saying is, look at this. I will place an order every time my stock reaches 10,000 tons. Correct? Right? So I will place an order every time my stock reaches 10,000 tons. Yes or no? My stock reaches 10,000 tons. Now it takes 2 weeks for the person to deliver it. Yes or no? So before the delivery happens, so I will pick the phone call, and the moment my stock balance is 10,000, I will pick the phone call. By the time he delivers, my stock balance will be reducing by how much? So 2 weeks consumption. Every week, in a year, I will consume 60,000. In a year, I will consume 60,000 tons, which means on an average, every week I will consume how much? 60,000 divided by 50, right? Like the 2 weeks it takes. So 60,000 divided by 50 into 2. So by the time the delivery happens, I would have already consumed how much? 2,400 tons. Yes or no? Yes or no? So technically at the time of delivery, my stock balance would have reduced to how much? 7,600. Yes. Now this guy is going to deliver How many kgs? 30,000 kgs. We just found out they are going to place an order only for two times in a year. So 30,000 kgs. So now the stock gets replenished by 30,000 kgs. So what is the maximum stock that you will be having? 7,600 is the minimum stock. What is the maximum stock? It's going to be 37,600. Yes, because plus 30,000, it's going to be 37,600. So the average stock will be the maximum stock plus the minimum stock divided by 2. So your average stock is going to be how much? Your average stock. That is a simple average way of computing, or you can also do it as minimum stock plus 1 by 2 of order quantity. I told you there are two formulas to calculate average stock. In costing we have seen. Yes, so what are the two formulas to calculate average stock? One is actually a simple average, that is minimum plus maximum by 2. That is arithmetically correct but practically not correct. Whereas the other formula is very logical. Minimum plus EOQ by 2. That is the stock fluctuation will happen only above the minimum level. So you take the average of my EOQ. So what is the EOQ? In this case, order quantity. What is the order quantity? 30,000. So 30,000 divided by 2 plus the minimum stock of 7,600. So the average stock gives you 22,600. So 22,600 into 0.1. This is going to be your overall carrying cost or holding cost. Then what is going to be your ordering cost? It is going to be number of orders, that is 2 into ordering cost plus per order. So the overall cost, if I am placing an order twice in a year, is going to be 2,460. Whereas if I follow EOQ, it is just going to be 1,095. So how much extra cost I am incurring because I am deviating from EOQ? So the difference between that 2,460 minus 1,095. So that gives you how much? 1,365 rupees per year. So every year I am incurring an extra cost of 1,365 because I am deviating from my EOQ. So it is better to follow EOQ. Are you clear with this? Technically, this entire discussion is not even pertaining to financial management. It is exact copy paste of your costing. In fact, in the new syllabus, what they have done is, so in the old syllabus, at least they had mentioned all these things and they had given some illustration. In new syllabus, what they have done from May 2024 onwards, they have just mentioned in a single line, they have mentioned refer material cost chapter in your costing. So this is nowhere, they have not mentioned separately things here. They have just said refer that costing syllabus. So they have just mentioned this as unit 3 management of inventory. Refer your costing syllabus, your material cost chapter. That's all they have done. They have just mentioned this part alone. Are you clear with this? In old syllabus, at least they have just mentioned a few things and given a few illustrations. That doesn't mean that these questions will not be tested. So please have that in your mind. This is equally applicable for new syllabus students as well. Clear? So with this, the small area inventory management is also over. Now, let's get started with the unit 4 in this working capital management chapter, which is management of receivables. So basically, receivables stands for what? Your debtors. Predominantly, it stands for your debtors. Of course, bills receivable also, right? So the people who owe some money to the firm, to the particular company, is called as what? They are called as debtors or receivables. Now, what is the point here? What is the point of discussion here? Now, there is some money that gets blocked in this debtors category. It is a part of current assets. I am making the sale today, right? But let us say I am getting the payment after 2 months. I'm getting the payment after 2 months. So for this 2 months, there is some amount that gets blocked by way of debtors, correct? So now this needs to be taken care of by the company. Right? So what they can do is they can have a look at their credit terms. They can have a look at their credit terms and they can be more cautious about it. Now, what they can do is they can maybe give a credit term of 3 months, or maybe they can give a credit term of 2 months, or they can maybe give a credit term of 1 month, as the case may be. So they can evaluate whichever option is the best for them. So what is there in evaluating this? If you give more credit term, what will happen? The chances of your sales will be more. More people will be willing to buy from you. But what is the problem if you give more credit term? The chances of bad debts is also more. Why? Because now they are taking more time. People are coming to you because you are giving more time. These people can be intentional defaulters also. The chances of bad debts is more. That is number one. And also more the credit period, now more will be the amount, funds blocked in it by way of working capital, and hence the cost associated to working capital will also be more. So basically, if you increase your credit term to your debtors, the advantage is you can improve your sales, but the disadvantage is the chances of bad debts will be more. Also, there will be a cost associated with the funds that get blocked, more the credit period, more the capital that gets blocked under working capital. Are you clear with this? So what the company needs to do, they need to do some cost benefit analysis for each of these things, for each of the methods, for each of these three proposals, in our case the three proposals, and they can find out whichever is that method that gives them the maximum net benefits. They can go for that particular option. Are you clear with this? So aspects of management of debtors, basically it's about the credit policy. Fine. What is the credit terms I should give them? 1 month or 2 month or 3 month, as the case may be. Credit analysis, that is at the time when I am choosing my customer, I should see whether this guy is going to repay me or not, whether he is credit worthy or not. The credit worthiness should also be seen. This involves due diligence or reputation check of the customers with respect to the credit worthiness. Are you clear with this? And then control of receivables. You should have a dedicated team to follow up on the payments and all that and ensure that this guy makes the payment on time. Are you clear with this? So following up with the data and all that. Now, in this context, there is a very interesting area called as factoring. There is an interesting area called as factoring. Sir, what is this concept of factoring? Now, let us say a company A Limited, there is a company A Limited, they have sold some goods on credit to a customer. Right? The credit period is, let us say 3 months. Now, A Limited, what they need to do, they need to wait for 3 months. At the end of 3 months, this customer will pay to A Limited and this transaction gets complete. There is an other alternative. What is the alternative? This is kind of similar to that bills discounting. But here it is not a bills receivable, it's a normal debtor. Okay? It can also be a bills receivable. Now, what this A Limited will do, it made the sale today. Immediately today itself, it goes to a person called as a factor. What this guy will do is, he will say, I am ready to buy your debtor, and he will pay A Limited an upfront amount. He will pay A Limited an upfront amount, but he will charge some commission. This is similar to the discount that banks will charge. Why is he charging a commission? Because later on this factor, he will go and collect the payment from the customer. So the customer will now not make the payment to A Limited. The customer will make the payment to factor, but after 3 months. But this factor pays A Limited today itself. So he is technically funding A Limited for the next 3 months, for which he charges something called as a commission, and this concept is called as factoring. Now, every time when there is actually a debtor and when you have a possibility of factoring, you should see whether this factoring is beneficial for you or not. Sir, how does factoring benefit me? Sir, always I should pay this guy a commission. Yes. But what happens is, you need not incur some administrative cost with respect to following up with the customer. You need not have a separate team to actually go and follow up with the customer and all that. All these things, this factor will take care of. Are you clear with this? In fact, at times, the factor will also take care of the risk of the bad debts. Suppose there is any bad debts, this factor himself will bear it. He will not pass it on to A Limited. Accordingly, his commission will be more. So if the factor is bearing the bad debts, it's called as a non-recourse factor. So if the factor is not bearing the bad debts, he says, no, if there is a bad debt, then I will catch A Limited. It's called as a recourse factor. So non-recourse factor will bear the bad debts. Obviously, more the risk, he will expect more commission and all that. Are you clear with this? And this concept is very similar to the bills discounting. Instead of this factor in bills discounting, we have the bank which discounts the bill upfront. Instead of paying 100 rupees, they will pay 90 rupees to the A Limited, and they will recover 100 rupees after 3 months. Something like that. Yes. So this difference is the earnings for the factor, but they are taking the risk of what? They are taking the risk of the bad debts in case they are a non-recourse factor. And one more thing is that they take care of all the administrative costs with respect to collecting the money from the debtor. Are you clear with this? In this context, we should see whether it is worthwhile going for the factor or not. So that is what we are going to discuss in this segment. A factoring firm, question number 4, a factoring firm has credit sales of 360 lakhs, right? And its average collection period is 30 days. So what they are saying, this is actually not a factoring firm. It's a normal firm, okay? It's a normal company. They have credit sales of 360 lakhs in a year, and its average collection period is how much? 30 days. So in a year, they have how much sales? 360. So what is one operating cycle's debtors value into 30 divided by 360? So can we say that in one cycle, they have a debtor balance of 30 lakhs, or in other words, the amount that gets blocked by way of debtors is going to be 30 lakhs for this company. The finance controller of the company estimates that the bad debt losses are approximately 2% of the credit sales. The firm currently spends 1,40,000 annually on the debtors administration, like telephone, the calls, and sending recovery agents and all that. This cost comprises of, look at this, telephonic bills, fax bills, along with the salaries of staff members. And these are avoidable costs. When can they be avoided? If you are appointing a factor. Now, a factoring firm has offered to buy the firm's receivable. Now, what this factoring firm says, look, 30 lakhs is your receivables. We will buy it from you. Meaning what? We will buy this. We will be the owners of this 30 lakhs. We will pay you some money today itself. At the end of the credit period, we will collect it. At the end of 30 days, we will collect it from the debtors. If there is any bad debts, we will bear it. Are you clear with this? How do we know they are bearing it? They are saying it's all avoidable cost. Clear? Factoring firm is offered to buy the firm's receivable. The factor will charge 1% commission and will pay an advance against the receivable on an interest of 15% per annum after withholding 10% as reserve. Analyze what the firm should do. Assume 360 days in a year. Now, what is this? Now, very, very beautiful calculation. Time and again, students make a mistake here. Maybe if this can come for a 5-mark question. The other areas in receivable management are fairly simple and straightforward. This is the place where generally students find it difficult. And I think this is the only question given in your illustration regarding your factoring. So please pay attention to this. Now, what they are saying is, first, what is my debtor's value? My debtor's value is 30 lakhs, correct? Now, this guy factor, he says, I am going to charge you 1% of the debtor's value as commission. So what is his commission? His commission is going to be 30,000 rupees. Now he is also telling one more thing, right? So 30 lakhs is the value of debtors for which he is willing to purchase from you. Now he's saying, look, that entire 30 lakhs I will not pay you today. I will withhold 10% for what? It is going to be for my security purpose. I will withhold this. This 10% I am withholding, is it a cost? No. After this 30 days, I will pay it back to you the moment I collect it from your debtor. Clear? So the factoring firm says 10% alone I will withhold. So for safety purpose, at the end of 30 days, the balance 10%, I will release the payment. So initially, I will release only 90% of the payment. Are you clear with this? So basically, the factoring commission is how much? 1%. Reserve, how much amount is he withholding? 10% of 30 lakhs, it's going to be 3 lakh rupees. So now what this factor says is, so now today I am purchasing the debtors worth how much? 30 lakhs from the company, correct? Now from this 30 lakhs, I will withhold 3 lakh rupees, that is reserve, correct? So balance 27 lakhs I will pay. No, he's saying my commission, you need to pay me 30,000. That also I will deduct it upfront. So this 30,000, it needs to be paid by this company to the factor, correct? So now what the factor says is, I need to pay you 30 lakhs minus 10%. I am putting it as my cushion, minus 30,000. That also I will just reduce it, and the remaining amount only I am just going to remit it back to you. So basically he says 3,30,000 rupees he will withhold upfront. Are you clear with this? That is 30,000 rupees with respect to the factoring commission and 3 lakh rupees with respect to reserve. He says this 3,30,000 upfront I will not give you. This I will keep it with myself, because 30,000 is anyways the money that you need to pay to me. 3 lakhs is I am keeping it for security purpose. After 30 days, the moment I recover money from the customer, I will pay this back to you. Are you clear with this? Now Now, not just that, he is saying one more thing. Now, technically, how much is the amount that he is going to release for funding? 30 lakhs minus 3.3 lakhs, correct? So this is technically how much, guys? This is going to be 26 lakhs 70,000. So he will release 26 lakhs 70,000 to him today itself. Today, you have made the sale today. So you are going to a factor. The factor says, I will pay you 30 lakhs, but wait, I will withhold 3 lakh rupees pertaining to my reserve, 30,000 rupees pertaining to my commission. So I am going to fund you today itself. I will pay you 26 lakhs 70,000, correct? But wait. He says this 26 lakh 70,000 I am funding to you today, it is going to be against an interest of 15%. Why? Well, this guy is saying, come on, I am going to bear your risk, correct? I'm going to bear your risk. Not just that, for 30 days, I'm going to finance you. If you are able to, if you want to do it by yourself, you need to incur some extra cost plus wait for 30 days. Whereas if you're doing it through me, you just need to pay me a commission. And of course, for the 30 days, whatever I'm funding you, that portion, you need to pay me some interest. So now how much amount is this factor funding him? Today itself, he's ready to pay 26 lakh 70,000. So what is the interest applicable on that? He's going to fund only for 30 days. Correct? So this is going to be 26 lakh 70,000 into 15% into 30 divided by 360. So how much is this going to be? So 26 lakh 70,000 into 0.15 into 30 upon 360. So this is going to be 3,375 rupees. This is payable as interest. So he's saying from this amount that I'm going to disperse to you, the interest also I will deduct it upfront. So the net amount that I will release today is going to be 26 lakhs 36,625. Are you clear with this calculation? So basically we found the debtor's value. This entire value will the factor give it today? No. For cushion purpose, for the safety purpose, he will withhold 10%, that is 3 lakh. Then he is charging a commission, that also he will withhold at the time of payment itself. So 3 lakh 30,000. So the net amount he is ready to release or fund is 26.7 lakhs. On this 15% per annum for 30 days, he will compute the interest. That also he is deducting upfront. So all his fees and all he is deducting upfront, fees and interest, and net amount only he will release it to the company. Are you clear with this? So the company will get today, net amount the company gets is 26 lakh 36,625. Are you clear with this? Yes. Now, because the company goes to the factor, what is the benefit? Benefit number one, the company can save on what? The cost of administration. They had given all this fax and all this admin staff and all. 1,40,000 I can save. Yes. Then the company can also save what? The cost of bad debts. Yes. So 2% on annual sales is generally my bad debts. Every time I make a sale, I'm going to repeat this. So once in every 30 days, this again, I'm going to make what? This 30 lakhs rupees worth of sale. Correct or not? So 30 lakhs again and again, every 30 days I do. So in a year, I will actually factor the entire 360 lakhs worth of sale. At a time, I will factor only how much? 30 lakhs. But anyways, it gets factored again and again in a year. So obviously what happens here? What happens here is, so here the entire bad debts cost, this can also be saved. 2% on 360 lakh, 7 lakh 20,000. So how much amount you are able to benefit because you are going for the factor? 8 lakh 60,000. But wait, is there a cost associated with it? Yes, there is a cost associated with it. So what is the cost? There are only two costs. What are the costs here? Factoring commission and interest charges. Remember that reserve amount is not a cost. He will release it after 30 days. So don't worry about it. That is just he withholding it for security purpose. Now factoring commission, how much is it? How much is it? Commission is 30,000 rupees. Correct? 30,000 rupees. But remember, this 30,000 rupees is pertaining to one cycle of 30 days. Correct? In a year, they keep on doing it. So basically, 30,000 rupees is for 30 days. How much is it for 360 days? Because the moment 30 days gets over, again this company will go to a factor, the new debtor will come, for them the next 30 days they will fund. Like this, it keeps on moving. So technically throughout the year they will be funded by this factor. 30,000 upon 30 into 360. Annually the factoring commission is how much? 3,60,000 rupees. Correct? Similarly, the interest charge is also 33,375. That is pertaining to one period. That is pertaining to 30 days. Like that, how many days are there in a year? 360 days. So 33,375 upon 30 into 360. So that gives you how much? 4,500,000. So what is your total cost that you incur, extra cost you incur because of factoring? 7,60,500. What is the total benefit you get because of factoring? 8,60,000. So the net benefits the firm is 99,500. Or in other words, if you do this factoring, if you go for this factors method of funding, you will gain a net amount of 99,500. So is it worthwhile to go for factoring or not? Yes. Since the savings to the firm exceeds the cost of the firm on account of factoring, the proposal is acceptable. Are you clear with this? So basically this factoring is nothing but almost similar to the bill discounting concept, discounting of bills of exchange, but here it is done by a third party called as factor, for which he charges a commission and also charges an interest, and all these things he deducts upfront. Are you clear with this? But for that, there is no difficult areas in this particular concept of receivables management. So with this, we have finished this part as well of receivables management. So now let's move to the next unit of discussion. Now, this is unit 5, which is management of payables, that is creditor. Now you tell me, these guys, the creditors of a company, they technically fund you, but not by giving you money, but they fund in kind. That is, they sell the products today and they are ready to accept the payment at a later date, correct? So indirectly, this is also a source of working capital finance only. Now with respect to management of payables, what is the issue here? What is the issue? What needs to be done here? So there are some costs for availing the trade credit. Now, if I go for a trade credit, that is, if I want to purchase on credit, if I want to make purchase credits, it is actually not free of cost. It comes with some cost. What is it? Number one, price. Now, if you see, if you paid by cash today and purchase, or against that, if you actually purchase something on credit, there will definitely be a price difference. What is it? So basically, if you pay today and purchase it, this guy, the supplier, will give you a discount. Why? Because you're making the payment today itself and you're carrying it. Yes, you're taking the goods, cash and carry model, correct? Suppose you are saying I want 3 months credit and all. So this guy will not give you the discount. So technically, you are losing out on the discount because you are going for a credit period. Are you clear with this? So because of going for credit, there are some prices like this one. The first one is a change in the price. Number two, suppose if you do not keep up with your commitment, you are saying that you will pay after 30 days, but you are not paying after 30 days, it amounts to loss of goodwill. So this is basically a qualitative factor. This cannot be quantified in monetary terms, but yes, this will result in cost of goodwill, loss of goodwill. Then since you are having a lot of suppliers, now you need to have a separate team and incur some administrative costs. And of course, there are some conditions that you need to abide by. Sometimes most of the suppliers insist that for availing the credit facility, the order should be of some minimum size or even on a regular basis. Just like that and all, they will not give credit facility for every customer. So the suppliers will say you need to purchase a minimum of so much, or you should purchase every month you need to purchase. So all these kind of conditions they will do. But you know, there are some costs of not taking the credit. That is, these are some benefits of taking credit. What are the benefits of purchasing on credit? The first one is impact of inflation. Assume there is no concept of credit purchase. Now what will happen? You can purchase only when you have the money, correct? Let us say in the month of Jan, you wanted to purchase something, but you didn't have the money. Now you got the money somewhere in the month of Feb. But what happened between this Jan and Feb? There happened an inflation, and because of this, the per unit price went up. Now you tell me, had you purchased the products on credit, you could have purchased it in the month of Jan itself at the price prevailing in the month of Jan. Correct? The payment could have been done on a later date, no problem. Whereas now that you do not have this model of cash, suppose if you do not have this model of credit, if you need to pay by cash, now you need to purchase it only in the month of Feb when the prices have gone up. Or in other words, when there is inflation, not taking a credit will actually make you lose some money. Are you clear? On other words, when there is an inflation, when prices are rising, it is better to go for credit period. That is, it is better to purchase goods by using a credit period because make some credit purchases, because now you will purchase it at a time when the prices are relatively lower. At the time of payment, even when the prices are higher, you need to only pay that amount which was prevailing at the time of purchase. Correct or not? This is what it is. Number two, yes, we know that the straight credit is typically an interest-free loan. This is what I said. It is technically funded. It is funded by way of non-cash item. That is, it is not a monetary way of funding, but through materials they are funding it. So it comes free of interest. That's what they are saying. And number three, inconvenience. Sometimes you might not be having cash whenever you want to purchase. So now in that case, all this taking up credit from the supplier will help you. So this is also one more advantage of taking credit. See how they have used this double negative. Cost of not taking credit, which means benefit of taking credit. Are you clear with this? That is what they have mentioned. Now in this segment, generally the problem arises with respect to cash discount. The problem arises with respect to cash discount. This is one very good sum given in the institute study material that we are going to solve right now. So please pay attention to this. Now, many students do not understand this question itself. So first, let me read the question and explain you what is the decision that we need to take. The dolls company purchases raw material on terms of 2/10 net 30. First, wait. What do you mean by 2/10 net 30? Now, generally, the supplier is telling you, so you are the customer, there is another supplier from whom you are purchasing the goods. He is telling you that the normal credit period is what? You need to make the payment by 30 days, correct? But if you make the payment before 10 days, if you make the payment by 10 days, I will give you a cash discount of 2%. Clear with this? Now you read this. 2/10 net 30 means what? 30 days is the general credit period. You need to make the payment anyways by 30 days, but if you make the payment within 10 days, you are eligible for a discount of 2%. This is called as 2/10 net 30. It could be anything. 1/20 net 40 also it can be. Are you clear with this? But whenever they give this word, understand the meaning of it. It means this 30 stands for the general credit period, maximum credit period, but this 10 stands for the credit period before which if you pay, you will get a discount of how much? 2%. Are you clear with this? This is the meaning of this 4 words given here, 2/10 net 30. Clear with this, guys? Now, a review of the company's records by the owner, Mr. Gautam, revealed that payments are usually made 15 days after the purchases are made. So generally what this company is doing, their past record shows that the company is making the payment after 15 days only, which means, are they enjoying this cash discount? No, they are not enjoying this cash discount, right? Now look at this. When asked why the firm did not take advantage of its discount, the accountant, Mr. Rohit, replied that it cost only 2% for these funds, whereas a bank loan would cost 12%. Now, what is the justification Mr. Rohit is saying? Sir, now we are paying after 15 days, correct? Suppose we need to pay it 5 days in advance. That is, if I want to avail the discount, correct, I need to make the payment by the 10th day, correct or not? So technically speaking, what I need to do is, if I have to make the payment 5 days in advance, now I don't have the funds with me. I need to borrow the money from the bank, correct? If I borrow the money from the bank, it will cost me 12% interest, correct? Now, why should I pay 12% to get a discount of only 2%? This is the logic that Mr. Rohit, the accountant, is saying. Are you clear? Currently, the company is paying it within 15 days. Now, the owner, Mr. Gautam, is asking why you are not availing the cash discount by paying it within 10 days. He's saying, if you want me to make the payment before 5 days, then I don't have the money. I should borrow it from the bank. Bank interest will cost 12%. Why should we borrow money by paying 12% interest to get a benefit of 2% discount? It doesn't make sense. This is the illogical explanation that Mr. Rohit is giving. Clear with this? Yes. Analyze what mistake Rohit is making. Number 2, if the firm could not borrow from the bank and was forced to resort to use the credit funds of trade funds, then what suggestion might be made to Rohit that would reduce the annual interest cost identified? Now, first of all, you understand one thing. This 12 percentage is per annum. Whereas this 2 percentage, what this guy is saying is, I will give you a discount of 2 percentage provided you make the payment 5 days earlier. So technically this 2 percentage is pertaining to 5 days. This 12 percentage is pertaining to 365 days. These two are not comparable as such. But this guy, the accountant, he has made a mistake in comparing these two assets. Are you clear with this? So Rohit's argument of comparing the 2 percentage discount with 12 percentage bank loan rate is not rational, as 2 percentage discount can be earned by making the payment 5 days in advance. Whereas, so that is within 10 days rather than 15 days, right? Whereas the bank loan of 12 percentage is a cost that is incurred for 1 year. Clear? So assume, let us say the purchase value is 100 rupees. Guys, this calculation is very important. Let us say the purchase value is 100 rupees. Now the discount that can be earned by making the payment within 10 days, that is, generally you pay it within 15 days. Now you pay it within 10 days. That is, by making 5 days in advance. If you make the payment within 10 days, how much discount you will get? 2 percentage on 100. You will get 2 rupees discount. Correct. So the net amount that you will be paying, to your creditor, to your supplier will only be rupees 98. Yes or no? So you will be having 2 rupees extra with yourself. Yes, guys. Clear or not? Now you tell me how much you have paid. 98 rupees only is the cost for you. Now how much you have saved? 2 rupees you have saved. Correct. Now this 2 rupees is the savings for 5 days. So how much is the savings for 365 days? This 2 rupees upon 98. So this 2 rupees is the amount saved for every 98 rupees paid, and this is happening for every 5 days. So how much is your overall savings for 1 year? So it is going to be 149 percentage. If you annualize it, technically speaking, this discount can be 2 percentage on the order value. But what is happening here? Because I am making this in 5 days early, this is actually the savings made, the percentage 2 upon 98. If you see this, it is going to be 2.04 percentage. You technically save 2.04 percentage for 5 days. So how much do you save for an entire year? Technically, it's actually the annualized benefit of taking the discount is 149 percentage. You should compare this 149 percentage with 12 percentage. Now you see which is better. Obviously, if I take this, if I make use of this particular discount, discount that they have mentioned, that is 2 by 10 net 30. If I make the payment 5 days earlier, that is before 10 days, now I can save some discount, and the annualized cost of discount is actually 149 percentage as against 12 percentage. So it is better for me to borrow at 12 percentage, annualized 12 percentage, and pay this creditor 5 days earlier and benefit by 149 percentage. So obviously it is better to take the loan, pay this creditor 5 days before itself, that is within 10 days, and avail the benefit of 149 percentage. This 2 percentage is for 5 days. 2 upon 98. Why is it upon 98? Because 98 is the amount that I'm now net of. 98 is the amount that flows out of my, that is the cash outflow that is happening if I actually go for this discount. Yes or no? So basically 2 upon 98, you will get the actual savings, the discount percentage that you earn, that is for 5 days. How much is it for 365 days? Are you clear with this? This means the cost of not taking the discount is 149 percentage. So what is suggestible? You borrow at 12 percentage, make the payment early, and avail this benefit of 149 percentage per annum. Annualized, if you annualize it, it is 149 percentage. But if you're talking about for the 5 days, it is going to be 2%. Are you clear with this? No. Now, suppose the firm could not borrow from the bank and was forced to resort the use of the credit fund, trade credit funds. What suggestion might be made to Rohit that would reduce the annual interest cost? Now, if I am able to borrow the money, I can make the payment quickly, and I can make the payment within 10 days, and I can get the discount benefit. Suppose if I am not able to get the bank loan, then what needs to be done? Then anyways you need to pay within 30 days. No doubt about that. So within 30 days you need to pay. Suppose you're not getting the loan. If you're getting the loan, pay it within 10 days, avail the discount benefit. if you're not getting the loan, definitely it needs to be within you. It needs to be paid within 30 days. There is no second thoughts about it. That is what they have mentioned. The bank loan facility, if the bank loan facility could not be available, then in this case, the company should resort to utilize the maximum credit period as possible. Therefore, the payment should be made in 30 days to reduce the interest cost. Are you clear with this? This also they will borrow. Maybe if they are not able to immediately arrange the funds, they will somehow arrange it after a period of 10 to 12 days. Yes, maybe after some time, whatever it is, make sure that you are making the payment within 30 days because your overall interest cost will also be minimum. Of course, the company's goodwill is also at stake. Are you clear with this? So in this case, you tell me, is it better to go for the discount? Yes, absolutely. It is better to go for the discount because it gives you a benefit of 149% annualized, correct, as compared to bank borrowing of only 12%. So borrow at 12%, make the payment early and get a benefit of 149% in an annualized manner. Are you clear with this? And that is about this particular segment of creditors management. Now, the final part is actually financing of working capital. This is basically a theoretical part. So now in the first segment of the chapter, we saw how do you calculate the amount of working capital required, correct? Working capital investment, how do you calculate the amount? Yes, we saw current assets minus current liabilities. We saw all those calculations with the working capital cycle and all. Now, this segment talks about how do you finance it? How do you arrange for this finance? Correct. After determining the amount of working capital required, the next step to be taken by the finance manager is to arrange the funds. As discussed earlier, it is advisable that the finance manager bifurcates the working capital requirements between permanent and temporary. So permanent working capital means what? At any given point of time, it should be there in the business. Temporary, I told you, it's only a seasonal requirement. So this needs to be classified. Permanent working capital is always needed. Hence, it should be financed through long-term sources such as debt and equity. Are you clear with this? This is where I said your working capital finance is not a short-term finance. It is a long-term source of finance that needs to be arranged. So you can also arrange it through your debt and equity channel. On the contrary, temporary working capital may be arranged through some short-term sources of finance. So broadly speaking, the working capital finance can be classified into two categories: spontaneous sources and negotiable sources. Spontaneous sources are the sources of finance which naturally arise in the course of business operation. That is nothing but your creditors, correct? Trade credit, credit from employees, credit from suppliers of services, that is outstanding wages. For 1 month delay, they will accept all these things. These are spontaneous sources, that is they are naturally bundled in the course of the business. Whereas negotiated sources is what you going to a bank and asking for some loan. On the other hand, the negotiated sources, as the name implies, are those which have to be specifically negotiated with the lenders, say commercial banks, financial institutions, general public, etc. And the finance manager has to be very careful while selecting a particular source or a combination thereof for financing of working capital. Are you clear with this? This is basically a theoretical part, and with this we have completed this particular chapter. Now this is actually a very big chapter. Working capital is actually a very big chapter. Now we have spent approximately about 2.5 hours in condensing the entire chapter on a bird's eye view, right? So this marathon will help you revise all these concepts covered in this particular chapter, because this chapter, working capital management, this is actually a very big chapter. It has 6 units inside it. I told you it's actually a big chapter. There is a lot of numerical problems that needs to be solved that I generally do it in my regular course, but in a fast track course I wanted to touch upon the important aspects in every single unit. So that is why we have seen all the 6 units. In that, the important and the tricky areas we have explained it here. But don't think that working capital is only this much. There are some extra issues that needs to be discussed, but those issues I've just generally I cover it in my fast track. But in this marathon, whatever is important, utmost important area, I have picked it up and I have compiled it. And I think we have done about 5 questions in this particular segment. So that will do for this particular revision. Clear with this? Yes.